Hey, good morning all. So, welcome to the revision batch for CMA Intermediate, and hope you have already learned little bit about the subject, correct? So, not that you are coming and learning for the first time, am I right? Yes. So, because what happens is that in 4 days I cannot complete the entire batch for the first time learners, okay? So, this is like only I will be doing a revision from the importance point of view, because if you see CMA Intermediate, you have this paper 7B. So in that, what they are doing is that they are giving the questions mix and match, like DT question is also there, IDT question is also there. There is no proper division, kind of division in the sense like part A or section A, section B will be IDT, like that it is not there. I have seen your question paper. So wherein 15 questions are there into 2, 30 MCQs, that 30 marks, that is 15 MCQs into 2 marks each, and then you have this descriptive questions. So I don't know whether you have gone through the GST videos which I have already uploaded in my YouTube channel. So for GST, that is CA Intermediate students, I already did 5-day batch. So that contains lot of GST related information. So this particular class I am focusing more on the extra topics, so which are there for CMA Intermediate, because everywhere what they do is that CA Intermediate portion only CMA Intermediate students also will be learning. But for CMA Inter, there is some extra topics which are all applicable. So those extra topics also we need to learn. So I am just giving you the focus, like where we are going to focus this next 4 days. So first we are going to cover the extra topics which are there for CMA Intermediate, including customs and even some additional topics in GST also we have, like rules related information, etc. and all, which usually you will not be focusing that much. So that we are going to see. Second, we are going to cover all the amendments. Any issue? We are going to cover all the amendments. So amendments we are going to cover, and already your now if you see CMA Institute website, here they have given so one supplementary for June 25 exam, okay. In that paper 7B, like that they have given what are all the amendments. So we are going to cover these amendments. Usually what happens, these amendments will be helpful in scoring in MCQs. So in MCQs it will help. Mostly what I have observed over the last 4-5 years papers I have seen. So initially it was fully objective, because this MCQ based exam only you had. So only from last 1 or 2 years only they started asking descriptive questions in the exam. So when I have gone through these papers, so every attempt they are focusing on little bit on amendments in MCQs, so rather than creating the questions, but the difficulty was not that much, so it was little easy only. Definitely you will be able to cope up, okay. And so I don't know whether students are watching in YouTube or not. Hello, if you are there, just comment. So whatever doubts that you have, you can put it in the chat. I will be able to see your chat. And as students are watching across the South India, for that reason I am taking the class in English. Is it okay? Yes. So in the break time, whatever doubts you have, you can ask me in Tamil and I will be able to respond to you. But the class alone, let's have a common mode of communication, that is English, okay. Then, so first I told you that extra topics we will be covering, and then we are going to focus on this amendments also, and thereafter we will be discussing, like this will take some 2 days, and next 2 days we will be focusing on GST from CMA Inter perspective. I mean, for your exam there are some important areas from which repeatedly they will be asking questions now, so that we will be discussing. So that's how we are going to schedule this 4 days classes. Done? Yes. And this particular customs, let me start with the customs first. So in this customs, because I told you that you would not have covered customs at all, so that's the reason why I am just discussing with you the customs related portion first. And you can see here And online students, you can download the PDF from the description to this video. You can download this PDF for indirect tax extra topics, and you can see that. Hope you all got the handout. So that is because you are coming for face to face na. So extra privilege. All the time you are traveling from long distance and you are coming. So I should encourage face to face students. That's why I gave the booklet for free. Got it? And those who are sitting like lazy fellows, even though in Chennai, thinking I can watch in YouTube and all, let them take a print of it. Correct or not? Some difference should be there, no? So see this. Taxable event under customs. So first of all, you need to, so today we are going to complete customs. You have only 4 chapters. So taxable event under customs, that is when there will be levy of customs duty, and then computation of customs duty, that is how to compute the customs duties and types of customs duties. And next aspect is about the valuation, computation of assessable value and customs duty payable, including valuation rules. These are the 4 areas that you have as per your study material. Okay. So first we are learning the basic aspects. So when will there be customs duty? You tell me. When will there be customs duty? On import of goods into India or export of goods from India, there will be levy of customs duty. So customs duty is levied as per Customs Act 1962. So act year you should remember. What is the Customs Act? 1962. And whether the Customs Act is applicable to the whole of the country, including Jammu and Kashmir? Yes. If you observe, some laws are applicable to only, except Jammu and Kashmir to the country. Some laws are applicable throughout Jammu and Kashmir as well as India. So like that, Customs Act is applicable to whole of the country. Okay. And for the purpose of levy of customs duty, so total 4 conditions should be satisfied. 4 basic conditions should be satisfied. What are those 4 basic conditions? So see that below. First, there must be goods, and that goods must be imported into India or exported from India. Got it? There must be goods, and those goods should be dutiable goods. What is the meaning of dutiable goods? Those goods which are covered under Customs Tariff Act 1975. So now you need to remember 2 acts. One is Customs Act 1962. So that is the first thing that you need to remember. This is Customs Act 1962. And then you need to remember Customs Tariff Act 1975. What is the difference between Customs Act and Customs Tariff Act? Customs Act contains the provisions related to import and export, how to import, how to export, how to compute the customs duty will be there in the Customs Act. But what is the rate at which we need to pay the customs duty? That information will be there in Customs Tariff Act. For example, you are importing a product. Say you are importing this calculator, and on this calculator, what is the rate at which you need to pay customs duty? So that will be there in Customs Tariff Act. Okay. And how to import this, when to import, and what are the documentation required, all those things will be there in Customs Act. So these 2 are connected. So Customs Tariff Act contains only the rates related information. Okay. So after remembering these 2, the next area that you need to see is that what are the 4 conditions that must be satisfied to attract customs duty liability. So there must be goods, and that goods must be specified in the Customs Tariff Act, and that goods should be imported into India or exported from India. Okay. So that goods should be imported or exported. Such import must be into India or such export must be from India. Then if these 4 conditions, whether all the conditions should be satisfied? Yes. When all the 4 conditions are satisfied, then customs duty liability gets attracted. Got it? And next here, what is the meaning of import and what is the meaning of export? You should be knowing. So you understood the 4 conditions now. So what are the 4 conditions? There must be goods. That goods must be dutiable. Dutiable means what? It should be covered under Customs Tariff Act. And next it should be imported or exported. Where it should be imported into India or exported from India. So when these 4 conditions are satisfied, then there will be levy of customs duty or customs duty liability gets attracted. In this, each and every terminology we need to focus. So we need to first know what is the meaning of goods, and next we need to know what is the meaning of Customs Tariff Act, and that is dutiable goods. Then import means what, export means what, and the meaning of India also we need to know. Now you can see now the same page above, Customs Act extends to the whole of India, and save as otherwise provided in this act, it applies to any offence or contravention committed outside India by any person. So what is the meaning of India? Because for the purpose of levy of customs duty itself, so they are telling if it is imported into India or exported from India, like that. So what is the meaning of that India? That we need to first know. So generally the meaning of India, next page you see, India means up to territorial waters. What is territorial waters means? Up to 12 nautical miles from the baseline is known as territorial waters. You can see the image in the same page below. That is, from the land up to 12 nautical miles is known as territorial zone, and thereafter beyond 12 and up to 24 nautical miles is known as contiguous zone. Contiguous zone means if any vessel or aircraft is coming into the contiguous zone which is not having proper permission to enter, but it has entered, so that can be fired upon. Okay, so the customs, like this coastal guards and all will be there na. The coastal guard will have power to shoot the ship or shoot the aircraft or seize the ship or arrest the people. Got it? All those powers they will be having in this contiguous zone if without power they are coming into that area. Got it? And territorial waters is completely India, that is complete domain of India, and thereafter beyond 24 nautical miles and up to 200 nautical miles we have one area. What is the name of that area? You can see Indian Exclusive Economic Zone, and so this is called as like a common area for all the shared countries. For example, India, Sri Lanka, this side Myanmar, all those countries will be there na. For that, this 200 nautical miles in Bay of Bengal will be common. Every country will have equal right over there. That is called as exclusive economic zone, and beyond 200 nautical miles the area we call as high seas. So this we need to know for MCQ purpose. So they will ask, so high seas extend up to A, B, C, D. So beyond 200 nautical miles, not up to 200 nautical miles, beyond 200 nautical miles. Territorial waters extend up to 12 nautical miles, and contiguous zone is up to 24 nautical miles. Exclusive economic zone is up to 200 nautical miles. Is it clear? So therefore this is the meaning of each and every terminology. So the waters when we see, but what is the meaning of India? Up to 200 or up to 12? Up to 12. You can see there, up to 12 is known as India, but up to 200 is known as Indian customs waters. See the definition, Indian customs waters. Indian customs waters says waters extending into the sea up to the limit of exclusive economic zone under section 7 of the territorial waters, continental shelf, exclusive economic zone and other maritime zones act, and includes any bay, gulf, harbor, creek or tidal or river. So what you need to remember is up to 200 nautical miles is known as what? Indian customs waters. Again I am repeating, India is up to 12 nautical miles. Indian customs waters is up to 200 nautical miles. What is the difference, sir? What is the difference between India and Indian customs waters? All the provisions of Customs Act is applicable in India, but some people will commit the offences etc. and all na. So then in that case, whether the customs officer can arrest that person even beyond 12 nautical miles and up to 200 nautical miles? Yes. For example, Danny, like that one person will be there. So who will be a drug lord, okay, and he will be doing lot of smuggling etc. and all. Now our Dorai Singham can go and arrest the person or not when he is in the territory, like beyond territorial waters? Yes, that is possible. You understood or not? So like that. So for the purpose of arresting a person or seizing the ship or for the purpose of firing upon etc. and all, these powers gets extended beyond 12 nautical miles and up to 200 nautical miles. Got the connection between India and Indian customs waters? Now go back to the previous paragraph and read this previous page. Now you read, you will understand. Customs Act extends to whole of India, and save as otherwise provided in this act, it applies to any offence or contravention committed thereunder outside India. What is outside India means? Beyond 12 nautical miles. Very good. Beyond 12 nautical miles for the purpose of offences and penalties, this will be applicable. Got it? Next. So, if you see imposition of customs duty, so we have three aspects that we need to know. First levy, then point of payment called as assessment, and then collection. What is the meaning of levy? Levy means what? When will there be customs duty imposed? That is known as levy. The point of time at which liability to pay duty gets attracted, that is known as levy. Okay. Then point of payment. Okay, I have the liability, but when I should discharge that liability, that is known as point of payment. Okay. Then collection. Collection is the time at which liability is actually collected. You just try to understand the connection like this between these three. There is a cage. There is a cage. Inside that cage, there is one monkey. Okay. That monkey name is duty. That monkey name is duty. The moment you open the cage, the monkey will jump on your head. Okay. Only when you give the banana, the monkey will get down. You understood? Now, opening cage is the taxable event, levy. Opening cage is the taxable event, levy. And the monkey will come and sit on your head, liability. You got it? You have a liability. So, once the levy happens, the liability gets attracted. Okay. Then you need to discharge the liability. How you will discharge the liability? You will give banana to the monkey, so it will get discharged. You understood or not? So that is the difference between levy. Levy means the stage at which liability gets attracted. The moment you open the gate, that opening gate is the levy. Got it? And point of payment. So point of payment is what? The moment you open the cage, the monkey comes and jumps on your head. That is a point of payment. You understood? But whenever you actually give the banana, only it will get down. So that is known as collection. Is it clear? Understood? Next. So levy, when will levy happen, or other name for levy is taxable event. The event on happening of which duty liability gets attracted is known as taxable event. As per section 12 of Customs Act. So you need to remember this section, highlight this section, section 12 of Customs Act 1962. Section 12 of Customs Act 1962 is the taxable event. What is the meaning of taxable event? The event on happening of which you need to pay tax or pay duty, that is known as taxable event. So what is a taxable event? Import into India or export from India is the taxable event. Is it clear? And what is the difference between duty and tax? What is the difference between duty and tax? Duty means whether you are earning money or not, you need to pay that. That is duty. But tax means only when you are earning money, you need to pay. For example, I am importing, one watch for my own consumption. Should I pay the customs duty? Yes. If I am importing the watch for reselling, so selling it in Instagram, because if you see Instagram, lot of first copy goods and all they will be selling na. So if you see all branded goods, first copy, second copy they will be selling. All those are imported. For what purpose they are importing? For the purpose of sale, reselling. So they are generating a revenue. And some people will import for their own consumption. So the celebrities, etc. and all, if you see, they will not buy local made goods. Then what is the difference between you and the celebrity? So they will be importing goods for their own consumption. Correct? So whether they need to pay customs duty? Yes. That is the difference between duty and tax. So whether I am earning money or not, I need to pay. That is called as duty. Only when I earn money, I need to pay. That is called as tax. Is it clear? So customs duty is duty, which means when you are importing, whether it is for one purpose, that is you are generating money, or you are not generating money, you need to pay. That is called as customs duty. Is it clear or not? That is the reason why the taxable event is import into India or export from India. Now, so you can see this section is the charging section of the act. So every act will have a charging section. What is the charging section for GST? Section 7. Section 7 is the charging section which talks about supply. When will there be GST pa? Supply of goods or service or both. So supply is the taxable event in GST. Section 7 is the charging section there. Like that here, section 12 is the charging section. And for the time being enforced, duties of customs shall be levied at such rates as may be specified under Customs Tariff Act. I told you. What is the connection between Customs Act and Customs Tariff Act? Customs Act contains only the provisions like when will there be levy, but rate will be there in Customs Tariff Act. Okay, and whether government is importing and they are also required to pay customs duty. Government imports, na, what government will be importing? Lot of things they will import. So for example, right now metro project is being constructed. For that, lot of equipments are required. They will import that, and for the purpose of like defense equipments, weapons, shield, so all those things, tear gas, all these things also will be imported. So when they are importing this, for what purpose? Definitely government's purpose only. So whether they are also required to pay customs duty? Yes, because if you observe, the difference between income tax and indirect tax is that in income tax, government is not a person. If government earns income, they are not required to pay income tax. But if they are covered under customs, that is import, they are required to pay customs duty. If they make any supply, they are required to pay GST. Let's take an example of IRCTC. Is IRCTC government department? Indian Railways government department. When Indian Railways is earning profits, whether they need to pay income tax on the profit? No, because government department is not a person under Income Tax Act. But when IRCTC is providing the service by way of transportation of people or transportation of goods, are they required to pay GST? Yes. Same way, when they are importing any equipment for use in the railways, are they required to pay customs duty? Yes. You understood the difference? So government is not a person under income tax, but government is a person under GST and customs. So that is the second point. The provisions of subsection 1 shall apply in respect of all goods belonging to government as they apply in respect of goods not belonging to government. So government as well as non-government, both are treated as same under customs. However, for government, some imports are exempted, no need to pay customs duty. What are they? You can see, government usually imports some goods. Is it required to pay customs duty for that? So as per section 12 subsection 2, customs duty is payable by government also, just now I told you. However, the following imports made by government is exempt from payment of customs duty. What are they? So just remember this part: Indian Navy, Police, Ministry of Defence and Coastal Guard. If they import any specific equipments, so they are not required to pay customs duty on that. Who are they? 4 are Indian Navy, then Police, Ministry of Defence, then Coastal Guards. So Navy you can understand. So what Navy officers will do? Transportation of goods, passengers by ship, etc. and all, that is Indian Navy. And Police, Indian Navy will be safeguarding the country through sea. If anyone is attacking, Indian Navy will safeguard. Coastal Guard will safeguard the borders. If any goods are, smuggled goods are entered into India, etc. and all. Police, you know. Ministry of Defence means Army, Indian Army, etc. So if these people are importing any goods, that is exempted. Apart from that, any other goods imported by government also, they need to pay customs duty. Then what is the scope of Customs Act? So Customs Act applies to whole of India and save as otherwise. So it already we discussed. Meaning of India also we discussed. Meaning of Indian customs waters. What is the meaning of territorial waters? That also I told you. So territorial waters is up to what? 12 nautical miles from the baseline. Okay. And when I say this water only coming under territorial waters, or even the airspace also will come. Airspace also will come and the subsoil also will come. Because when a flight is coming, it is not coming on water, it is coming on the top. So that is also covered. And through submarine also goods can be imported. So that is also covered. You can see there, So India includes not only the surface of sea in the territorial waters, but also the airspace above and the ground at the bottom of the sea. You understood? So India means not just the land, up to 12 nautical miles, not only the water, but also the airspace, but also the bottom of the sea. Everything is part of India. Got it? Now generally we will say, so like if some other vehicle is parked outside our house, what we will tell? We'll ask them to remove the vehicle. So when we ask them to remove the vehicle, that person will say, I kept in road only, now what is your problem, like that. Now, so by definition, my house includes the precincts of my house. Is it clear? So the precincts of my house. What is precincts of my house means? The front area is also mine. So you cannot block my gate and you cannot say it is road only, etc. and all. I have right to passage, correct? Like that. So when you say India means not only the land, even the 12 nautical miles from the land, that is also part of India. Next. So when there will be import into India or export from India, just now I told you India means up to 12 nautical miles. So as soon as a ship or a aircraft enters into this 12 nautical miles, then it is called as import into India. Is it clear? Now here we need to understand one aspect. Sir, this 12 nautical miles, how I will know? Will they construct a gate, something in the water? So how will I know that it is 12 nautical miles? It's an imaginary line, means no one will put a gate there. How in sea you can construct a gate and all? So not practically possible. Every ship will have a radar. So that radar will tell as to from the land, so that line. So they will have a screen. In that screen, many Hollywood movies also would be seeing na. So one screen will be there. In that screen, it will tell you are entering into the line of territorial waters, you are not having permission, etc. and all. So through that they will be checking this. What is the significance of Indian territorial waters and Indian customs waters? Okay. So Indian territorial waters is up to 12 nautical miles from baseline and Indian customs waters is up to 200 nautical miles. But I told you the connection. So what is that? For import and export we see territorial waters, but for offences and penalties we will be seeing 200 nautical miles. Read it. If a person has committed any offence punishable under Customs Act, okay, punishable under Customs Act within the Indian customs waters, he may be arrested. Also goods may be confiscated and vessel may be stopped, okay. So in the Indian customs waters, if the same is found to be used in smuggling. Further, prohibited goods can also be confiscated if brought within the Indian customs waters. Is it clear? Yes. Next you can see this. This is what I was referring to. Up to 12 nautical miles is territorial waters and thereafter up to 200 nautical miles customs officer can execute their powers. Okay. Next. Look into the next one, taxable event, section 12. So what is a taxable event under customs? Import into India or export from India is the taxable event. Am I right? So we need to understand the meaning of import. You tell me, what is the meaning of import? Bringing goods from outside India to India is known as import, and taking goods from India to outside India is known as export. Okay. So just one second, online students are asking for PDF. Okay, so those who are watching in YouTube, I instructed my team, they will share the PDF, just wait for some time, they are making it. So say this, taxable event under section 12, I told you import into India. What is the meaning of import? You tell me logically what is import. Bringing goods from outside India to India is known as import. Very good. And same way, what is the meaning of export? Taking goods from India to outside India is known as export. You can see here, taxable event under customs in case of import. Import is complete as soon as the goods enter the territorial waters. So import means what? Bringing into India from a place outside India. Same way, what is the meaning of export? Export is complete only when goods cross the territorial waters, and export means taking out of India to a place outside India. Now there is one confusion that has started, that is, there is a ship which is coming into the territorial waters and that ship did not unload the goods into India, did not unload the goods into the land. It entered the territorial waters and it went to some other country. For example, it is unloaded in Sri Lanka, but it would have entered the Indian territorial waters, possible na? So now in this case, can we call it as import into India? By definition it is yes. By definition, if you see, India is up to 12 nautical miles, then the moment the ship touches the 12 nautical miles means it is import into India, but the goods are not actually consumed in India, the goods are consumed in Sri Lanka. So Indian government should not levy customs duty on that logically, correct? So if you see definition wise, definitely it is, but if you ignore the definition and see the practicality, so definitely it should not be levied, that is customs duty should not be levied in this case. So for that reason, so there are two case laws, Supreme Court cases, these two case names you need to remember. So say this, Kiran Spinning Mills case and Garden Silk Mills case. So even if you are not remembering the case name, it is okay, but you need to remember the decision in that case, okay. So what is the decision that they are telling? Whenever the goods cross the customs barrier, then only it will be treated as import. Means as and when the ship enter into territorial waters, it is not import. As and when the goods are unloaded, it is not import. As and when the goods cross the customs barrier. Customs barrier means what? Customs control. So whenever you are trying to take the goods out of customs control, then only the taxable event will arise and only it will be called as import. Until that point of time, it is not called as import. See there. Held that import is complete only when goods cross the customs barrier. Customs barrier means what? You just write down there. Customs barrier means customs control. Customs barrier means customs control. Okay. Customs barrier means customs control. Held that import is complete only when goods cross the customs barrier. And the taxable event is the date of crossing customs barrier, but not on the day when goods landed in India or had entered the territorial waters. Is it clear? Not the day when goods are landed or it has entered into territorial waters. It is the day when goods are unloaded and you are trying to take the goods out of the customs control, then only it is treated as import. Is it clear, pa? Second case, Garden Silk Mills case, held that import of goods in India commences. Sir, you are telling only when goods cross the customs barrier, it is import. But import definition says whenever it enters into the territorial waters, it is import. So, but these two are contradictory now, sir. For that reason, another case they gave. Import commences as soon as it enters into territorial waters. See the wording, import commences as soon as it enter into the territorial waters. As soon as it enter into territorial waters, import commences. But when it is completed, only when it crosses the customs barrier. Okay. So already they gave in 1999 one case, but in 2000 they have given a clarification for that. Another case they are telling that correct only, import means as soon as it enter into the territorial waters, it commences, but it is not completed. When it will complete? Only when the importer is trying to take the goods out of the customs area. Got it? Then the taxable event is reached at the time when goods reach the customs barrier and bill of entry for home consumption is filed. So usually what is the document that is required to clear the goods from the customs? That is called as bill of entry. There are three types of bill of entry, pa. Bill of entry for home consumption, bill of entry for warehousing, and ex-bond bill of entry for home consumption. Like that, there are three types of bill of entries. Concentrate. What are the three bill of entries? Bill of entry for home consumption. Next bill of entry for warehousing, and thereafter ex-bond bill of entry. So first listen, it's already there. I'll tell you where it is. So first listen, bill of entry for home consumption. Another bill of entry is bill of entry for warehousing, also known as in-bond bill of entry. To keep the goods into the warehouse, we need to execute a bond called as in-bond bill of entry. Again, to take the goods from the warehouse, we need to file a bill of entry called as ex-bond bill of entry. Okay. So like that, we have three bill of entries. Now try to understand the purpose. First listen. So what is the purpose of bill of entry for home consumption? As soon as the goods are imported, so that will be unloaded now. When you file the bill of entry for home consumption, you in the sense importer, when you file a bill of entry for home consumption, pay the customs duty, they will release the goods and you can take those goods and go to your place. That is known as bill of entry for home consumption. Now I don't have money, but I imported the goods, but I don't have money to pay the customs duty. So now what I can do, I can file in-bond bill of entry and take the goods and keep it in the customs warehouse with payment of duty or without payment of duty. Without payment of duty, where I will keep customs warehouse. Thereafter, whenever I have money, at that time I will pay the customs duty and clear the goods from the customs warehouse. For that, I will be filing one bill of entry called as ex-bond bill of entry. Okay. So that is what they are telling. Whenever you file the bill of entry for home consumption, that is the place where taxable event is reached. Okay. So now here you can see in the next page what are the options available to the importer. Next page, page 31, below one chart is there, have a look into that. What are the options available to the importer? As soon as the goods are unloaded, where it will be unloaded? In port, okay, port or airport it is unloaded. Once it is unloaded, I told you, importer is having option 1, option 2. What is option 1? He can take it to his place. Pay duty or no need to pay duty? Pay duty. So upon payment of customs duty, he can take it to his place. What is the name of that bill of entry? Bill of entry for home consumption. Okay. And whenever he files a bill of entry for home consumption and take it out of customs area, that is a taxable event. Correct. Then next, option 2. What is option 2? The unloaded goods can be kept in the warehouse with payment of duty or without payment of duty? Without payment of duty, no need to pay duty. What is the name of the bill of entry that he need to file for that purpose? Bill of entry for warehousing, also known as in-bond bill of entry. So it will be kept in the warehouse. Thereafter, it will be cleared from the warehouse upon payment of duty or without payment of duty? Upon payment of duty. What is the type of bill of entry that he need to file for that? Ex-bond. Simple to keep in the warehouse, in. To take from the warehouse, ex. In-bond, ex-bond. Got it? So to keep the goods in warehouse, in bond. To take the goods from warehouse, ex bond. Upon payment of customs duty. So this is the stage at which the taxable event gets attracted and the customs duty liability will also be attracted. Is it clear? Now, because of this, what will happen? You see, observe carefully. When you unloaded the goods and kept the goods in the, that is unloaded the goods, at that time, the rate of duty was 10%. Carefully listen. As and when you unloaded the goods, at that time the rate was 10%. And thereafter, you cleared the goods from the warehouse. First you unloaded, kept the goods in warehouse. At that time, what is the rate? 10%. And you cleared the goods from the warehouse. At that time, it became exempted. So means government is giving exemption. Now tell me whether you need to pay customs duty or no need to pay customs duty. Hope you understood my question. At the time of import and keeping the goods in warehouse, so 10% was the rate. And thereafter, government gave exemption. Then you have cleared it to the importer's place. Government has given exemption at the time of clearance, means this time. Okay. So say you deposited in the warehouse on 1/10/2025. You cleared from the warehouse on 31/10/2025. Meanwhile, on 25th October 2025, government gave the exemption. You understood? Now tell me whether you need to pay customs duty or you are not required to pay customs duty. No need to pay customs duty because the taxable event is at the time of clearance. At the time of clearance, exempted or not exempted? Exempted. So no need to pay customs duty. Are you understanding this? Okay. Same way. At the time of import and unload, it was exempted. You kept the goods in the warehouse. Thereafter, you clear the goods from the warehouse and the exemption got withdrawn. Whether you need to pay duty or no need to pay duty? Pay duty. So at the time of clearance, whatever is the dutiable factor that you need to do. If it is dutiable, pay. If it is exempted, no need to pay. So this only I have given as one point. You read this. You read this. As clearance from warehouse is the taxable event if goods are exempted at the time of import and by the time goods are cleared from warehouse, if the exemption is withdrawn. Customs duty payable or customs duty not payable? Payable. Same way, if goods are dutiable at the time of import and before clearance from warehouse, if the goods are exempted, then customs duty payable or customs duty not payable? Customs duty not payable. Are you understanding this? Next. So come back to the conclusion. So you tell me what is the taxable event in case of import? See the previous page. What is a taxable event in case of import? What is the conclusion you need to remember? Sir, as and when goods cross the customs barrier, that is a taxable event. At that time means out of customs control. Remember this word? Out of customs control. At that time, whatever is the rate that is there, that only I need to pay. Means whether it is exempted or dutiable, at that stage only I need to see. At the time of import, etc. and all, I don't have to bother. So this conclusion you need to remember and write in exam. So what is that? Mixing up with mass of the goods in the country. Mixing up with mass of the goods in the country after crossing the customs barrier is the taxable event in case of import. Okay. Next. So students who are watching in YouTube, you can download. Our team has shared the PDF in the description. You can download, and also you can join the Telegram group also, so that if there is any extra notes etc. I am giving, I will put it in the Telegram group. Okay. Even you also. Hope you got the Telegram group and all. You join in that group, and whatever doubts you have, you can post in that group, and any extra notes etc. and all I am giving also, I will put it in that. Okay. Then coming back to this. So this case study you need to answer. Don't see the answer there. You all should participate. Okay. Concentrate. In the following situation, state the consequences under Customs Act. Situation 1. Goods cross the territorial waters. Goods cross the territorial waters means ship entered the territorial waters, but not landed in India. Not landed in India, which are to be transported to another country. Okay. Now in this case, whether there is import or no import, whether we need to pay customs duty or not required to pay customs duty. Why not required to pay customs duty? Because it has not crossed the customs barrier. Okay, that's how you need to write the explanation, because it has not crossed the customs barrier. Okay, then very good. Situation 2. Goods are imported and kept in customs warehouse, which are exported after processing. Whether you need to pay customs duty on import or no need to pay customs duty on import. No need. No need, because where the goods are? Customs warehouse. From there did we clear it for importer place, or from there itself it is exported? Means it crossed the customs barrier or not cross the customs barrier? Not cross the customs barrier. It is not coming into India. India means it should cross the customs barrier. Customs warehouse is under whose control? Customs control. It did not cross and enter into India, na? So it exported from there itself. So that's why no need to pay customs duty on import. Then another case. Goods are imported and cleared for home consumption. Cleared for home consumption means what? Cleared to importer's place. Means it crossed the customs barrier? Yes. Later it is exported after processing. So tell me whether it is import and customs duty payable? Yes. Customs duty is payable. Is it clear? Are you getting this? So first and second case, customs duty not payable because it did not cross the customs barrier. But in the third case, it crossed the customs barrier, it entered into India. So because of which we need to pay the customs duty. Got it? Now, first case, go back to the first case. Is it treated as export? Is it treated as export? No import. At least is it treated as export? No, because goods are not going from India to outside India. That's why it is not export. And second case, is it export? Yes, because it got landed in India. Correct, Appa? It got landed in India and thereafter it is going outside India. So it will be treated as export. But sir, import itself did not happen. How come it will be export? Locally manufactured goods also can be exported, na? In that category it will come. Yes, there is no import. In the second situation, if you read, there is no import, but there is export. Why there is export? Because goods did not cross the customs barrier. In the warehouse itself, we made the goods and we have exported. It is like if goods are manufactured in India and it is exported, how we will treat the same way? It is export. Third case, will it be treated as export? Yes, because it imported, crossed the custom barrier and then again it is exported. So definitely it will be treated as export. You understood? So read the answers. First situation is what? Goods cross the territorial waters but not landed in India, which are to be transported to another country. The said goods are not treated as imported into India as they did not land in India and did not cross the customs barrier. And situation 2, goods are imported and kept in customs warehouse which are exported after processing. So said goods are not treated as import into India as they did not cross the customs barrier. However, it is treated as export. Why it is treated as export? As it crossed the territorial waters. Okay. Then situation 3, goods are imported and cleared for home consumption. Later it is exported after processing. Now, so the goods are said to be imported into India and customs duty shall be payable on the same. On export of the above goods, customs duty is exempted. Got it? Customs duty is exempted. So refund of customs duty paid on import is available. So at the time of import, whatever customs duty we pay, upon export we will get the refund of that, because product imported when product imported I paid customs duty. Now this product is exported. When it is exported, the product is not in India. So whatever customs duty I paid at the time of import, I will get it as a refund. Okay. Then you understood up to this, everyone? So you just quickly look into the first page what we have seen. So page number 28. In page 28 we saw about the levy, point of payment, collection, and in the levy I told you conditions. Thereafter government, what are the exemptions, and then next page we saw India, meaning of territorial waters, customs waters that we have seen, and then taxable event in case of import that we have completed, and options available to the importer. That is the discussion we are into. Got it? Now, see, the effective preparation is only when you do the revision at frequent intervals. So we need to revise. So to the extent possible, we need to recollect whatever we have learned. Then only you can retain it for a longer time and you can be successful in exam. Okay. So very simple. The one who clear in exam will fail, those who clear in exam, they will also forget. Those who fail also will forget. Those who clear will forget after exam. Those who fail will forget before exam. As on result today, both are same. You understood? Now result would have come. You ask them any question, they will not be able to tell. For exam they remember and they are able to be successful. That's what you should do. Got it? Our target is the exam. Up to exam you should remember, you should not forget it. Okay. So when you revise it as many number of times as you can, you will be able to cope up in the exam. Got it? Then look into this, options available to the importer. So clearance for home consumption versus clearance for warehousing, and can without filing bill of entry the goods can be taken. This is goods, this is goods, this is bill of entry. Only I should file bill of entry, then only I can touch my goods. It is my goods only. But to touch it, I need to file a bill of entry. What bill of entry? Either a home consumption, either bill of entry for home consumption or warehousing, I need to file. Sir, can I touch it? Yes, I can. Until that point of time, I should not. That is the first point. Without filing bill of entry, the unloaded goods cannot be cleared for home consumption or warehousing. Until that point of time, goods will be under whose control? Control of a custodian. Who is custodian, sir? Custodian is port officer. Port officer or airport officer. Airport Authority of India is there now, which will be controlling the airport, and Port Trust of India, which will be controlling the port. They will appoint one officer called as custodian. Okay, it will be under their control. Then goods can be cleared to warehouse with payment of duty or without payment of duty. Without payment of duty, but thereafter at the time of clearance from warehouse for home consumption we need to pay. So sir, home consumption like that they are telling. So what is this home, sir? Here importer's place is called as home. You understood? Importer's place is called as home. At that time and all, they could not know how to draft that, so they gave home consumption like that. Home consumption means to importer's place when it is taken. Okay. Then when the bill of entry should be filed? Before the date of arrival. Before arrival of vessel or aircraft or vehicle, we need to file. For example, today flight is coming or today ship is coming. By when I should file bill of entry? Yesterday. By yesterday. Suppose yesterday is a holiday, then yesterday only. There is no holiday and all. For filing bill of entry, there is no holiday. 24/7 it will be working. There is a portal called as IC Gate portal. In that IC Gate portal, we will be filing the bill of entry. That is not there for your intermediate exam. In final level, you will learn the procedures, etc. and all. There you have that. Okay. So at intermediate level, you don't have, so you don't have to bother about it. Okay. So say this, bill of entry should be filed before arrival of the vessel or aircraft or vehicle, even if such day before the date of arrival is holiday, bill of entry should be filed. What will happen if I am not filing bill of entry before arrival? Say today it arrived, today I am filing bill of entry, or tomorrow I will file bill of entry, or day after tomorrow I will file bill of entry. Then what will happen? I have to pay late fee. Correct? I have to pay late fee. Late fee is attracted if bill of entry is not filed before the date of arrival. Understood, pa? Then, so just like your exam application, if you pay on time one amount, otherwise late fee is there. Correct? Beyond that, when is your exam application? Time is there. Correct? Enough time is there. Like that we will think and we will not apply. 10th will be over. Thereafter, I have not filed, then this June attempt is gone. So you will pay with late fee. That is this late fee. Got it? Some extra amount you need to pay. How much late fee, sir? Not required. Just learn that there is a late fee. How much late fee? It is not there now. Then, as customs warehouse, sir, you are telling customs warehouse. What is this customs warehouse? Is it owned by customs department? No, no, pa. It's not owned by customs department. You can also start a customs warehouse. You can also start, take one land and construct one big warehouse, and you can take a license for that. You can call it as customs warehouse. You understood? And imported goods can be kept in that warehouse without payment of customs duty. Again, it can be cleared from that warehouse upon payment of customs duty. Are you understanding this? You can also own a warehouse. So customs warehouse does not mean a warehouse belonging to customs department, but a warehouse which is owned by any person. Then what customs will do? Customs will give license, licensed by customs department to act as customs warehouse. Got it? So, sir, can importer convert his own warehouse? Warehouse means what, pa? Go down, place to store. Okay. Can he convert his own warehouse into customs warehouse so that he will keep it in his warehouse? Whenever he really wants, at that time he will take, at that time he will pay customs duty. Can he do that? Yes, he can do that. See the next point. If the importer has a warehouse for which license is obtained, then he can defer the customs duty payable. He can defer the customs duty payable till the time he uses such goods, because clearance from warehouse is only the taxable event. Understood? Next, you can see here. So this is how first the ship will come into the territorial waters. First the ship will enter the territorial waters. As soon as it enters into the territorial waters, in the ship itself there will be cranes. In the ship itself there will be crane, and that crane will take the containers and will be unloading into the vehicle. Okay, unloading into the lorry, and the lorry will take that to the importer's place. For that they need to file one bill of entry called as bill of entry for home consumption. Another way is there. What is that another way? As soon as the ship enters into the port and they will unload the goods, and they don't want to take it to their place, but they want to keep it in a warehouse. They want to keep it in a warehouse. For that purpose, they will file a bill of entry for warehousing, and they will take the goods to the warehouse, and thereafter for clearance from the warehouse, they need to file bill of entry for home consumption from warehouse called as ex-bond bill of entry. Got it? Next. So this is in-bond, this ex-bond. Okay. Point of taxation in case of import. So far what we have seen is section 12, levy. Section 15 we are discussing, that is what is the point of time at which the liability gets attracted. So first the event happened, but what should be taken as the rate? So at the time of import one rate will be there, at the time of deposit one rate will be there, at the time of clearance from warehouse one rate will be there. So which rate should be taken? That is given in section 15. Okay, relevant date for determination of rate of duty, okay. This is like our time of supply in GST. In GST there is a concept of time of supply. So whenever the transaction happens, we need to check the time of supply. At that time, whatever is the rate of GST is there, that should be taken like that. So here also what should be taken as the rate? So see there. Option 1 is what, pa? Goods imported for home consumption. So what we will do, as soon as the goods are imported, so the bill of entry for home consumption will be filed. Who will file a bill of entry? Importer. And for that ship, for that ship, one grant of entry inwards will be given. Grant of entry inwards means permission to enter. You are coming into my house. I will give a permission. May I come in, sir? Yes, come in, like that. So that is called as grant of entry inwards. Okay. So grant of entry inwards date or bill of entry date, whichever is later, not earlier, whichever is later, will be taken as a relevant date for determination of rate of duty. You can see here, date of presentation of bill of entry or date of entry inwards of the vessel, whichever is later. Okay. So usually which will be later, sir? Entry inwards only later. Yeah, because bill of entry should be filed before arrival. Correct or not? Bill of entry should be filed before arrival, and upon arrival only now you give entry inwards. So which means usually whichever is later is entry inwards. But when bill of entry will be later? If you file it late, arrival happened and thereafter you file bill of entry, then whichever is later will be bill of entry date, because of which you need to pay the late fee for delay in filing bill of entry. So date of presentation of bill of entry or date of entry inwards of the vessel. Sir, in case of aircraft and vehicle, there is no entry inwards. Vessel, there is an entry inward concept. That is, first the vessel will come. They will anchor the vessel till the time they get the permission to enter. But aircraft, where they will park? You understood? Aircraft is coming, no permission given to enter. Where will they stop that? Can we stop the aircraft there? It will fall, na? Correct? So can we take it some other place? Where to take it? So okay, sir, we will revolve there itself. Fuel will be waste. Correct? So for aircraft, there is no concept of entry inwards. You come. Aircraft can come. So therefore, in case of aircraft and vehicle, they did not give entry inwards. They gave arrival. See there. Arrival of aircraft or vehicle, whichever is later. So tell me, for vessel, what is the, you need to remember, what is the relevant date for determination of rate of duty? Come on, date of bill of entry or grant of entry inwards, whichever is later. Suppose if it is aircraft or vehicle, it will be arrival of aircraft or vehicle or bill of entry, whichever is later. Bill of entry common. Bill of entry common. In case of vessel, it is entry inwards. In case of aircraft or vehicle, it will be arrival. That's it. Okay. Then next one, goods deposited in warehouse and thereafter cleared for home consumption. This is option 2. In case of option 2, what will happen? First we will import the goods. We kept in the warehouse. Really, when we need to pay duty? At the time of depositing in warehouse or clearance from warehouse? Just now I told you. So because at the time of deposit it will be exempted, at the time of clearance it may become dutiable, we need to pay, correct? So you tell me what is the relevant date for determination of rate of duty in case of warehouse goods? Come on. Ex-bond bill of entry. Whenever you file ex-bond bill of entry means you are taking the goods from the warehouse. So see there. Date on which bill of entry for home consumption in respect of such goods is presented. That is which bill of entry? Ex-bond bill of entry. Any other goods, any other goods. Any other goods means what? Smuggled goods. So smuggled goods means illegally they will be bringing into India without any documents, etc. and all. For that smuggled goods, what will be taken as the rate? Whenever they are caught. Whenever they are caught, at that time they will be required to pay duty, na? At that time whatever is the rate, that will be taken. So date of payment of duty. Okay. For example, you would have watched one Surya's movie, Iron, like that one movie. Correct? In that movie, so he will be doing lot of smuggling and all. So different things he will be bringing into India. One time he will be caught, the diamonds and all will be caught. So like that, whenever he is caught, until that point of time no one will know. But whenever he is caught at that particular point of time, so whatever is the rate applicable, that he need to pay. Got it? Because there is no concept of entry inwards, whether he is asking permission and bringing. So there is no concept of entry inwards, there is no concept of bill of entry, nothing. That's why the date of payment of duty. Can you remember this? Now, how this will be tested? So you can see in the next page. That is a ship entered into the territorial waters on 27/2 and the duty rate was 20% at that particular point of time, and entry inwards was granted on 5/3 and the rate of duty was 20%, and this person importer filed a bill of entry. That bill of entry was filed on 15/3, the rate of duty is 10%. Now tell me, what is the relevant date for determination of rate of duty? Option 1 or option 2? Is it clearance for home consumption or warehousing? Home consumption, clearance for home consumption. There is no inbound bill of entry given na, means it is normal bill of entry. Okay, so tell me what is the relevant date for determination of rate of duty? Just read the provision and tell me. Yes, whichever is later, date of presentation of bill of entry or grant of entry inwards, whichever is later. Which is later? 15/3. As on 15/3, what is the rate? 10%. So what is the applicable rate? 10% is the applicable rate. Is it clear? And is the bill of entry filed on time or filed late? Filed late. Why filed late? When the bill of entry should have been filed before arrival itself, but he is filing it late. So because of which, whether he need to pay late fee or not? Yes. So write there somewhere, late fee payable for delay in filing bill of entry. Late fee payable. Late fee payable for delay in bill of entry. For delay in bill of entry. Next one, case 2. So the ship entered the territorial waters on 5th March and entry inwards was granted on 10th March and he filed a bill of entry, that is bill of entry for home consumption on 20th February. So tell me what is the relevant date for determination of rate of duty? 10/3, that is presentation of bill of entry or grant of entry inwards, whichever is later. Which is later? 10th March. So as on 10th March, what is the rate applicable? 20%. Whether he need to pay any late fee? No. But he need to amend the bill of entry. Why he need to amend the bill of entry? At the time when he filed the bill of entry, what was the rate? 10%. Now what is the rate? 20%. Means he need to amend bill of entry. Is it clear or not? Amend means what? Change the bill of entry. So amendment in bill of entry. Amendment in bill of entry. Amendment in bill of entry. Then look into third case. Third case, the ship entered the territorial waters on 28th February and 5th March. So they have got the entry inwards and they filed an inbound bill of entry. Inbound bill of entry is presented on 25th March. The rate of duty 10% and expand bill of entry 15th June, the rate of duty is 15%. Tell me what is the applicable rate? 15th 6, that is 15% should be taken. Why? Expand bill of entry. Any late fee? No. Any amendment bill of entry? No. Neither late fee nor amendment in bill of entry. Neither late fee nor amendment in bill of entry. Neither there is late fee nor there is amendment in bill of entry. Is it clear? Why no late fee? Because bill of entry, only normal bill of entry should be filed before the date of arrival. Normal bill of entry means which bill of entry? Inbound bill of entry. Got it? So, but here if you see, when the inbound bill of entry is presented 25th March, but after 5th March only it is presented. Okay. So neither late fee nor amendment in bill of entry. However, late fee payable for inbound bill of entry. Puridappa. That is, inbound bill of entry should be presented before the date of arrival. For that, late fee will be applicable. However, late fee payable for inbound bill of entry. Inbound bill of entry. Okay. So that is with respect to this application. And you can see previous page some important notes in respect of baggage. What is baggage? Passengers luggage. Baggage refers to passengers luggage. You can write there, baggage means passengers luggage. Baggage means passengers luggage. In respect of baggage and goods imported by post, the provisions of section 15 will not be applicable because we have separate provisions for baggage and post. So these provisions will not be applicable. Section 15 does not deal with valuation because for valuation we have a separate section, that is section 14. Date of arrival means the date of final arrival but not the first arrival. For example, one aircraft will come to Chennai, but because of the weather, climate and all in Chennai, it's like say floods, rainfall, etc. Because of which the aircraft will go to Hyderabad and thereafter it will come to Chennai at a 1 week later. Now what will be taken as the date of arrival? So the date of final arrival. See there, date of arrival means the date of final arrival but not the first arrival where the aircraft or vehicle returns immediately after first arrival. Then date of entering into contract for import is not relevant. So at the time when we enter into contract, the goods may be exempted or the goods may be dutiable, that is irrelevant. At the time when we clear the goods from the customs warehouse, that is only relevant, or customs barrier is only relevant, but the date of importation is relevant. Then you can see taxable event in case of export. So far we have seen what is a taxable event in case of import and how to determine the rate of duty in case of import. Now we are looking into taxable event in case of export. So in case of export, generally export means what? Taking goods from India to a place outside India. What is the meaning of India? Territorial waters. So as and when goods cross the territorial waters, the goods are said to be exported. Correct or not? So now in case when the goods are said to be exported, what happens? The ship started from India. Okay. The ship started from the customs, the ship started in India. This is the territorial waters. Within the territorial waters, the ship has sunk and the containers and all fell into the river. Whether these goods are said to be exported or not said to be exported, not said to be exported. KGF 2, you understood? They started ship full of gold and Rocky Bhai started the ship with full of gold and all. What happened? So in the territorial waters itself, the ship sunk and it fell na. So KGF 3 we are waiting. We need to know what will happen for that. Correct? So that's what I am talking about. The ship has sunk within the territorial waters. Is it treated as export or not treated as export? Not treated as export. So whether treated as export? No. So this is that case, Rajendra Dyeing and Printing Mills case. Export is complete only when goods cross the territorial waters of India. So if the ship sinks within the territorial waters, export is complete or not complete? Not complete. Hence duty drawback not payable. Duty drawback means it is an incentive that will not be given. Then one more case is also there. Ship crossed the territorial waters and returned due to engine trouble. Whether it crossed territorial waters? Ship crossed territorial waters and it took a U-turn and came back because of engine trouble. Whether it crossed territorial waters or not crossed territorial waters are crossed. Means export happened or has not happened? Happened. Okay. So held that export is complete once goods leave the Indian waters and property passes to purchasers. Even if goods return due to engine trouble, duty drawback is payable. So that is this. Then point of taxation in case of export. In case of export, what should be taken as the relevant date for determination of rate of duty? Like how import visa on a bill of entry date or grant of entry inwards, whichever is later. Like that for export, what should be taken? So in case of export, the relevant date is the date of let export order. As soon as the goods are handed over, so they will be giving let export order, that should be taken. In case of any other goods, smuggled goods, the date on which we pay the duty. And what should be taken as relevant date for exchange rate? Simple for remember, bill of entry. In case of import, bill of entry date. In case of exports, shipping bill date. For exchange rate means what? To convert the foreign currency into Indian rupees, we need an exchange rate now. For that exchange rate, in case of import, we need to take bill of entry date. In case of exports, we need to take shipping bill date. That will be given in the question itself. What is bill of entry date? What is shipping bill date? That should be taken. And in case of warehousing, there are two bill of entries. What are the two bill of entries? Inbound bill of entry, exbound bill of entry. Which bill of entry is relevant for exchange rate? Inbound bill of entry. At the time when you deposit the goods in warehouse, you will file inbound bill of entry. At that time, exchange rate we need to take. Exchange rate means converting into Indian rupees. And for rate of duty, for payment of custom duty, we need to take the exbound bill of entry. Okay, that is this. So you can see here, as soon as the exporter, okay, so hand over the goods to the customs officer, they will file a shipping bill. So what is this? So see this, one exporter is coming, he is bringing the goods and he will give the shipping bill for export, and when he gives the shipping bill, he will pay the duty also, payment of duty along with shipping bill to the customs office. Now customs office will tell, okay, let export order, fine, you can export now. So those goods will be order of loading and exportation. Then this crane will take the goods and put it into the ship, and the ship will leave the country. Is it clear? So this is known as the export process. So now the shipping bill date is relevant for what? Exchange rate. And this let export order date is relevant for what? Rate of duty. Is it clear? So now say this. So exported goods, the date on which he filed the shipping bill, and let export order date, whatever is the rate, 15%, that 15% should be taken. But shipping bill date is irrelevant for rate of duty. Shipping bill is only for exchange rate. Then look into the next one, whether derelict, jetsam, flotsam and wreck shall be treated as import and whether duty shall be levied. So let me check whether you have this in syllabus. So I am just showing you in your study material what are all the portion that we have discussed. So to get an idea. So first we saw the Customs Act basic concepts. Customs Act means what? Levy of customs duty, meaning of terms, baseline, exclusive economic zone, continental shelf, and Indian customs waters means what? Because I have given lot of unnecessary information, I have removed everything and to the point I have given. Okay, so that and all, if you read now you will sleep. These are all sleeping pills actually. So chargeability, section 12, and this taxable event in case of import. I told you now that garden silk mills case, etc. and all, and taxable event in case of exports. They gave definitions, and after definitions, rate of duty, articles liable to different rate of duty. Yes. So derelict, jetsam, flotsam, wreck is there, section 21. So we are discussing that. So look into this. Whether derelict, jetsam, flotsam, wreck shall be treated as import and whether duty shall be levied. You can see, as soon as the ship enters into the sea, sometimes the ship may derail. That is called as derelict. The ship may fall into the water, and sometimes the goods will be thrown out of the ship to save the ship from sinking. That is known as jetsam, jettisoned goods, like that they say, means goods which are thrown into the sea. Flotsam, those goods which are thrown into the sea will continue to float. That is called as flotsam. And wreck refers to damaged parts of the ship. All these goods, if any person is bringing, he need to pay customs duty as if goods are imported into India. Got it? Example, let's try to understand. I'll give you one story. Okay, there is one hero, and that particular hero is one roadside rowdy or pickpocketer kind of. Okay, that is the entry scene, and police are chasing him. Okay, because he has stolen something, police are chasing him, and this hero was running, and suddenly one ship he saw, and he climbed into that ship, and the ship started going, and in that ship, so heroine introduction. Heroine is a rich girl. Okay, so her family is rich, she is a rich girl, etc. and all. And what has happened? So this heroine has fell for this hero. Okay, and Titanic movie, okay, so but Indian version. And therefore what happened, then this hero and heroine, they were standing like this and happily enjoying the scenery. Suddenly one blue whale came. In the Indian version, got it? One blue whale came, and the blue whale saw hero and heroine, and the blue whale could remember its flashback. In last Janma, that blue whale fell in love with the heroine, and before proposing itself, in one accident, so that person was dead. And in this Janma, that Atma went into blue whale, and now it is born. For small housefly, one flashback it was there, you believed, correct? then this big blue whale, why won't you believe there is a flashback? So therefore, now this blue whale recollected everything. But the blue whale did not like the hero touching heroine and all. So because of which, blue whale went and hit the ship. The ship got broken into pieces. And now our hero is taking heroine in one hand and the damaged part of the ship in another hand, and he is swimming and coming. You understood? So blue whale came, climax fight, okay. Blue whale came and our hero is coming. So now hands are full. So therefore, with using his left leg, he kicked the blue whale and it crossed 200 nautical miles and it came and fall into the Chennai Marina beach. Got it? And thereafter, like how Vijay will swim and come in Sura movie, like that, our hero also came into, the beach. Now, hero is bringing three things. Heroine. Is heroine goods? No. Heroine is not goods. Ship, damaged parts of ship. Goods? Yes. Whether customs duty payable? Yes. Blue whale, imported. Okay. Whether it is goods? Yes. Customs duty payable? Yes. That is this. Okay. So, derelict, this refers to any cargo, vessel, etc. abandoned in the sea with no hope of recovery. Jetsam, this refers to goods jettisoned from the vessel to save her from sinking. Save her, whom? Ship. Ship or feminine gender they gave. Got it? Her, like that. Okay. So then flotsam. Flotsam refers to jettisoned goods which continue floating in the sea are called as flotsam. Okay. So sir, container when it is thrown into the sea, why will it float, sir? Container will be heavy na, sir. Kambi kattra kadalla solranga, sir. Got it? At that time when the Customs Act was created, container was not there. It was boxes, wooden boxes. So wooden boxes, when you throw into the water, it will float. Okay. Today it is irrelevant. And so wreck refers to cargo or vessel or any property which are cast ashore by the tides after shipwreck. As per section 21, all goods, derelict, jetsam, flotsam and wreck brought or coming into India shall be dealt with as if they were imported into India unless it is shown to the satisfaction of the proper officer that they are entitled to be admitted duty free. Means unless exempted, we need to pay customs duty. Sir, suppose if the person don't want to pay customs duty, hand over the goods to government. Our hero, he don't want to pay customs duty means hand over everything except heroine to the government. So he can go happily with heroine. You understood or not? So that is what it is. So what is the difference between jetsam versus flotsam? Jetsam means thrown into the sea. Flotsam means which will continue to float, is known as flotsam. Then next, some important definitions under customs. You can see section 2 clause 22, meaning of goods. Goods includes what? Vessels, aircraft, stores, baggage, currency and negotiable instruments. So this is the meaning of goods. Vessels, aircrafts and vehicles, stores, baggage. Vessel means you can understand. Sir, vessel itself is goods? Yes. A vessel which is bringing goods is also goods. An aircraft which is bringing goods is also goods. A vehicle which is bringing goods is also goods. Then stores. Stores refers to goods which are in the ship or in the aircraft. What are the goods which are in the ship and in the aircraft for consumption? Water, beverages, food, consumables, fuel, spare parts, life-saving jackets. These are all called as stores. Okay. Then baggage. Baggage refers to passengers' luggage. Currency and negotiable instruments is also goods. However, in GST, money definition, so like goods definition and service definition both excludes money. So money is neither goods nor services. So therefore, on import of money, we need to pay customs duty, but we don't have to pay any GST. That's what I have given. These are not treated as goods under GST. Consequently, IGST not payable on import of currency and any other kind of movable property. Then import duty is levied on almost all items, where export duty is levied only on few limited products. Yes, that's true. So on all goods, import duty will be payable, imported. But exports, India encourages exports. So we don't have to pay customs duty on all exports. Only on imports only customs duty payable. All exports are not leviable to customs duty. Only few exports we need to pay customs duty. Remaining we don't have to pay customs duty. Like scarce goods will be there na, rice. on rice exports, customs duty is there because rice is required in India. So because we are having that as our staple food, daily we are living on that. So therefore, if rice is exported, we will not agree. So for that, customs duty will be there like that. So whenever some goods are in commanding position in India, on that only export duty is levied. Then drawings and designs, even though intangible, are treated as goods under customs. Drawings and designs means what? Blueprint or drawing, artwork, etc. If it is imported in soft copy, no problem, it is not treated as goods. But if it is imported in hard copy like paper form, then it will be treated as goods and we need to pay customs duty on the same. Okay, that is this Associated Cement Company's case. Then dutiable goods, already I told you what is the meaning of dutiable goods. Those goods which are covered under Customs Tariff Act 1975 is known as dutiable goods. Means any goods which are chargeable to duty, on which duty has not been paid. Duty has not been paid, that's what. Duty not yet paid. Once you pay duty, it will become duty paid goods. English by English, dutiable versus duty paid. Dutiable means you have to pay but not yet paid. Duty paid means you have paid. See there, upon payment of duty, it will become duty paid goods. Okay. Now say this, goods are divided into two, covered under Customs Tariff Act, not covered under Customs Tariff Act. Not covered under Customs Tariff Act, which is not leviable to duty, all called as non-dutiable goods. Which are covered under Customs Tariff Act, again divided into two, chargeable to duty, exempted. So exempted also dutiable goods, chargeable to customs duty is also coming under dutiable goods. The moment it is covered under Customs Tariff Act, it will be called as dutiable goods. Next, look into imported goods. You tell me what is imported goods. Already you told me, goods brought from outside India to India. So the warehoused goods are also imported goods till the time they are cleared for home consumption. Now say this, from high seas, as soon as the ship enters, then that goods will be called as imported goods. Then who is importer? Importer means the owner of the goods. Underline that. Importer means the owner, beneficial owner, or any person holding himself out to be importer. For example, you are importing, you are the owner, so importer. You are the owner, but I am importing on behalf of you, so you are the beneficial owner and I am holding myself as importer. Why you could not import? Because you don't have the contacts there. For example, you want to import from China, you don't have the contacts, I have the contacts. I know how to take the permission and import it. So you authorize me to import, but you are the beneficial owner, means you are only going to make the payment. I am just importing on your behalf. I will also be called as importer, you will also be called as importer. Okay, you understood this? Read it once again. Importer in relation to any goods at any time before their importation and the time when they are cleared for home consumption includes any owner, beneficial owner, or any person holding himself out to be importer. Okay, then so logically any person who files a bill of entry will be called as importer. Okay, next, export goods. Export goods means what? Goods which are taken from India to outside India. To be taken is export goods, already taken is known as exported goods. Be careful when they are asking the definition, you be careful what to write. Export goods means goods which are taken out of India to a place outside India. Export versus exported goods. Export means to be taken but not yet taken, but once you have already taken, then it will be called as exported goods. Exporter also same definition pa. Owner, then beneficial owner or person holding himself to be exporter. For example, I am the owner of the goods, I am manufacturing and I am exporting, I am owner exporter. I am manufacturing and you are exporting, so I am called as supporting manufacturer, beneficial owner, and you are exporting on my behalf, so you will be called as merchant exporter. Is it clear? Actually this definition is same as importer na. Importer also owner, beneficial owner, or any person holding himself to be importer. Same way owner, exporter also owner, beneficial owner, or any person holding himself to be exporter. Then see the next one, relevant date for determination of rate of duty and exchange rate. What should be taken as the relevant date for rate of duty? Option number 1, if it is import cleared for home consumption, option 2 cleared for warehousing. So what is a taxable event in case of import? Date of crossing customs barrier. So these two case names you try to remember now. So date of crossing customs barrier is the meaning of taxable event, import. So you remember like this. There is a garden. In that garden there is one person by name Kiran. What is the person name? Kiran. Where is he? Garden. Whenever Kiran comes out of the garden, it is treated as import. Okay. So what is the case name? Kiran spinning mills, garden silk mills, date of crossing customs barrier is import. Is it clear, pa? Clear? So Kiran spinning mills, garden silk mills, date of crossing customs barrier is import. Kiran playing in garden, whenever Kiran comes out of the garden, it is import. Okay. So Kiran spinning mills case, garden silk mills case, whenever he crosses the customs barrier, it is treated as import. Okay. Opportunity we only should create to write in the exam. Got it? Whenever they are giving something related to import, you write like this. You learn this na, you write, so that your answer sheet will be separate from others. You got it? Then what is the meaning of export? Date of crossing territorial waters. For this also two case laws name is there. You remember this. Sun rises in the east and sets in the west. Correct? That is sun exports case. Going, coming back. You got it? Sun rises in the east and sets in the west. So ship goes, return due to engine trouble. That case. Then Rajendra dying, ship sinking. You got it? Ship sinking, Rajendra dying. Okay. So which case? Rajendra dying and printing mills case. The ship has sunk within the territorial waters. Say this. Rajendra dying and printing mills and sun exports case. So date of crossing the territorial waters is treated as export. Then relevant date for determination of rate of duty. This already we discussed just now. It is just a summary part. This is actually summary of our discussion. So if it is vessel, date of presentation of bill of entry or grant of entry inwards, whichever is later. Aircraft or vehicle, date of presentation of bill of entry or arrival, whichever is later. In case of warehousing, date of presentation of export bill of entry. For export, what is the relevant date? Date of let export order. For exchange rate, in case of option 1, whenever you file the bill of entry. In case of option 2, date of presentation of inbound bill of entry. Which bond? Which one? Bill of entry for warehousing. In case of export, date on which you present the shipping bill or bill of export, that should be taken. Exchange rate as determined by whom? So RBI, CBIC, whose exchange rate should be taken? CBIC exchange rate should be taken. In case of improper imports or improper exports, relevant date is the date of payment of duty. Got it? So this is about the basic concepts. One second, I'll just open your study material. Fine. So here you can see reimportation 21. Yes, we have exemptions related provisions also, and that exemption related provisions also we need to discuss. Okay, so that is also here, and then we will see the MCQs for that. Okay, now look into this. The next chapter is about exemptions, but I don't want to put lot of information theory. Let's do some practicality of it, and then we will come back to exemptions. Is it okay? Because otherwise you will sleep and all. So I'm just skipping this chapter and moving on to classification of goods and types of customs duty. Various customs duties payable. So we completed taxable event. Exemptions we have not yet discussed, that we will see little later. Now we are moving on to classification of goods and types of customs duty. So kindly open your notebook and let's try to write down the format, how to compute the customs duty payable. Okay. So write down computation of, give a side heading or heading, computation of customs duty payable. Computation of customs duty, computation of customs duty payable. So let's take assessable value. Assessable value means the value on which we need to pay customs duty is known as assessable value. So first we need to do the valuation and then only we will do the customs duty computation. So assume that we know the assessable value. So what is the assessable value? The assessable value is say 1,50,000. 1,50,000 is the assessable value. Now total we need to do the customs duty computation in 3 parts. Part 1, total 9 customs duties we have, total 9. We will do it in 3 parts. First part is basic customs duty. Basic customs duty at the rate of, the rate will be given in the question itself. You don't have to remember the rate. Suppose if nothing is given, then you take 10%, but 100% of the cases it will be given in the question itself. Okay. So let's take 10%. 10% on what? On assessable value. So what is the assessable value? 1,50,000 into 10%, that will be 15,000. Okay. This is basic customs duty. Number 2, what is BCD means? Basic customs duty. Number 2, SWS. SWS means social welfare surcharge. What is the rate at which we need to pay social welfare surcharge? That is always 10%. Always, it will not be given. You have to remember, always it will be 10%. 10% of what? 10% on basic customs duty. What is basic customs duty? 15,000. 15,000 into 10%, that will come to 1,500. That is social welfare surcharge. And number 3, there is something called as CVD. What is CVD? Countervailing duty. Countervailing duty. This is at what rate? This is given in the question. This is at the rate given in the question. On what we need to compute? On assessable value plus basic customs duty plus social welfare surcharge. What we are trying to do now is we are preparing a format, we are preparing a template, so that any question that you get related to computation of customs duty, you need to fit into that template and arrive at the answer. The format we are learning. Okay. So first basic customs duty, that will be given on assessable value. For example, the assessable value is 1,50,000. On that 1,50,000, 10% is 15,000, and then social welfare surcharge at the rate of 10% of basic customs duty. Basic customs duty 15,000 into 10%, that is 1,500. Countervailing duty, that will be given in the question on what? On assessable value, basic customs duty, social welfare surcharge, and it is applicable on which cases? What are the goods for which this will be applicable? Okay. So say this. This will be applicable in case of CVD is there na, applicable to. CVD is applicable to. What are the goods for which CVD will be applicable to? You tell me, what are the goods on which we have to pay excise duty, central excise duty or state excise duty? Even today, after implementation of GST, there are some goods on which we need to pay excise duty. What are they? Alcoholic liquor for human consumption. Very good. So alcoholic liquor for human consumption. Alcoholic liquor. So on import, are we importing liquor? Yes. A number of brands, Jack Daniels, Antiquity, Old Monk, Napoleon. These are all some brands which are being imported. Okay. Alcoholic liquor for human consumption. Not that I am consuming and all here. I am just giving you examples. Alcoholic liquor for human consumption. Number 2, petroleum products. Petroleum products. Are we importing petroleum products? Yes. So on import of petroleum products also we need to pay CVD. Then we have tobacco and tobacco products, on that also we need to pay excise duty. These are the three goods on which excise duty we need to pay today, even though there is GST. Even though there is GST, we need to pay. So what is that? Tobacco and tobacco products. Tobacco and tobacco products. Alcoholic liquor for human consumption, petroleum products, tobacco and tobacco products, for these three. And in the present case, we have not imported that, so that's why we are not taking. If you do the total of this, this will be called as customs duties excluding additional customs duties. Excluding additional customs duties. So what is that? 15,000 plus 1,500 will be 16,500. This is part 1 pa. This is part 1. This is part 1. So in part 1 there are 3 customs duties. What are they? Basic customs duty, social welfare surcharge, CVD. Basic customs duty on all goods. At what rate? That will be given in the question itself, and it will be computed on assessable value. Then social welfare surcharge, at what rate? Always 10%. 10% of what? Basic customs duty. Then CVD at the rate that will be given if it is there. What are the goods for which CVD is applicable? If you are importing alcoholic liquor for human consumption, petroleum products, tobacco and tobacco products, and the total of this is customs duty excluding additional customs duties. Then we have 3 additional customs duties. So number 4, safeguard duty. Safeguard duty. Number 5, anti-subsidy duty. Anti-subsidy duty. ANTI, not AUNTY. ANTI, anti-subsidy duty. Okay. So don't write anti and all in exam. Then anti-dumping duty. Anti-dumping duty. So these are the 3 additional customs duties that we have. So when it is levied, etc. and all, we will be learning. We are just trying to understand the template first. So safeguard duty, then anti-subsidy duty, anti-dumping duty. In short form, SD, ASD, ADD. Okay. Then if you do the total of this, that will be called as customs duties excluding IGST and compensation cess. Customs duty excluding IGST and compensation cess. Okay, that is 16,500 only, because we don't have any additional customs duties. This is part 2. Safeguard duty, anti-subsidy duty, anti-dumping duty, customs duties excluding IGST and compensation cess, 16,500. And thereafter we have 3 more. Number 7, that is IGST. Sir, on import are we required to pay IGST? Yes, on import we are required to pay IGST, and that IGST will be payable at the rate of, so that will be given in the question. So why we need to pay IGST? Because in the past we had CVD and SAD, that CVD and SAD got subsumed into GST. So because CVD was to counterbalance excise duty, SAD is to counterbalance sales tax, and excise duty is now part of GST and sales tax is now part of GST. Due to that reason, in the place of CVD and SAD we have IGST. So IGST, that will be given in the question. Let's take 12% on what? On assessable value plus part 2 total. Okay, assessable value plus part 2 total, that should be taken. What is assessable value plus part 2 total means? That is 1,50,000 plus 16,500 into 12%. So please do how much it comes to? 1,50,000 plus 16,500 into 12%, that is 19,980. Then we need to take compensation cess. Compensation cess at what rate? Same, at the rate given in the question, and it should be computed on what? Same, assessable value plus step 2 total, that should be taken, and here we don't have compensations in the question, so we don't have to do, otherwise we need to take. Then next, ninth one is SAD, called as special additional duty. What is SAD? Special additional duty. Again, it is at what rate? At the given rate. It will be given in the question itself. On what? Same, assessable value plus step 2 total. And this SAD is applicable in which case? Only one product for which SAD will be applicable. So it is applicable to petroleum products. Only for petroleum products this SAD will be applicable. For other goods SAD will not be applicable. So whenever there is IGST compensation says, SAD will not come, because we don't have GST on petroleum products due to that reason. Now if you do the total of this, that is called as total customs duties payable. Total customs duties payable. So this is the way in which you need to compute the customs duty. So 16,500 plus 19,980, that is 36,480 will be total customs duty payable. This will be called as step 3 or block 3, okay, part 3. So total we have to do the computation of customs duty payable in 3 parts, okay. So 3 parts. In that 3 parts, in first part we will be having basic customs duty, social welfare surcharge, CVD, and next we have safeguard duty, anti-subsidy duty, anti-dumping duty. Finally we have IGST at 12%, compensation cess and special additional duty. Got it? So this total will be the total customs duty payable, total 9. Are you understanding this? You have to by heart this template, and any question that you get, you need to just put into this template and arrive at the answer. Is it clear? Now, sir, we are not able to get the PDF. Already it is there in the description. You check. There is one Google Drive. In that Google Drive it is available. Just click on that Google Drive and you can see that. Okay. So now have a look into this. What are the various customs duties payable? In that various customs duties payable, we have basic customs duty. That basic customs duty, I told you we have standard rate or preferential rate is also there. Standard rate means usual rate, preferential rate means some countries when we are importing we get a preferential rate, and usually it will be 10% on assessable value, but usually that will be given in the question, don't worry. Then social welfare surcharge. Social welfare surcharge is always 10% on basic customs duty. So suppose if the basic customs duty is nil, then social welfare surcharge is also nil. Previously we had education cess and secondary and higher education cess, which is not there now. Then protective duty. Protective duty, so just mark there, protective duty is omitted. So they have omitted the protective duty. Now it is not there. So that's a Finance Act 2024 amendment. So that's a Finance Act 2024 amendment. This protective duty is not there. This is omitted. Previously it was there, but now they have omitted. Okay. Finance Act 2024, it is omitted. So we don't have to remember this protective duty. Then next, safeguard duty. So when safeguard duty will be levied? It is levied when goods are imported in large quantities. So can you give me an example of product which is imported in large quantities? Smartphones. Smartphones are imported now in large quantities. Whether we have domestic manufacturers of smartphones? Yes. What is that? Redmi, Xiaomi. Xiaomi is a domestic manufacturer, and we have one or two like that. But majorly if you see Samsung and Apple, then other brands only people are using, correct? So that is being imported into India. So when goods are imported in large quantities, whether the domestic industry gets affected or not? Yes. To protect the domestic industry, they will be levying the safeguard duty. Thereby, even imports are at a cheaper rate, I mean imports are in large quantities, when we increase the rate of that import by adding more duties, so definitely discourage. Now people will be discouraged to import, rather than they will go for locally manufactured. Locally manufactured is say 100 rupees and imported is 150 rupees. Which will you prefer? Local manufacture. If locally manufactured is 100 and the imported one is 80, definitely you will go for 80. So to increase the rate, so that the import cost should increase, they are bringing in the safeguard duty. It is levied when goods are imported in large quantities. It is added after computing social welfare surcharge. That's why I told you the safeguard duty will be added after adding all these things. Then next one, we have countervailing duty under section 9. This countervailing duty under section 9 is only known as anti-subsidy duty. This is only called as anti-subsidy duty. Anti-subsidy duty. Okay. When this anti-subsidy duty is levied, it is levied on import of subsidized articles. So whenever you are importing subsidized articles, means what? Example, China. China will give lot of subsidy to their manufacturers. That's the reason why they will be able to sell to India at a cheaper rate. Is it clear? So now in this case, when the product is being imported, because have you ever wondered, lot of Chinese goods and all are available at a cheaper rate. Example, toys. Chinese toys, if you see, very cheaper it is available. So how they will be able to manufacture at that cheaper rate? Because China government will be giving them a subsidy. This is called as trade war. China is doing trade war with many countries. What they do? They give subsidies to their manufacturers, because of which they will be selling to India at a cheaper rate. When the product is being sold to India at a cheaper rate, so definitely, people in India will be preferring that goods only. So naturally, domestic manufacturer will die. So then Chinese goods only will be there in India. Then tomorrow they will increase the rate. Then we are forced to buy at a higher rate. Is it clear? So that is called as the trade war which they are doing. So to counter the trade war, what we are doing on imported goods from China which enjoys the subsidy, we will add the customs duty and increase it, so that we make these goods ineffective. Got it? So countervailing duty or anti-subsidy duty, it is levied on import of subsidized articles. It is added after computing social welfare surcharge. That's why we are adding this anti-subsidy duty. Then there is something called as anti-dumping duty under section 9A. Now this anti-dumping duty means what? So people, that is exporter outside India, is dumping their goods to India. So when is it called as dumping? You would have studied marginal costing. You studied or not studied? Studied. And in marginal costing there is one point. Accept the order. Accept or reject decisions are there. In that accept or reject decisions, will take the decision of accepting if the contribution is positive. Correct? Contribution positive, accept. What is contribution positive? Selling price minus variable cost. Even if the fixed cost is not recovered, you accept, like that it will say. Correct? Which means in case of export orders, if you are getting some recovery towards your fixed cost also, it is okay, you accept. Same marginal costing they will also learn. Correct? Not only VPA, exporter outside India also will learn marginal costing. So they will export to us less than their selling price. They will export just to recover their variable cost, because they made in large scale, economies of large scale production. They make, for example, installed capacity is 100%, means they would be doing production capacity 80%. Anyhow 20% is unutilized capacity. If they make also, the fixed cost is going to be the same. Correct? For that reason, they make that extra 20% and dump it to India. That is called as dumping. Means they are selling to India at a price less than their selling price. Whose selling price? Exporter selling price. Because of which Indian industry gets affected. Correct or not? To counter that only, they are bringing this anti-dumping duty. It is levied when goods are imported at a price less than its price in exporting country, and it is added after computing social welfare surcharge. You can see anti-dumping duty. Got it? Anti-dumping duty. So next one. So we have IGST. IGST is at what rate? So at the given rate in force on what? Assessable value plus all customs duties. GST compensations is also same, assessable value plus all customs duties. Next, look into this position of goods under customs post implementation of GST. This has got a connection to GST and customs. See this. Whenever you are importing alcoholic liquor for human consumption, okay, you need to pay, I told you, CVD. Now, locally when we sell alcoholic liquor for human consumption, are we required to pay GST? No. For the purpose of GST, there are two non-taxable supplies. What are the two non-taxable supplies? Alcoholic liquor for human consumption and petroleum products are non-taxable supplies under GST, means we don't have GST on that. So on alcoholic liquor for human consumption, today we need to pay excise duty, CST or VAT on domestic. Suppose if you are import, you need to pay only CVD. Same way on petroleum products, so that is crude oil, petrol, diesel. What are the 5 petroleum products? Crude oil, crude oil, then next high speed diesel, then petrol, then natural gas. ATF means aviation turbine fuel. On these petroleum products, today we are paying excise duty, CST, VAT. So on import we need to pay CVD and SAD. Then on tobacco and tobacco products, we are paying excise duty as well as GST. So that's why on import we need to pay CVD and IGST. On all other goods we have to pay only GST on local sale. So on import we need to pay IGST. Now from this table, tell me what are the 3 goods for which CVD is applicable. What are the 3 goods for which CVD is applicable? CVD, 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 CVD. Alcoholic liquor for human consumption, petroleum products, tobacco and tobacco products. That's what I have given. Alcoholic liquor for human consumption, petroleum products, tobacco and tobacco products. Then what are the goods for which SAD will be applicable? Only one. What is that one for which SAD is applicable? Petroleum products, correct? So that's what I have given here. Petroleum products only SAD will be applicable. You got it? Then what is the procedure for computation of customs duty? Already we discussed this. So we have to do this case study 1. So up to this you got the understanding. So what we have completed in the last 2 hours. So we took this taxable event under customs and we completed that, and then we discussed types of customs duty, how to compute the customs duty payable. So we'll take a small break and thereafter we will continue with this case study and other aspects. Got it? Yes. And the class will be like this: 2 hours, 1 break, 2 hours, lunch break, again afternoon 2 hours, 1 break, then next. Okay. So that's how the class will be daily basis. Thank you. And online students, if you have any doubt, you can put it in the comments. Okay, we'll start. See this case study 1. So please close your book for some time and just open your notebook. Just open your notebook. This book is not required. Look into the screen. Case study 1. Particulars. Product imported is whiskey. When whiskey is imported, it's an alcoholic liquor for human consumption. Assessable value is 1,50,000. Basic customs duty 10%, social for surcharge 10%, IGST not applicable. Why IGST not applicable? Because on import of alcoholic liquor for human consumption there is no GST. Then, but CVD will be applicable, SAD is not there, GST compensation cess is also not there. I want you to work out for whiskey and tell me what is the customs duty payable. Just fit into the template and we will do. So for whiskey alone I will calculate, remaining you should try. Correct? Done? Come on, start. So in case of that product imported is whiskey, what is the assessable value given? 1,50,000. Correct? So whiskey assessable value is 1,50,000. What is the first thing that we will take? What is the first thing that we will take? Basic customs duty at the rate of 10%. What is the basic customs duty? 10%, 15,000. Social welfare surcharge will always be at the rate of 10% of 15,000, that is 1,500. What else we have? Whether we have CVD? Yes. CVD is at what rate? 18%. So CVD is computed on what? CVD at the rate of 18%. On what? On what? This is basic customs duty on assessable value, social welfare surcharge on BCD, CVD on what? Assessable value plus basic customs duty plus social welfare surcharge. Check the template. So whenever you are computing, this basic customs duty, assessable value, and we need to take social welfare surcharge, that's how we compute CVD. You see this, CVD will be computed on assessable value, basic customs duty and social welfare surcharge. So therefore, what is the assessable value? 1,50,000 plus basic customs duty 15,000 plus social welfare surcharge 1,500. So 1,50,000 plus 15,000 plus 1,500, that comes to 1,66,500 into 18%. What is 29,970? 29,970. And if you add this, it is customs duties excluding additional customs duties. So don't add assessable value. So only customs duties you need to take. 29,970 plus 1,500 plus 15,000. That will come to 46,470. This will be the customs duties. Customs duties, okay, excluding additional customs duties as well as total customs duty also same. Am I right? Excluding additional customs duties, and finally even after adding everything else also, it will be 46,470 is the total customs duty payable. I mean IGST, GST, compensations, etc. and all we don't have. So total customs duty payable 46,470. You got this? Now try the next one. What is the next one? Cigarettes. For cigarettes, assessable value 1,50,000. Basic customs duty 10%, social welfare surcharge 10%, IGST will be 18%, and CVD is 12.5% because we have CVD and GST compensations. Because tobacco and tobacco products are so special that we need to pay GST as well as additional customs duties, excise duty also. So additional customs duty, CVD also payable. Except SAD, everything else is there. Come on, try. Just stick on to the format. Whatever is the format, just follow that. You will get the answer. Finished? You got a number? Okay, cross check. So what is the product that we have? Cigarettes. So with respect to cigarettes, so what is the assessable value? Same 1,50,000, no change in that. And then we need to take basic customs duty 15,000, social welfare surcharge 1,500, CVD we have on cigarettes, yes. What is the rate? 12.5%. So 12.5% we need to take. So 12.5% means it is on what? Same 1,50,000 plus 15,000 plus 1,500 into 12.5%, that is 20,812.50. Now you do the total of this. So 15,000 plus 1,500 plus this 37,312.50. Now in order to get the answer as per the guideline answer, that is suggested answer, you should not round off here. Last number you will get, that alone you round off, then only your answer will match. Okay. So now we have IGST. So what is the IGST? IGST at what rate? You can see there, IGST at the rate of 18%. At the rate of 18% on what? On assessable value plus all customs duties. That is assessable value plus customs duties. That is customs duties. What is that assessable value plus customs duties? Assessable value 1,50,000 plus customs duty up to this is 37,312.5 into, so 18%. We don't have safeguard duty, anti-dumping duty and anti-subsidy duty. That's why we have not taken. Otherwise we will take that. So 33,716.25. And then compensation cess. Compensation cess at what rate? Please check the question. Compensation cess at 12%. This will be computed on what? Same it will be computed on assessable value plus customs duty. So that is assessable value 1,50,000 plus customs duty 37,312.5 into 12%, that comes to 22,477.50. We don't have anything else, everything we have taken. You check the question once again. Basic customs duty we have taken, social welfare surcharge we have taken, IGST we have taken, CVD and GST compensations as also we have taken. Now you do the total of this. 37,312.5 already we got. Now 33,716.25 and then 22,477.5. So that will come to 93,506.25. So 93,506.25 we are ignoring because we need to round it off to nearest 1 rupee. Whether you got this 93,506 as the answer, everyone. So good. Next one. So try this. Aviation turbine fuel. For aviation turbine fuel, assessable value 1,50,000, basic customs duty 10%, social for surcharge 10%, only CVD and SAD is also there. CVD already you know how to do, SAD is 4%. Come on, try. Yes, done. Simple only, already you did this. Aviation turbine fuel, say this, ATF, aviation turbine fuel, assessable value 1,50,000, no change, and basic customs duty 15,000, no change, 1,500 social welfare surcharge, CVD at what rate? 12.5 only, so same amount, 20,812.50, so that is 37,312.50. There is no IGST, there is no compensation cess, there is only SAD. SAD at what rate? SAD at the rate of 4% on assessable value plus customs duty. So SAD we don't have in the first two places, last place only we have. What is assessable value? 1,50,000 plus 37,312.5 into 4%, that will be 7,492.50. Now you do the total of this. 37,312.5 plus 7,492.5, 44,805. You got it? Then last one is machinery. Machinery. So what is the answer that you got? Yes. So in this case, for machinery, what is the answer that you have got? First, for machinery, we need to take 1,50,000, 1,50,000, and after that 1,50,000, basic customs duty 15,000, social fare surcharge 1,500, and CVD. So we have any CVD? No, there is no CVD. So that will come to 16,500. And we have only GST, that is 12%. So 12% means, so we need to take 12% of what? Assessable value, 1,50,000 plus 16,500 into 12%, 19,980. And then compensation says SAD and all we don't have. Now you do the total, that is 16,500 plus 19,980, 36,480. So this will be the total customs duty payable. Okay, 46,470, 93,506, 44,805, and 36,480. So this is how we need to do the computation of customs duty. Like any of these four models we may get. So depending upon whichever is question asked, you should be able to arrive. You understood this or not? Computation. Now we are moving on to manner of computing value in case of warehoused goods. So whenever we imported the goods, we deposited the goods in warehouse. Thereafter, we do the clearance of these warehoused goods. When we do the clearance of these warehoused goods, we will pay the customs duty normally. But sometimes it so happens that we transfer the document of title to some other person. I'll try to explain this, what happens in this case. So just listen, you don't have to make note of this, just listen. That is, first what will happen in the customs port or customs airport? So the goods will be unloaded. So unloaded goods, we will be taking it to warehouse. So who imported these goods? Say Mr. A has imported these goods. This Mr. A, what he will do? These unloaded goods will be kept in the warehouse. So which warehouse? Customs warehouse. Should this customs warehouse be near to port or airport? No, it can be anywhere. For example, port is in Chennai and the customs warehouse can be in Madurai. So anywhere the customs warehouse can be, not necessarily that warehouse should be attached to port or airport, it can be anywhere. So unloaded goods is deposited in the customs warehouse with payment of duty or without payment of duty? Without payment of duty, without payment of duty. And thereafter this customs warehouse is giving a warehouse receipt to Mr. A. Customs warehouse is giving a warehouse receipt to Mr. A. What is the price at which these goods are imported? Okay, so basically these are imported goods and the price at which these goods are imported at say $10,000. These goods are imported at $10,000. Carefully listen, goods are imported for $10,000 and these are unloaded in the port or airport and it is sent to customs warehouse without payment of customs duty, for which customs warehouse gives a warehouse receipt to Mr. A. Up to this clear. Now there is another person, that another person is Mr. B. So what Mr. B is doing? So Mr. B wanted these goods. Mr. B wanted these goods. Okay, for that purpose, so he approached Mr. A to sell the goods to Mr. B. Now what Mr. A is telling, see boss, I have to pay the customs duty anyhow, so I don't want to pay the customs duty, you only pay the customs duty and take these goods. Okay, so therefore sale of warehouse receipt, sale of warehouse receipt. Now who is the owner of the goods? Mr. B. Now Mr. B, for doing this, anyhow Mr. A should pay the customs duty na. Now Mr. B will pay customs duty, and what is the value at which these goods are sold? Say $11,000. This $1,000 is the profit of Mr. A. Now who will file the bill of entry with the customs warehouse? Which bill of entry needs to be filed? Ex-bond bill of entry. Who will file ex-bond bill of entry with the customs warehouse? Mr. B will file the ex-bond bill of entry. Okay, ex-bond bill of entry. Ex-bond bill of entry they need to file. And how much will be taken as the assessable value for payment of customs duty? Now who will be paying customs duty? Mr. B will be paying customs duty. Are you understanding up to this? He will be filing the bill of entry and will pay customs duty. So customs duty will be payable. So what is the rate at which customs duty will be payable, and how much should be taken as the assessable value? See, assessable value will be simple. Assessable value will be the original import price. What is the price at which originally it is imported? $10,000. That $10,000 will be taken as the assessable value. Is that clear? And let's multiply this assessable value with, say, some exchange rate of 80 rupees per dollar. So that will come to rupees 8 lakhs. Understood up to this? Okay. Again I am repeating, carefully listen. First we are importing the goods. So whatever I am writing in this I will share with you in the Telegram group. On a daily basis whatever notes I am writing, I will share in the Telegram group so that you can see that. Suppose in case you have not written anything also, this will be there. Okay, don't worry. So imported goods for $10,000. These are unloaded. It is cleared to customs warehouse without payment of customs duty, and customs warehouse gave a warehouse receipt to Mr. A. And what happened? Mr. B wanted to buy these goods, so A transferred the warehouse receipt to Mr. B, for which Mr. B paid $11,000. Now Mr. B will file the ex-bond bill of entry and will pay customs duty. So while paying the customs duty, what should be taken as the assessable value? This $10,000 will be taken as the assessable value. On that into 80, 8 lakhs. Got it? But he need to do the computation of customs duty. Let's assume the basic customs duty as 10%. Okay, so this is assessable value we got. Now basic customs duty at the rate of 10%. 10% on what? 10% on assessable value. 8 lakhs into 10% is what? 80,000. Then social welfare surcharge at the rate of 10% on what? Basic customs duty. What is the basic customs duty? 80,000. 80,000 into 10% will be 8,000. So social welfare surcharge will be 8,000. Got it? And thereafter we need to compute CVD. CVD we don't have. IGST we need to compute. Usually what we will take for IGST? Suppose if the IGST is at 18%, how we will do the computation of IGST? Assessable value plus all customs duties. Correct? Now it is warehoused goods which is sold by way of transfer of documents to title. For this a special process there. Please concentrate. Up to this it is normal. Now only there is a change. So IGST will be at the rate of 18% on what? A. Regular. What is regular? Assessable value plus basic customs duty plus social welfare surcharge. Okay. So what is this? Assessable value plus basic customs duty plus social welfare surcharge? 8,88,000 or B. Transaction value of sale. What is the price at which it is sold? $11,000, but that $11,000 you convert into Indian rupees. Let's take 80 rupees per dollar. That will come to 8,80,000, whichever is higher. Whichever is higher. You understood, Appa? So how much should be taken as IGST? The regular way. What is that regular way? Normal assessable value plus total customs duties, or the price at which these warehoused goods are sold. The price at which these warehoused goods are sold. What is the price at which these warehoused goods are sold? $11,000 into 80 rupees per dollar, that is 8,80,000, whichever is higher. Which is higher? 8,88,000 will be higher into 18%. That will come to 1,59,840. You got it? 1,59,840. Now you do the total of this. That will be the total customs duties payable. So what is the total customs duties payable? 80,000 plus 8,000 plus 1,59,840. That is 2,47,840. Understood? So tell me, what is the treatment? How to take IGST on warehoused goods? the original value. What is the original way? Original way, that is assessable value plus all customs duties, or the price at which these warehoused goods are sold, whichever is higher. Okay. So now that is this point. Manner of computing value in case of warehoused goods. So that is given in section 3 clause 8a, where the goods deposited in warehouse under the provisions of Customs Act are sold to any person before clearance for home consumption or export under the said act. The value of such goods for the purpose of calculating IGST shall be, where whole of the goods are sold, where fully the goods are sold, the value determined under subsection 8, that is assessable value plus customs duties excluding IGST, or transaction value of such goods whichever is higher. And suppose if only part of the goods is sold, suppose 60% of the goods is sold, accordingly you determine, or where any part of the goods is sold, the proportionate value of such goods as determined under subsection 8, or the transaction value whichever is higher. Now sometimes what will happen, A will sell to B, B will sell to C, C will sell to D, D will sell to E. Now E will only do the clearance. Now at that time what should be taken? Normal assessable value plus basic customs duty, social welfare surcharge, or the price at which E purchased the goods, the last buyer has purchased the goods, whichever is higher. Read this paragraph. However, where whole of the warehouse goods or any part thereof are sold more than once, before such clearance for home consumption or export, the transaction value of the last such transaction, underline the transaction value of last such transaction, the transaction value of last such transaction shall be the transaction value for the purpose of clause A or clause B. And where the warehoused goods remain unsold, the value or proportionate value shall be normal, that is remaining goods which are not sold will be cleared by original importer only, na. So Mr. A in our example, so regularly he will pay. So in this example say this, suppose if A is only clearing the goods from warehouse, then what he need to do? Normal way he need to compute the customs duty. Just because A is not clearing and Mr. B is clearing, so that's why we have a special process to be followed in this case. Okay. Then even for computation of GST compensations also we need to follow the same format. Let's try to understand with the help of an example. So even if you are not understanding this theory part, don't worry. So that is incorporated into this illustration. So look into this case study in the next page. A Limited is the original importer, and A Limited is placing an order with the foreign supplier, and foreign supplier will deliver the goods to the Chennai port, and the number of units is 10,000 units at the rate of 1000 rupees per unit. This is the CIF price. What is CIF price means? Cost, insurance and freight. That is the price at which they need to pay customs duty, that is 1000 rupees per unit to Chennai port. And thereafter from Chennai port, the customs officer like A Limited filed inbound bill of entry. Step number 1, A Limited imported the goods, placed the order with the foreign seller sent the goods to Chennai port, and the goods were in Chennai during the transit, or goods entered the Chennai port. After goods entered the Chennai port, A Limited filed inbound bill of entry with the customs officer, and customs officer passed warehouse order. So therefore the goods are deposited in Madurai public warehouse. Okay, so that's what I told you. The port can be in Chennai, but the warehouse can be in a different place. So this deposit is with payment of customs duty or without payment of customs duty? Without payment of customs duty. Whether the goods are still under customs control? Yes. As the goods are deposited in warehouse, it is still under customs control or customs barrier. Okay. Now what happens is warehouse will give a warehouse receipt of 10,000 units to A Limited. Now what A Limited is doing with that warehouse receipt? 4,000 units they are selling to B Limited. Whether they are clearing or the warehouse receipt is transferred. Warehouse receipt is transferred. Now who will be the importer? Who will file the ex-bond bill of entry? B Limited is the importer and they will file ex-bond bill of entry. And what is the price at which B Limited purchased from A Limited? 1,200 per unit. Okay. Then let's do the computation for this. How to do the computation for this transaction? You don't have to make note, just listen. First, so sale to B Limited. So who will be the importer? Customs duty payable by. Customs duty payable by A Limited or B Limited? B Limited. What is the number of units? What is the number of units? 4,000 units. 4,000 units. And what will be the assessable value? What will be the assessable value? Come on, 4,000 units into what is the price at which the goods are originally imported? $1,000 per unit. So 4,000 into $1,000 per unit into what is the exchange rate that is given? Exchange rate pa. Exchange rate. Okay. So price itself 1,000, not $1,000. Okay. So 1,000 rupees is the price. 4,000 into 1,000 rupees per unit, that will be rupees 40 lakhs. So 40 lakhs is the assessable value. And then we need to take basic customs duty. Basic customs duty at the rate of 10%. So what is that? 4 lakhs. Okay. And then we need to take social welfare surcharge. What will be the social welfare surcharge? Social welfare surcharge at the rate of 10%, that will be 40,000. So we got basic customs duty 4 lakhs, social welfare surcharge 40,000, and then next one we need to take IGST. We don't have anything else, only these two. So IGST, while computing IGST at the rate of, let's take IGST 18%, okay. IGST, let's assume 18%. So IGST will be computed on what? IGST will be computed on A, assessable value, basic customs duty and social welfare surcharge, that is 44 lakh 40,000, or B, that is transaction value. What is the price at which these goods are sold? 1,200 into 4,000. 1,200 into 4,000 will be 48 lakhs or 48 lakhs, whichever is higher. So which is higher? Whichever is higher. So what should be taken? 48 lakhs. So 48 lakhs into 18%, that is 6 lakhs, 8 lakh 64,000, 8 lakh 64,000. So will be taken. You understood? So this is how we need to do the computation, and finally we get the total customs duty payable. So what is the total customs duty payable? That is 4 lakhs. Assessable value don't count. Okay, 4 lakhs plus 40,000 plus 8 lakh 64,000, that will be 13 lakh 4,000 will be the total customs duty payable. Is it clear? 13 lakh 4,000. And who will pay this customs duty of 13 lakh 4,000? B Limited. B Limited will pay. A Limited will not pay. Now A Limited will receive some money now, 1,200 rupees per unit. Is A Limited required to pay any GST? No, because this is called as sale of warehoused goods under customs. Sale of warehoused goods under customs is excluded from supplying. As it is excluded from supply, customs duty not payable with respect to that. Is it clear? Then next we have C Limited. So thereafter see the next transaction, sale of 2,000 units to C Limited at 1,800 rupees per unit. 2,000 units to C Limited at 1,800 per unit. So what is this? 2,000 units ka value. So 2,000 units we need to take, and assessable value will be 2,000 into, so 1,000 rupees per unit. No change in that. That is rupees 20 lakhs. And what will be the basic customs duty? Basic customs duty will be 2 lakhs. Social welfare surcharge will be 20,000, and IGST. While computing IGST, what we need to do? You take 2,20,000. A, 22,20,000, or B. B is what? What is the price at which it is sold? 2,000 units. So 1,800. So that comes to 36 lakhs. 36 lakhs. Whichever is higher. Okay. Whichever is higher. Whichever is higher. On the top of that, we need to multiply how much? 18%. So 36 lakhs into 18%. 36 lakhs into 18%, 6 lakh 48,000. So the total 6 lakh 48 plus 2 lakhs plus 20,000, 8 lakh 68,000. 8 lakh 68,000 will be taken as the total customs duty payable. You understood? And that too by C Limited. So A Limited is not required to pay any GST. Then what happened? So total 10,000 units, 4 and 2 over, 6,000 over. What is the units, number of units left? Still, so 4,000 units. In that 1,000 units they are selling to D Limited. At what rate? 1,100 per unit. who subsequently sold to E Limited at what rate? 1400 per unit. So now what will happen in this case? So who will be paying the customs duty? D Limited. D Limited or E Limited? E Limited will pay the customs duty. E Limited will pay. So now what should be taken as the number of units? 1000 units. 1000 units means, so it will be 1000 into 1000 per unit. 1000 into 1000 per unit will be 10 lakhs. And then basic customs duty 1 lakh. Social welfare surcharge 10,000. Now IGST A, that is 11 lakh 10,000, or B. What is that B? The price at which E is purchasing. What is the price at which E is purchasing? 1400. So therefore we need to take 14 lakhs. 14 lakhs, whichever is higher, into 18%. Okay, that is 14 lakhs into 18%, 2,52,000. Now you do the total of this, 2,52,000 plus 1 lakh plus 10,000, that is 3,62,000 will be taken as the total customs duty payable. Understood? Again, who will pay this? E Limited will pay. Whether A Limited is required to pay anything? No. Now see the remaining units. Balance 3,000 units cleared for home consumption. So who will pay customs duty? A Limited only will pay customs duty because A Limited is only clearing. Thereafter A Limited is selling to F Limited. Now for this 3,000, it's the regular way we need to pay the customs duty. What is that regular way? Assessable value 3,000 into 1000, that is 30 lakhs. On the 30 lakhs, basic customs duty and social welfare surcharge will be 3,30,000. So 3,30,000 plus assessable value 30 lakhs, 33,30,000. On that just the 18% we will do, no comparison, no comparison. Pa assessable value 30 lakhs pa. On that 3,30,000 will be basic customs duty, social welfare surcharge. So 33,30,000 into 18%, 5,99,400. So total customs duty payable will be 3,30,000 plus 5,99,400, 9,29,400. Who will pay? A Limited will pay. A Limited will pay. Thereafter A Limited subsequently sells to F Limited. For what rate A Limited is subsequently selling? See there, what is the price at which A Limited subsequently sells? 1,600. That to how many units? Only 1,000 units. So on that they will pay GST. So 1,000 into 1,600 into 18%. So 2,88,000 GST payable by A Limited on sale. Is it clear? First A Limited importing, they pay the customs duty. Thereafter they are selling to F Limited. So when they are selling to F Limited, so A Limited will pay. Why in the previous 3 cases A Limited did not pay? Because first of all they are not clearing. So who is clearing? The other person is clearing. So A Limited is not required to pay any GST. But in this case A Limited is only clearing and then they are making sale to F Limited. Are you understanding this? So that is about this warehoused goods. Then look into the next one, section 5. Section 5 of Customs Tariff Act, levy of lower rate of duty under a trade agreement. I told you we have 2 types of customs duty. One is standard rate, another one is preferential rate. Whenever we are importing goods from countries with which India is having trade agreement, then the preferential rate will be applicable. Standard rate will be applicable if we are importing goods from any country with which we are having trade agreement, then reduced rate, that is called as preferential rate. Say this, in case central government has entered into a trade agreement with the government of foreign country or territory for levy of duty at a lower rate, then the duty as per trade agreement shall be levied. Okay. Then next, but that will be given in the question itself. That will be given in question itself whether the standard rate to be taken or preferential rate to be taken. If you see in the question that there is trade agreement, go with the preferential rate. Then this particular things, this protective duty, I told you that this is omitted. It is not there. Previously it was there, but this is omitted now. This is omitted, so it will not be applicable. Okay. Then you can see section 8 of the Customs Tariff Act, emergency power of central government to increase or levy export duties. That is, generally change in rate happens when only during budget. Only during budget the change in rate happens. But government has been given emergency power to increase the rate. That is this. where in respect of any article, whether included in second schedule or not. In first schedule, there will be import tariff. So in Customs Tariff Act, there are two schedules. First schedule talk about import tariff. Second schedule talk about export tariff. So where in respect of any article, whether included or not in second schedule, the central government is satisfied that export duty is leviable thereon should be increased, or that can be, that an export duty should be levied, and the circumstances exist wherein it render it necessary to take immediate action. The central government may by notification official gazette direct and amend of the second schedule to be made so as to provide for increase the export duty leviable, or as the case may be for levy of an export duty on that article. What does it mean? Which means that whenever government is of the opinion that they want to increase the export duty or bring a product into the levy of export duty, they don't have to hesitate. They will bring it into the ambit of customs duty, but they don't have to wait for parliament approval. So they have emergency powers. This is the emergency power. Same way, they have emergency power to increase the import duty also. No need to go to the parliament, through notification itself they can do, that is section 8A. The central government has emergency power to increase the import duty by notification official gazette. The difference between 8 and 8A, if you see, 8 emergency power to increase export duty, 8A emergency power to increase import duty. 8 they can bring a product into levy of export duty, but 8A they cannot bring a product into levy of import duty. They need to wait for parliament approval. Is it clear? So means only in budget it will happen. Already if the product is there, they can increase it. That is this. Then next look into safeguard duty. What is safeguard duty? I told you. When safeguard duty will be applicable? When goods are imported in large quantities. When goods are imported in large quantities, that is going to spoil the domestic market. Due to that reason, they will be levying safeguard duty. Is safeguard duty country specific or product specific? Product specific. So once they levy safeguard duty on that product, if that product is imported from any country, there will be safeguard duty on that product. Is it clear? So please read this. Read this. Safeguard duty is product specific, and once levied applicable on import of that product from any country. Okay. So say this, imposition of safeguard duty. If the central government, after conducting such inquiry as it deems fit, is satisfied that any article is imported into India in such increased quantity. I told you, when safeguard duty will be applicable? Only when goods are imported in large quantities and under such conditions so as to cause or threaten to cause serious injury to domestic industry. It may by notification official gazette, so apply safeguard measures. What is that safeguard measure? They will impose safeguard duty, or they will be applying tariff rate quota. Now, so in one line, if I need to tell you, whenever goods are imported in large quantities, they will be levying safeguard duty. Over. Okay. Now, what are the cases where safeguard duty is not applicable? Just now I told you, once safeguard duty is levied, if you import that article from any country, there will be safeguard duty. However, they gave some relaxations. Relaxation number 1. If you are importing from a developing country, you are importing from a developing country, which does not exceed 3% of total import of that article into India, then there is no safeguard duty. Is it clear? Example, say this, say product X you are importing, product X you are importing, product X imported, and it attracts which duty? Safeguard duty. Now this product X we are importing from two countries. We are importing from one developing country, say we are importing from Taiwan, and remaining and all we are importing from developed countries. Okay, many developed countries. So Japan, Singapore, like that, from there we are importing. What is the import from Taiwan and import from developed countries? import from Taiwan is somewhere like 120 lakhs. Import from Taiwan 120 lakhs. And developed countries, import from developed countries is somewhere like 1180 lakhs. Import from developed countries 1180 lakhs. What is the total imports? What is the total imports? Total. Now what is the percentage from developing country? What is the percentage from developing country? How much? 120 divided by 120 plus 1180 into 100. So 120 plus 1180, 1300. So 120 by 1300 into 100. Please see how much. 120 by 1300 into 100, that is 9.23%, which is greater than 3%. So whether safeguard duty is applicable or not applicable? Applicable. Therefore, safeguard duty applicable on all imports. Safeguard duty applicable on all imports. Is it clear? Whether you are importing from developing country or developed country. Now, a slight change in this. Now, say for example, we are importing from, so developing country which is not 120 lakhs, which is say somewhere like 15 lakhs, which is like 15 lakhs. Now you do the percentage. So 15 divided by 15 plus 1180, 1195 into 100. So 15 divided by 1195 into 100 is how much? 1.25, which is less than or equals to 3%. Therefore, safeguard duty not applicable on import from, not applicable on imports from which country? Developing country. However, imports from developed country, safeguard duty will be applicable. Sir, why sir, developing country only they are giving this benefit? Because India is also a developing country. When we are importing from developing country, same blood, white blood, like that, you understood? So they are also developing, we are also developing. We should encourage developed countries and all, no, because already they are developed. Again, why should they get developed because of us? You understood? So, however, imports from developed countries, attracts safeguard duty. Is it clear? So tell me, what is the first point? When per safeguard duty not applicable, this is very important for theory question or as well as practical question. But rather than practical question, for theory question only they will be asking. But if I tell theoretically, you will not be able to remember. That's why I am connecting with example and I am telling. Okay. So very important, because definitely there is a chance of asking this, because you have questions for 7 marks and all theory questions. So in that they will ask, explain in brief about safeguard duty and what are the situations where safeguard duty is not applicable. Like that, one 7 marks question they will ask. Okay. So say this, an article originating from a developing country. When this is applicable, you are importing from a developing country, so long as the share of imports of that article from that country does not exceed 3%. Does not exceed means what? Does not exceed means less than or equals to 3%. Does not exceed means less than or equals to 3%. Sir, even if it is exactly 3% also, no safeguard duty. Yes, exactly 3% also, no safeguard duty. Got it? If it exceeds 3%, definitely there will be safeguard duty. Okay. Next. Second, when this first point will not be applicable if you are importing from more than one developing country. Okay. So see the second point. Where an article is originating from more than one developing country, then so long as the aggregator imports from each such developing country with less than 3% import share taken together does not exceed 9% of the total import of that article into India. Got it? So you can try to understand with the help of some examples I gave below. Case study 3 you see. You are importing product X from developing countries A, B, C, D and developed countries, and the total imports is 17,100. From developing countries to total, if you see, so 29.23, 11.69, 8.77, 3.5. Now any one country with less than 3%? Any one country with less than 3%? No. Which means that second point will not be applicable. So all countries imports, there will be safeguard duty. Is it clear? Then look into next question, case study 4. So what is the conclusion for the previous? Therefore safeguard duty is levied on product X imported from all countries. The next case study 4. We are importing from 4 developing countries A, B, C, D and developed countries. So product Z. So here if you see the percentage, whether each developing country with less than 3%, yes, each developing country with less than 3%, take it together. Take it together, 2.89, 2.53, 2.17 and 1.81, take it together. How much it is? Count together, pa, how much? 9 point something, so it is more than 9%. So there is no relaxation. Read the provision. You are importing from more than developing country, more than one developing country, and developing country with less than 3% taken together should not exceed 9%. Here taken together exceeds 9%. So again, so whether it exceeds 9% cumulatively, yes, therefore safeguard duty is leviable on product Z imported from all countries. Then case study 5, developing countries A, B, C, D, developed countries and total. Now you see the percentage is less than 3%. Now take it together, 2.94 plus 2.57 plus 2.21 plus 0.37 total, which does not exceed 9%. So whether we get the relaxation? Yes. For imports from developing countries A, B, C, D, there is no safeguard duty. Therefore safeguard duty not levied on product Z imported from all developing countries, but developed countries there will be safeguard duty. Is it clear? Now, so tell me first 2 points, come on. Imports from a developing country does not exceed 3% of the total import of that article into India. Then import from more than one developing country with developing country less than 3% taken together does not exceed 9%. Okay, whether this 9%, 3% to be calculated monthly or yearly. So yearly, like last 1 year data they will take and they will do the computation. For example, today they are determining means last 1 year data they will take. Okay, so determined on a yearly basis. Then one more point you see, that is government can specify that if you are importing from some specified countries, there is no safeguard duty. So government also can specify, and then also there is no safeguard duty. See this. So central government may by notification official gazette exempt such quantity of any article as it may specify in notification when imported from any country or territory from payment of whole or part of the safeguard duty leviable thereon. Got it? Then next, import by 100% TOU or a unit in SCZ. So for third point you remember, notified countries. Notified countries there is no safeguard duty. Then fourth point, imports by 100% EOU or SCZ. Okay. So these 4 points you remember. So EOU or SCZ imports also there is no safeguard duty. However, you try to import into EOU or SCZ and then clear to DTA. DTA means domestic tariff area. So the entire country they have given some export promotion zones, that is called as EOU, SCZ, etc. The rest of the country is known as DTA. First you are importing into SCZ, you are escaping from safeguard duty. Thereafter it may enter into India, possible or not. For that reason only, so there is no safeguard duty. However, if it is cleared to DTA, then there will be safeguard duty. Got it? Read it. Any safeguard measure applied shall not apply to articles imported by 100% EU or SCZ unless it is specifically made applicable or that article is either cleared as such into DTA or used in manufacture of any goods that are entering into DTA. Simple, if it is consumed in EU or SCZ, no problem. But from there, if it is sold in India, then that attracts safeguard duty. So these are the 4 points you need to remember and write if you get a question on non-applicability of safeguard duty. Until the time they determine the final safeguard duty. Who will determine the safeguard duty? Government will determine the safeguard duty. Till the time they determine the safeguard duty, provisionally they will be levying a safeguard duty. What is that provisional safeguard duty? So for a period of 200 days, they will levy a provisional safeguard duty, because they need to do the investigation. Without doing investigation, they cannot decide. Suppose they completed the investigation. What is the time limit within which they need to complete the investigation? 200 days. What will happen after 200 days? Whatever is the amount they have decided not to levy, but already they collected, that will be refunded. Suppose if they have not collected more, collected less, the extra amount will be recovered. Read it. On final determination, the government of the opinion that increased imports have caused or threatened to cause serious injury to domestic industry, it shall refund the safeguard duty so collected, and any provisional safeguard measure shall not remain in force for more than 200 days from the date on which it is applied. Other condition, the safeguard duty imposed under this section is in addition to any other duty imposed under this act. And what is the period for which? Means it is an addition. That's what I told you. We have lot of customs duties. In that, safeguard duty is also one of the customs duty. Then the safeguard measures applied under this section shall, unless revoked earlier, cease to have effect on expiry of 4 years. Means what is the period for which safeguard duty is applicable? For a period of 4 years. Can it be extended? Yes, it can be extended. So see the next point. In no case the safeguard measure shall continue to be applied beyond a period of 10 years. Means it can be levied for 4 years and it can be extended for a further period. But what is the overall period? Overall period, maximum period will be 10 years. When they will extend? When they are of the opinion that the domestic industry is getting affected because of imports. If the central government is of the opinion that domestic industry has taken measures to adjust to such injury or threat, and it is necessary that safeguard measures should continue to be applied, it may extend the period of such application. Then, so this is about safeguard duty. Okay, so you have this safeguard duty related information in your study material, in like whatever they have given, everything we discussed. Okay, so you can see here safeguard duty. Okay, other customs duties, safeguard duty. So that 3% point, 9% point, all those things, and duration of imposition, what is the period, etc. and all. Done. Now we are moving on to the next one. What is the next one? Countervailing duty on subsidized articles. This is also known as anti-subsidy duty. Okay, so they use the word countervailing duty on subsidized articles, but you can also easily remember it as anti-subsidy duty. Okay, so now what is the purpose of this anti-subsidy duty? Already I told you. So I asked you to remember China as example. China government will be giving subsidy to the exporter of toys to India, because of which they will be selling toys to India at a cheaper rate. So then Indian toy manufacturers will get affected. For that reason they will be levying anti-subsidy duty. Is it clear? So see there, some countries encourage exporters by offering them subsidies, and when those articles are imported, the price acts as a deterrent to local manufacturers. Therefore, to protect the interest of local manufacturers, countervailing duty is levied on those subsidized articles. So when will there be conditions to be satisfied? You remember this condition. First a country should have offered subsidy on exportation of article. Example, China is giving subsidy to the manufacturer who is exporting to India. Then such article on which subsidy has been granted must be imported into India. So that article will be coming into India. Such import could be from any country, but with respect to such articles. Means China, it may come from China, or it may go to Korea, or it may go to Taiwan, it may go to Singapore, Malaysia, and it may come. You understood? But the goods are manufactured in China. It may come from any country, but it is originally belonging to China. Such import could be from any country, but with respect to such articles. Such articles may or may not be in the same form. That is, it may be imported as finished goods, or it may be imported as raw materials. Means the subsidy might be given for raw materials. Carefully listen. The subsidy might be given for raw material, but what we are importing is finished product. But the finished product also has a subsidy. Raw material, if it is subsidy, the finished product also will have the subsidy, because in finished product the raw material will be included. Raw material rate is 100 pa, finished product rate is 500, then value addition is how much? 400, correct? Now raw material price got reduced by 50 means overall finished product price also will get reduced by 50, correct or not? So either the article, the subsidy may be given for raw material or finished goods. Tell me what are the 4 conditions. First, any country should have given subsidy to the exporter, okay, who is exporting to India, and that article on which subsidy is enjoyed may be imported into India, and that article may be imported from the same country or any other country. It may be imported in the same form or any other form. Got it? Then subsidy deemed to exist. When there will be subsidy deemed to exist, how the subsidy will be given? Carefully listen. First, subsidy will be in the form of financial contribution by government. Underline those words. Financial contribution by government. Financial contribution by government. So there is a financial contribution by government or any other public body in the exporting or producing country or territory. Such contribution may include direct transfer of funds like grants, loans, etc., or waiver of revenue due to the government. Okay? Then, so how the subsidy will be in the form of financial contribution. Subsidy will be in the form of financial contribution. And next, there is any form of income or price support granted or maintained by the government. So price or income support. Price or income support means what? They will tell you are buying a raw material at 100 rupees, don't worry, I will tell you to one manufacturer, you buy from that manufacturer 10 rupees. That is called as price support. Income support, you don't worry, monthly I will give you some money, that is income support. Understood? Either they can give a financial contribution. See, I am telling you what are the ways in which the subsidy can be given. Either they can give subsidy in the form of financial contribution, or they can give subsidy in the form of price support or income support, or they can also give waiver of revenue due to government. What is waiver of revenue due to government? Exemptions, tax exemptions. You have to pay some tax, I am waiving off, you don't have to pay tax. You got it? That is also a kind of subsidy. Or government make payments to a funding mechanism, okay, and that funding mechanism in turn will support the manufacturer. But directly I will not give you money pa, one NGO I will create, to that NGO I will contribute, and that NGO will in turn work for you. Is it clear or not? So I will create a funding mechanism, that funding mechanism will in turn support to you. These are the different types of subsidies. Total 4 types of subsidies. What are they? Number 1, that highlighted words you remember, and then you add little bit here and there and you write maane, tene, pon maane, like that. Okay, you understood? Keywords you should remember, pa, theory and all. What you should do is that keywords you should remember. After remembering the keywords, here and there we should garnish, okay, sprinkle extras, and then you arrive at the paragraph. Because while and whatever is the keywords, you should underline that. Where in exam, answer sheet. So the one who is seeing your answer sheet will definitely see those keywords. In answer key also that keywords is there. Okay, he has written correctly. Because they will be under heavy pressure to complete the answer, evaluation. So due to that reason, we need to play with their mind. You understood? See, there are 2 ways. Do lot of hard work and become successful, or do smart work and become successful. So do smart work. Try to play with his mind, and you position that you are an intelligent fellow. You understood? Whether you are intelligent or not, God only knows. But you position, your answer sheet should be so good that the valuer will think maybe you are a ranker. You understood? Like that, let's cheat them, nothing. So entire world and life is about cheating only, darling. Got it? So we need to do that. And with the valuer, we need to ensure that these things and all when we are doing, he will think, okay, he has read so much that he is writing like that. Okay, so these are the keywords. What are the 4 words that should be there? What are the 4 different types of subsidy? Number 1, financial contribution by government, otherwise waiver of revenue due to government, then income or price support, then government makes payment to the funding mechanism, and that funding mechanism in turn will support the manufacturer. Got it? Next, look into the FAQs. What is the amount of anti-subsidy duty? How much will be the anti-subsidy duty? Anti-subsidy duty will be like a percentage. It will be notified on what? Either on assessable value or landed value. Got it? Again, I am repeating. Safeguard duty will be a percentage. Will that be given in the question itself? Yes, it will be given in the question itself. And it should be computed on what? It should be computed either on assessable value or landed value. And what is landed value means? Assessable value, basic customs duty plus social welfare surcharge. And if the question is silent, which should be taken? Take it on assessable value. Okay. So write there, note, if the question is silent, if question is silent, compute safeguard duty on assessable value. Compute safeguard duty on assessable value. So sometimes in question they will give the percentage. They will not tell whether it is an assessable value or landed value, but you need to do it on assessable value. What is the period for which anti-subsidy duty can be levied? Safeguard duty can be levied for what period? 4 years plus 6 years. Overall 10 years. Like that here 5 years. Anti-subsidy duty for 5 years, and it can be extended for a further period of 5 years. Like that, plus 5 years, 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 plus 5 years. There is no limit, unlimited time they can levy. So 5 years plus 5 years by central government if discontinuance would continue injury to the domestic manufacturer. Sometimes what will happen, they will not decide within the 5 years to extend, because elections, when election come, government dissolves. At that time they will not decide. Then what will happen? Automatic extension for 1 year. Automatic extension for 1 year. For example, 5 years over pa. Now automatically it will get extended by 1 year. In that 1 year they need to decide whether to extend or not. If they have not decided to extend, it will stop. If they decide to extend, it will get extended. See that. So if the review is not completed before the expiry of the period of imposition, then the duty may continue to remain in force, pending the outcome of such review for a further period not exceeding 1 year. If the said duty is revoked temporarily, say in that 5 years, they want to give a holiday. We call it as tax holiday. Tax holiday. For a period, they don't want to levy. For what period they don't want to levy? Maximum 1 year. If the said duty is revoked temporarily, revoked means what? Withdrawn. Revoked temporarily, the period of such revocation shall not exceed 1 year at a time. When anti-subsidy duty shall not be levied. Now listen, is this fair exporter, unfair exporter? They are selling to India, na? For them it is a fair exporter, unfair exporter. Unfair. Why unfair export? Why unfair export? They are trying to damage the domestic industry, and the foreign country is giving a subsidy. Correct? What if the foreign country is giving the subsidy in general to everyone? Whether they are selling to India or not also, they are giving the subsidy in general to everyone. Means it is fair only, na? They are giving the tax exemption to everyone. Not only those exporters who are exporting to India, everyone they enjoy that. Means it's a fair one only, na? So when there will be unfair, only for those exporters who are exporting to India, if they give a subsidy, it's unfair. But when they give it generally to everyone, it's fair only. Will you agree with me? That is this. countervailing duty shall not apply to article imported by 100% EOI or SEZ. This point is same na. Article imported by EOI or SEZ, just now I told you are in safeguard duty, same point. However, if it is cleared to DTA, EOI or SEZ importing an article, whether safeguard duty payable, no. Anti-subsidy duty payable, no. Nothing. Safeguard duty also not payable, anti-subsidy duty also not payable. Is it clear? However, when it is cleared to DTA, whether they need to pay? Yes, they need to pay. Got it? That is this point. What are the other conditions for levy of ASD? ASD shall not be levied unless it is determined that the subsidy is related to export performance. So the subsidy is given because they are exporting. Okay, means if subsidy is given in general to all, there won't be any anti-subsidy duty. If the subsidy is given only to exporter, fair, unfair, unfair. Number 2, the subsidy relates to use of domestic goods over imported goods. So they are telling to the manufacturer who is selling to India, boss, if you are using domestic goods only, you will get the subsidy. Means they are discouraging imports but encouraging exports. Fair, unfair, unfair. Then the subsidy has been conferred on limited number of persons. Underline limited number of persons. Only on limited number of persons they are giving subsidy. Means again fair, unfair, unfair. Then there will be anti-subsidy duty. Is it clear? If the subsidy is given only to exporters, if the subsidy is given only to limited number of persons, if the subsidy is given only for those who are using domestically, not importing, means it's unfair, definitely there will be anti-subsidy duty on import of that article into India. Got it? Can anti-subsidy duty be levied retrospectively? Yes, it can be levied retrospectively. Retrospectively means what? Retrospectively means backwards. Today they will give a notification, but the effective date will be retrospective, backwards. Prospective means forward, retrospective means backwards. Okay, so here you can see the following conditions to be satisfied for imposition of anti-subsidy duty with retrospective effect. That is, over a short span of time, large goods have entered into India. Then they may levy retrospectively. For example, last 3 months, large imports have happened. So now from that country, from China, now I wanted to levy retrospectively. Government of India wanted to levy retrospectively. So 3 months backwards they can levy. You understood? And these large imports is going to spoil the domestic market. So that's why they will levy retrospectively. What is the maximum period for which they can levy retrospectively? Underline 90 days prior. Means today they can give notification for effective date 90 days prior. Okay. The retrospective date from which the duty payable shall not be beyond 90 days from the date of notification. When is provisional anti-subsidy duty levied? Provisional duty will be levied because same safeguard duty also. Till the time they finally determine, they will be levying a provisional duty, and upon finalization either the differential amount will be collected or it will be refunded. Okay. Then the next one that we are going to discuss is anti-dumping duty. You can see your study material. So this is the countervailing duty, that is anti-subsidy duty that they have given. All these points we discussed. Now we are moving on to anti-dumping duty. Anti-dumping duty section 9A. Try to remember the section numbers pa. Section 8B is safeguard duty. 8B of what act? Customs Tariff Act. 9 of Customs Tariff Act is anti-subsidy duty. 9A is anti-dumping duty. A is anti-dumping duty. Got it? Now, when will there be anti-dumping duty? Clearly remember, whenever the exporter outside India is selling goods to India at a price less than their selling price, then there will be anti-dumping duty. Is it clear? And what is the anti-dumping duty? Safeguard duty, anti-subsidy duty, both are same. Safeguard duty also 1%, anti-subsidy duty also 1%. But anti-dumping duty is not percentage. Anti-dumping duty is absolute, one number we need to determine. How much is that? that is dumping margin or injury margin, whichever is lower. How much is anti-dumping duty? Respond. Dumping margin, see this. How much is the quantum of anti-dumping duty? Dumping margin or injury margin, whichever is lower. Dumping margin or injury margin, whichever is lower, will be taken as the quantum of anti-dumping duty. Got it? Now, let's try to understand this. Dumping margin versus injury margin means what? Say, there is a foreign country, so there is an exporter in Japan and importer in India. Now, who is dumping? Japan, okay, exporter in Japan. What is dumping margin? Logically, you tell me. What is the dumping margin? When there will be anti-dumping duty, they are selling to India at a price less than their selling price. So, what will be the dumping margin? Try. Their selling price. So, selling price in Japan minus means export price, correct? Selling price to India means export price. That is known as dumping margin. For example, selling price in Japan is somewhere $150 and export price to India is $100. So, what will be the dumping margin? $50. Is it clear? They are selling to India at a price less than their selling price. That is called as dumping margin. Is it clear, pa? Then injury margin. Who is getting injured? India. So, injury margin we need to see from Indian perspective. So, to what extent they will injure? When will there be injury? That product is imported in India at a price less than your selling price, correct? So, selling price in India, normal selling price in India minus import price, correct? You are importing, yeah, they are exporting means you are importing na. So, import price or landed value. What is landed value means? Assessable value, basic customs duty, social welfare surcharge. Say selling price in India is somewhere like $200 and the landed value is $125. What is the difference? $75. That $75 is known as injury margin. So, what should be taken? Dumping margin or injury margin, whichever is lower. Which is lower? $50 will be taken as the anti-dumping duty. Easy. Now, tell me what is dumping margin. First, anti-dumping duty is how much? Dumping margin or injury margin, whichever is lower. What is dumping margin? Normal selling price in exporter's country minus the price at which goods are exported to India. Got it? Then, what is injury margin? Selling price in India minus landed value of imported goods. What should be taken as the landed value? Assessable value plus basic customs duty plus social welfare surcharge. That will be taken as landed value. Okay. So, you can see here first, when there will be anti-dumping duty, when the export price of a product imported into India is less than the normal value of like article sold in the domestic market of the exporter, it is known as dumping. That is, normal value in export market is greater than export price. Anti-dumping action can be taken only when there is an Indian industry which produces like articles. Central government, upon receipt of complaint and after making inquiry, they will levy anti-dumping duty. How much is anti-dumping duty? Dumping margin, injury margin. Dumping margin means normal price and export price, normal value and export price. Injury margin means fair selling price of domestic industry and landed value. Landed value means assessable value and customs duties. Now, see this. Normal value means the price at which they are selling in their country. What if they are not selling in their country? See the price at which they are exporting to a third country. What if they are not selling in their country? See the price at which they are exporting to a third country. If that is also not available, see the cost of production plus usual profit margin, cost plus pricing. You understood? That country manufacturer is doing manufacturing now, do the cost plus pricing, cost plus usual profit margin you take, and that you need to determine. See, the normal value means comparable price at which goods under complaint are sold in the domestic market of the exporting country or territory. If the normal value, underline, if the normal value cannot be determined, then normal value shall be comparable representative export price to a appropriate third country. If that is also not available, cost of production in country of origin plus administration, selling and general cost and profit, that is cost plus pricing. Got it? Next. So see the next page, that is the determination of margin of dumping, that is like a chart form I have just given. Whatever I gave it here, like a chart form I mentioned, that is if the goods are sold in the country of exportation, the price at which it is sold. If not sold, you take the export to third country or cost of production plus usual profit margin. Export price, the price at which really they are exporting should be taken. If not available, then we need to determine as per rules. Okay. Then say this, there is no anti-dumping duty on articles imported by 100% EOU or unit in SEZ when applicable when EOU or SEZ clears to DTA. This point is common everywhere, correct? Safeguard duty also this point is there, anti-dumping duty also this point is there, anti-subsidy duty also this point is there. And anti-dumping duty shall be imposed for a period of 5 years plus 5 years. This is also same. If the government is of the opinion that cessation is likely to lead continuation of dumping, can they levy it provisionally? Yes. So till the time they do the investigation, they can levy provisionally. Thereafter, either they will collect the difference or give the refund. All these are common points. And retrospectively, can they levy? Yes. What is the time limit within which retrospectively they can levy? 90 days prior. So this point is also common. Understood? Now, we came to the conclusion. What is the comparative differences between these three? So now, when you are revising, you just revise this table. Just revise this table, that is sufficient. And in this protective duty is not applicable because we don't have protective duty at present. I told you this protective duty is omitted and we don't have. Okay. But remaining and all is there. So we discussed anti-dumping duty now. I think there is one illustration on anti-dumping duty given in your book. Have a look into this illustration. A commodity is imported into India from a country covered by a notification issued by the central government under section 9A. The following particulars are made available. Assessable value for levying basic customs duty 12,62,500, quantity imported 500 kgs, basic customs duty 10%, IGST 18%. As per the notification, the anti-dumping duty will be equal to difference between the cost of commodity calculated at $50 per kg and the landed value of the commodity as imported. Appraisal liability on account of normal duties and anti-dumping duty. So which anti-dumping duty they are going? Dumping margin or injury margin? Read the question and tell me, dumping margin or injury margin? Which is given? Injury margin. Injury margin only na, landed value and all is there. Injury margin means the price at which goods are sold in India minus landed value. Got it? So they have not given dumping margin, they gave only injury margin, for which we need to compute the anti-dumping duty. Can we start? Now first what we need to do? We need anti-dumping duty. Say this. We need anti-dumping duty. How much is the anti-dumping duty? Anti-dumping duty will be price computed at, they have given na, amount calculated at $50 per unit. Amount computed at $50 per unit minus landed value, correct? Now landed value, what is the landed value? Three things we will take in landed value. What are they? Assessable value, basic customs duty, social welfare surcharge. What is assessable value? Check the question and tell me. 12,62,500. 12,62,500. And what will be the basic customs duty? 10%. So 10% of 12,62,500, 1,26,250, and social welfare surcharge will be 10% of this, that is 12,625. Now you do the landed value. How much? 12,62,500 plus 1,26,250 plus 12,625. That will be 14,01,375. 14,01,375 is the landed value. What is the amount computed at $50 per unit? How many kgs imported? 500 kgs. So say this, 500 kgs into $50 per kg, na? $50 per kg, not $50 per unit, $50 per kg. So into $50 into, what is the exchange rate given in the question? 70 into 70, rupees 70 per dollar. That will be 500 into 50 into 70. That will be 17,50,000. Therefore, how much will be the anti-dumping duty? 17,50,000 minus 14,01,375. That will be 3,48,625. Got it? This is anti-dumping duty. And what is the total customs duty payable? Total customs duty payable will be basic customs duty 1,26,250, social welfare surcharge 12,625, anti-dumping duty 3,48,625. Do the total of this: 1,26,250, 12,625, 3,48,625. That will be 4,87,500. Is it clear? So say this, 4 lakh. Okay. So IGST is also there. IGST is given at 18%. Let's do the IGST computation. So then one more thing also will come in the total customs duty computation. So IGST is how much? IGST. While doing IGST, you need to add everything, correct? What are the everythings that we need to add? Taxable value, that is landed value, take 14,01,375 plus 3,48,625 into, what is the rate? Into 18%. Into 18%, that is IGST. 14,01,375 plus 3,48,625 into 18%, 3,15,000. Now you add 3,15,000 also. 3,48,625, 12,625, 1,26,250, 8,02,500. Clear pa? 8,02,500. You understood now how we got? Clear? Then next you see the comparative outlook of all three. So who will be the, and they have not given dumping margin. So can we take dumping margin as 0? So dumping margin or engineering margin, whichever is lower, so 0 is the answer. No, not like that. If dumping margin not given, don't take, that's it. Whatever margin that is given in the question, that only we need to do. Now, comparative outlook of safeguard duty, countervailing duty and anti-dumping duty. First, who will levy these three? These three is levied by central government upon receipt of complaint or information. Relief to domestic industry against. What is the relief? Why there will be levying safeguard duty? When goods are imported in large quantities. Serious injury. All these three are common, but there is a serious injury. For what reason? Serious injury on account of large quantities, imports in large quantities. Countervailing duty, serious injury on account of subsidy enjoyed in export pricing. Third one, serious injury on account of import of goods at a cheaper rate. Then what is the extent of relief? Safeguard duty, 1%. Usually that percentage will be on taxable value or landed value. When the question is silent, assessable value we will take. Same way, anti-subsidy duty also. But anti-dumping duty will be how much? Lower of injury margin or dumping margin, correct? Investigation required, and till the time investigation is completed, can they levy provisional? Yes, until completion of investigation. Final findings, time limit within 200 days from the start of investigation, whereas anti-subsidy duty 4 months, anti-dumping duty 6 months. Remember this difference, okay? Safeguard duty 200 days, provisionally they can levy 4 months, then 6 months. Upon finalization, what will happen? Either you will pay the differential amount or you will get the refund of the excess amount paid. Duration, what is the period for which it will be levied? Safeguard duty 4 years plus 6 years, maximum 10 years, that 5 years plus 5 years at a time after review, and maximum period will be unlimited time. Exemption, what is the common point between these three? Import by 100% EOU or a unit in SEZ. However, if it is imported and cleared to DTA, it is applicable. Retrospective levy, only two. Safeguard duty, there is no retrospective. Anti-subsidy duty and anti-dumping duty can be levied retrospectively within 90 days before the date of notification. Then, in case of anti-dumping duty and anti-subsidy duty, there is an automatic extension for 1 year, if not decided whether to extend or not within the expiry of 5 years. Then, this point I told you, what if we are not selling in exporter's country? Dumping margin, you see. Dumping margin, what if we are not selling in exporter's country? If not sold in exporter's country, then take the price to third country, or cost of production plus usual profit margin. Is it clear? And there is an alternative to safeguard duty called as tariff rate quota. See the note. In case of imports in large quantities, government can resort to tariff quota. What is tariff quota? Tariff quota means rather than levying safeguard duty, they will tell you have to import this much quantity only. Beyond this quantity, if you are importing, you are required to pay the extra duty. That is called as tariff rate quota. Read that. That is fixing the maximum quantity of imports as a safeguard measure instead of safeguard duty. Then this is very important point. Anti-subsidy duty and anti-dumping duty is mutually exclusive. What does it mean? When there is anti-dumping duty, anti-subsidy duty will not be applicable. When anti-subsidy duty is levied, anti-dumping duty will not be levied. So when in question both are given, be careful. Don't take both. Take any one. Highlight that. Anti-subsidy duty and anti-dumping duty is mutually exclusive. Is mutually exclusive. Then look into the next one, circumvention of anti-subsidy duty or anti-dumping duty. What is circumvention means? Escaping. Escaping. You tell me, activate your criminal mind and tell me how will you escape from anti-dumping duty or anti-subsidy duty? Think. How will you escape from anti-dumping duty or anti-subsidy duty? Huh? Okay, but already we have a provision now. If imported in 100% EOU or SEZ and then sold to DTA, then it is applicable. No, that is not. Already we have a provision for that. Which other way? When there will be anti-subsidy duty? Subsidy given by exporter country, correct? Now you change the name, description. You understood? You change the description. Product on the top, it will be, like one plastic toy. But inside, if you see, there will be electronic item. You understood? You change the description. You change the description. You change the country of origin. Import from China only, no problem. I will import from US. Just name I will change. And so either change in the description, name and description, or change in the country of origin, or import in unassembled or disassembled form. So long back in my childhood, I saw one movie. So it's Badmash Company something. Okay. In that movie, what they will do, hero and his friend import all left leg shoes in one port, all right leg shoes in another port. No one will clear. No one needs that. And the officer will sell it by way of auction, like a scrap he will sell. at a very cheaper rate. Hero will go to one port, hero friend will go to another port and buy it at a cheaper rate, will not pay any customs duty, etc. Then they will bring it to their place, attach these two and will be selling. You understood? Like that we can import it in unassembled or disassembled form in different ports. We will just break it into parts and import in different ports, because if you import it as a full item only, there is duty. So I will import it like parts. So like this you can circumvent. When you try to circumvent, already whatever notification they have given, they can extend it for these goods also. That is this concept. Okay. So you may get this as a theory question. You need to write this. Where central government on such inquiry, as it may consider necessary, is of the opinion that circumvention of anti-subsidy duty or anti-dumping duty has taken place. How it has taken place? Either of the following ways. How it will happen? Either by altering the description or name or composition. Underline, altering the description or name or composition, or import in unassembled or disassembled form, or changing the country of origin, or in any other manner. Then whatever provisions which are applicable to the existing, no need to take government approval. So no need to take parliament approval. Immediately they can extend it to other goods also. It may extend the anti-subsidy duty and anti-dumping duties to such other article also, from such date not earlier than the date of initiation of inquiry, as the government may by notification official gazette specify. Is it clear? Then next one, absorption of anti-subsidy duty and anti-dumping duty. How absorption will happen? So see this, absorption of anti-dumping duty and anti-subsidy duty. Carefully listen. First part, there is a dumping margin. So we are importing from China. And the importer is in India, and exporter in China, there is a normal selling price. That normal selling price is say $150, and export price is say $100. Okay. Then in India, normal selling price is say $200, and landed value is say $125. This is the example we took now. So how much is the dumping margin? How much is dumping margin? $50. And injury margin is $75. Therefore, anti-dumping duty fixed by central government is $50. You understood? Now, because of this reason, what will happen to the cost to importer? What will happen to the cost to the importer? Already they are paying 125 landed value plus this 50 plus 50, that will come to $175 is the cost to importer. But what is the normal selling price in India? 200. On the top of this they need to pay IGST, etc. and all, na? Correct. Now, because of which importer is telling, sir, locally itself the product is available at a same rate, so people will not be willing to buy from me. Now, what exporter is doing? Exporter has slashed down the price. Instead of selling at 100, now he is selling at 60, which means the cost will not be this much. The cost will come down. How the cost will come down? But to what extent it got reduced? $40 it got reduced now. Then the cost also from 125 it will reduce to 40. So that will be $85. Is it clear? You understood? How much is the reduction? How much is the reduction? $40, which means this $125 also will get reduced by $40. So then the cost will be not 175, the cost will be 85 plus 50, that is 135. Now there is a huge difference, 135 and 200. You understood what is the cheating that exporter is doing? Exporter tried to reduce the export price in order to absorb this anti-dumping duty. Now, what extent exporter has reduced, to that extent our government will increase anti-dumping duty. Increase anti-dumping duty. How much is the increased anti-dumping duty? How much they have reduced? $40 they reduce now. To that extent here they will increase, so that the revised cost will be $175. Is it clear or not? This is known as absorption of anti-dumping duty or anti-subsidy duty. Whenever exporter tries to reduce his export price in order to give the benefit to the importer in India, to offset the anti-dumping duty or anti-subsidy duty, that is called as absorption. Absorption means what, pa? Reduction in the export price. Say this. Absorption of anti-dumping duty is said to have taken place if there is a decrease in the export price of an article. Got it? Decrease in export price of an article without any commensurate change in the cost of production of such article. Okay. And when central government on inquiry, as it may consider necessary, is of the opinion that absorption has taken place, whereby the anti-dumping duty so imposed is rendered ineffective, it may modify such duty to counter the effect of such absorption. Got it? It may modify the duty to counter the effect of such absorption. Okay. From such date not earlier than the date of initiation of inquiry. So you can get a theory question, write a short note on circumvention of anti-dumping duty or absorption of anti-dumping duty. You need to write based on this. You may not get this question also. It's not that important, but as it is there in the discussion, I am discussing with you. So that is about this anti-dumping duty, etc., all those things. And you can see some multiple choice questions based on this. So we completed this chapter, types of customs duties. Okay. So we completed 2 chapters, basic concepts, that is taxable event and types of customs duties. Say this: the safeguard duty imposed shall be in force for a period of dash from the date of its imposition and can be extended with a total period of levy not exceeding. Which is the correct answer? 4 years and good. Basic customs duty on imported goods is levied at the rate specified in first schedule or second schedule? First schedule. Second schedule is export. First schedule is import. The anti-dumping duty shall be in force for a period of dash from the date of its imposition, can be extended for a further period of, so 5 years plus 5 years. Basic customs duty, okay, on exported goods is levied at the rate specified in export goods will be second schedule. For the purpose of computing IGST on imported goods, one of the following shall not be included. So GST compensation says social welfare surcharge will be included, anti-dumping duty will be included, but GST compensation says will not be included. Okay, because IGST, while computing IGST, GST compensation says will not be included. So but here for the first one A, second one A, third one C is correct, fourth one B is correct, fifth one is not D, fifth one is A. Okay. Next. I think true or false and all you don't have, na? Only MCQ. Only MCQ you have, but maybe this can be asked as a MCQ question. Safeguard duty shall also be considered while computing social welfare surcharge. True or false? False. Yeah, in the template where social welfare surcharge will come above, thereafter only safeguard duty. Then social welfare surcharge shall be considered while computing GST compensation cess. Correct, because GST compensation cess comes at the end. Safeguard duty levied by government may extend up to 10 years. True. Margin of dumping means Positive difference between normal value and export price, true. Rate of export duty is specified in schedule 1, false. It will be schedule 2. Fill in the blanks. In order to protect the interest of any industry established in India, central government may impose dash on any goods imported into India. That is actually omitted. It is not there. Protective duty concept is not there. Any provisional safeguard measure shall not remain in force for more than 200 days from the date on which it was applied. Anti-dumping duty shall be in force for how many years? Unless revoked earlier, 5 years from the date of its imposition. Anti-dumping duty is levied as per section 9A of Customs Tariff Act. So in MCQs they will give 9 and 9A like that. So 9A will be the answer. Okay. So that is about this. And they have not given questions. Last, after valuation, I think they have given assessable value and types of customs duties. I think there they have given. Fine. This we will discuss after completing the valuation, so that you will get an idea. See this question. This is related to today's discussion, that is rate of duty etc. and all we saw. Look into question number 11. Compute the total duty and integrated tax payable under customs law on an imported equipment based on the following information. Assessable value of the imported equipment $10,100. Date of bill of entry 25th April. Date of entry inwards 21st April. So which date should be taken as relevant date for rate of duty? Whichever is later. Rate of duty. Rate of duty is whichever is later. Entry inwards or bill of entry, whichever is later. Which is later? 25th April. On that day, what is the rate? 10%. For exchange rate, always bill of entry. For exchange rate, always bill of entry. So what is the exchange rate? $1 equals to 85. Integrated tax 18%, social welfare surcharge 10%. Come on, compute the assessable value. How much will be the assessable value? You tell me. 10,100 into 85. So see this, assessable value will be 10,100. 10,100 into 85. That will be 8,58,500. That will be assessable value. And what will be the basic customs duty? Basic customs duty at the rate of 10%, that is 85,850. Okay. Then social welfare surcharge at the rate of 10%, that will be 8,585. Over na. Next we need to take IGST. IGST at what rate? 18%. 18% of what? Assessable value 8,58,500 plus 85,850 plus 8,585 into 18%, 1,71,528.3. So we can round off. So you will get the total 8,585 plus 85,850, 2,65,963. 2,65,963 will be taken as customs duty payable. Got it? So rate of duty question is point is there na. So when you get this like this, you write small line. The relevant date for rate of duty is date of presentation of bill of entry or grant of entry inwards, whichever is later. Therefore 10% should be taken, like that little bit, 1 or 2 lines. Okay, so that you know even the impression will be formed. See this illustration 9. So we completed illustration 11. Look into illustration 9. Exxon company imported some goods from USA for being used in manufacture of final product. Determine the exchange rate to be considered for computation of import duty from the following information. Import general manifest was submitted by master of vessel. Entry inwards was granted. Exxon Co presented the bill of entry. Goods were allowed to be cleared from customs port. You tell me, pa, for exchange rate which is relevant? CBIC exchange rate prevailing on which date? Bill of entry. Correct? Import, pa, import. Bill of entry. What is the date of bill of entry? 2210. And CBIC rate is what? 84.5. So 84.5 will be taken. What will you write in exam? As per section 15 of Customs Act 1962, the relevant date for determination of exchange rate is the date of presentation of bill of entry, and the rate as notified by CBIC should be considered. In the present case, the bill of entry date is 2210 and the CBIC rate prevailing on that date is 84.5 is relevant. RBI rate is not relevant. Like that we should write. Okay. Next. You see this question number 8. Assessable value of an item imported is 2 lakhs. Basic customs duty 10%, integrated tax 18%, social welfare surcharge 10% on duty. Compute the amount of total customs duty and integrated tax payable. Ignore GST compensation cess. What is the assessable value? 2 lakhs. Then basic customs duty 10% means 20,000. Then social welfare surcharge will be 10,000. So 10%. So 2,000. Basic customs duty 20,000. Social welfare surcharge 2,000. And while computing IGST, what we need to do? Everything you need to add. Assessable value 2 lakh plus 20,000 plus 2,000. That will come to. So 2 lakh 22,000 into what is the rate? 18%. That will come to 39,960. So 20,000 plus 2,000 plus 39,960. That will be 61,960. Then next. Okay, these are the illustrations. Fine. Remaining, I think, related to valuation we have. Fine. So we will do valuation in the afternoon, so that we will complete these questions also, so that you will get a confidence. Okay, because what I have observed is that every attempt they are giving one question on assessable value computation and computation of customs duty, so that we will become thorough with, because already we know computation of customs duty. That valuation also we learn now. One 7 marks question we will be able to handle. Okay, so that we will meet in the afternoon and we will continue from there. We'll meet at 2 o'clock. Yes, we'll meet at 2 o'clock. Eat less and come. Don't eat heavily and come and sleep here. Eat less and come. So afternoon we will start with valuation under customs. Thank you. And one more thing. So GST we are going to refer from my revised book, CA Intermediate revised book, CACMA Intermediate. And if you already have that book, you can use that. If you don't have that book, you can buy that. Okay. So because you see that book once, if you like you buy, otherwise not required. Done. So book is 300 rupees only. If you like that, you buy, otherwise not required. I will be taking class from there. At that time, don't ask me to share the PDF etc. and all. I cannot give. Please try to understand that. And next thing, so we are also conducting classes for other subjects as well. Other subjects as well. So immediately after this, there will be a mock test for you. 31st, I am giving you a mock test. So you try to write the mock test, and I'll ensure that to the extent possible the paper is being corrected for face-to-face students. Okay. Online live I can't do anything with respect to that. For you I will try to do the evaluation and give. And thereafter we are starting with financial accounts and then corporate accounting. Every subject we are doing, but so 3 subjects we are giving free. So my IDT I have given, audit subject is also free, and even DT is free. I am only taking DT. Okay. So at the end I am taking. So therefore first I want to complete IDT, then at the end I have given DT. So they will share with you the schedule also. So keep that schedule, and whenever you are able to afford for the classes, every revision lecture will be for 500 rupees only. Every subject is 500. If you want, you join, attend, you like only, you pay. Done. So don't think, okay, sir is asking first to collect the money only, he is telling no. You attend the class, 500 rupees, with that 500 rupees I will not construct building and all, okay. So you join, attend the class, you like, you pay. If you don't like, you don't pay, it's fine, not an issue, got it. But as we are doing for all subjects, make use of this opportunity. Every subject we are doing, okay, so that it's like 4 days, 5 days, each and every subject will get completed, so that next 1 month you can be fully jam packed with respect to this, classes, then revision, go for exam, definitely will clear intermediate. That should be the objective. Clear? Thank you. Okay, we'll start. So this is the schedule I was referring to before break. So 27 to 30 we are having IDT. Thereafter April 1st to 6th will be financial accounting, then corporate accounting, then cost accounting. Corporate accounting and financial accounting is taken by one faculty, CA Vittal. So who is having very good experience taking for CMA students only. Okay, all faculties are having experience of taking for CMA. And then cost accounting by one faculty by name Prashant, is also very good for costing. Then law by Gautam Jain, so he is also very good faculty. OMSM by one faculty by name Vaidyanathan sir, so who was taking for CMA Institute. Then auditing by Sudarshan, so he is our team. Then FM DA management accounting by Tofik sir, he already took for CA also FM, his lectures are there in our YouTube channel also. And DT I am only taking. So therefore this audit and DT is free, you can come and sit and attend, not at all a problem. Even you can inform your friends also. So but ask them to register and come. Problem is that we have limited seats. All these classes will be here only because we thought of Anna Nagar, but the Anna Nagar premises is getting ready. So for that reason in this classroom only till May 18 the classes will be going on. Okay, and next so this we are doing face to face as well as online live parallelly, and for face to face as well as online live we are also giving backup of the lectures, and even recorded also separately they can get. If it is recorded till the exam they will have the validity. Okay, you will have the validity till exam June 30th. Done. And my advice is that you come and attend the class, you don't have to pay any fees. First day you sit, you feel like it is worth, you pay and attend the remaining days, otherwise not required. You understood what I am telling? First day you don't have to pay, just come and sit in the class, attend the classes. For example, financial accounting, corporate accounting, same faculty. You attend for the first day itself, you will know how he is taking, etc. and all. You are okay with it, you continue. You are not okay with it, so fine. So you don't have to pay, etc. and all. Like that you decide. There is no compulsion like, you know, you need to pay fees, because I don't believe in all those things. Like, for me, it is simple. Really, if quality is there, we should collect fees. Otherwise, we should not collect the fees. That's what I believe in. Okay. So for that reason, done. Then, because two students were asking me this doubt, that's why I told you that. Other three subject revision is only face to face. Yes, it will be through online live also, because everything we cannot give in YouTube, because I cannot put mud on someone's stomach. Okay, faculties and all too much. Now IDT it will change, but other subjects it will not change. If I give everything in YouTube, so think about their future and all. So not possible in YouTube, but online live we will do it in an app. Okay. Then will this class alone I will be sufficient for preparing for my exam? See, I cannot say that, because if you have already attended some classes, this revision will be sufficient. But if you have not at all attended the classes, from this only you want to learn and go for exam, I don't know to what extent it will be possible. You are taking a chance. You are taking a chance. If you have already attended some classes, then this will definitely be helpful. Moreover, we are winding up everything by May 18. So thereafter you won't have time. You will have time only to do the quick revision, and for that respective subject you can prepare and go. So for that reason, this will be sufficient, but will this only be sufficient? I really don't know. But this definitely for revision purpose, this will be sufficient. Then coming back to our discussion. So we are going to start with valuation under customs. In this valuation under customs, first we need to understand few terms. So the AC is working. So we need to learn about few terms called as Incoterms. Say this. International commercial terms called as Incoterms. These are the four terms that we have. Ex factory price. Ex factory price means, so each and every price prevailing at the factory gate. Price prevailing at the factory gate is known as ex-factory price. FAS means free alongside price. FOB means free on board price. CIF means cost, insurance and freight. So, what are the four prices that we have? Ex-factory. Ex-factory means what? Price prevailing at the exporter's factory. FAS means free alongside. Free alongside means, so at the port, before unloading, at the port before unloading. FOB means at the port after loading the goods into the ship or aircraft. CIF means price prevailing at importer's port. Small changes only we have between these prices. You can see the image, so you will get an understanding. So there is a exporter in US. The price prevailing at his factory gate is known as ex-factory price, and thereafter he will be incurring transportation charges to bring the goods from his factory to the port. So that transportation charges, when you add to the ex-factory price, it will be free alongside price. The price prevailing, okay, at the port before loading. We have not yet loaded, just loaded. And so transportation charges only. If you add loading charges also, then it will be called as FOB. So you can remember the equation: ex-factory price plus transportation charges is FAS. FAS plus loading charges is FOB. FOB price plus freight and insurance. FOB price means price prevailing at the port of exporter, means ready for shipment, and from there to India we need to incur some freight and insurance now. If you add the freight and insurance, then it will be CIF price, price prevailing at the importer's port. And this thereafter, after unloading, some post importation expenses will be there. So these goods will be taken to the importer's place. Whether that will be including the value or not including the value, that will not be including the value. Post import expenses are not part of value. Is it clear? So that is with respect to this. And next, so you understood these four prices. What is the connection between these four prices? Can you tell me once? Ex-factory price plus transportation charges is known as FAS, plus loading charges FOB, plus freight and insurance CIF. Now look into this methods of payment of customs duty. We have two methods: specific duty method and ad valorem method. Specific duty method means when customs duty is payable on the basis of unit of measurement, that is known as specific duty method. Unit of measurement means on TVs we need to pay based on inch size. So 55 inch means one customs duty will be there, 40 inch means one customs duty will be there. So irrespective of the value, whatever may be the value of TV, based on inches we need to pay the customs duty. Then in case of some goods based on kilograms we need to pay, and some goods based on length basis we need to pay. Length basis means, so cigarettes and all we need to pay based on length, centimeters. So number of centimeters, depending upon that the customs duty will be payable. That is known as specific duty method, irrespective of its market price, irrespective of its value. Okay, so when customs duty is payable on the basis of quantity imported. So for example, customs duty of 1000 rupees per metric ton of steel. Then ad valorem method means what? Ad valorem method we have two, that is transaction value and tariff value. So ad valorem means when customs duty is payable as a percentage of value. Please write down what is the meaning of ad valorem method. Customs duty payable as a percentage of value. Customs duty payable as a percentage of value is known as ad valorem method. Okay. So in ad valorem method, again we have transaction value method and tariff value method. Transaction value means, so that will be the price actually paid or payable. Tariff value means value determined by central government. So generally government from time to time will determine this is the value for the product, that only should be taken. But transaction value is not like that. Transaction value is the price actually involved in the transaction. For example, you are importing for $10,000, 10,000 is the transaction value. You are importing for $5,000, $5,000 will be the transaction value. Okay, price actually paid or payable. Now look into this. Tariff value means what? Transaction value means what? What is it I told you? Tariff value means government will fix the value. So we need to pay the customs duty based on that value only. For example, gold and silver, then RBD palm oil, these are all some goods for which tariff value has been fixed. Even though the market value is more or market value is less, or the price that we pay is more or less, but we need to pay customs duty only on the basis of tariff value. If you see in Middle East and all, gold price is very less. So, 1 gram, 24 carat itself, you will be able to get at 6,700 rupees, where in Middle East. But in India, what is the price of 1 gram gold? 8,000 rupees, okay, 8,000 and odd, it is crossing also, 8,000 rupees. Now, if you observe, 6,500 rupees you are importing, then you need to logically pay customs duty on 6,500 only, na? Correct or not? But no, they are telling you have to pay customs duty based on tariff value. Even though you import for 6,500, but you need to take the value what we determine, on that only you need to pay customs duty. That's the reason why lot of people are not interested in paying customs duty and bringing, they try to do the smuggling. Got it? Gold smuggling is more in India because of that reason, because if they pay customs duty on the tariff value, then whatever is the price that is there in the market versus whatever price at which they import will be same. But if they do the smuggling and bring it, so the difference 6,500 to 8,000 rupees means close to like 1,500 rupees per gram. And if they are importing some 20 grams also, 30,000 rupees gain. 20 grams and all easily they can bring, correct? 20 grams, 30 grams and all easily they can bring. And they will be focusing on bringing 1 kg like that and all. So huge gains they will be getting, got it? So coming back to this, these are some example of goods on which tariff value will be applicable. Read it. Tariff value can be fixed by CBIC for any class of imported goods or exported goods. CBIC should consider the trend of value of such or like goods while fixing tariff value. Once so fixed, duty is payable as a percentage of this value. And fixing tariff value is not permitted as per GATT. GATT means General Agreement on Trade and Tariff Convention. However, the provision of fixing tariff values have been retained. Then, so these are some examples. Then we have transaction value. What is transaction value means? Price actually paid or payable. So price actually paid or payable at the time and place of importation is the transaction value in case of import. Price actually paid or payable at the time and place of exportation is the transaction value in case of export. So you remember easily, in case of import, CIF price should be taken as transaction value. In case of export, FOB value should be taken as the transaction value. Can you remember what is the difference between CIF value and FOB value? FOB value plus freight plus insurance will be CIF value. Is it clear, pa? So in case of import, we should take, come on, what? CIF price. In case of export, what should be taken? FOB price. What is the connection between FOB and CIF? See this, next page, computation of assessable value in case of import. You can see assessable value in case of import is CIF price. How will we arrive at CIF price? First we will take FOB price, add insurance, add freight, we will get CIF price. And FOB price should be FOB price as given plus adjustments we need to make, and then after we need to take insurance and freight. If insurance is ascertainable, we will take actuals. So what is the meaning of ascertainable, not ascertainable? Importer at the time of filing bill of entry, if he knows how much is the insurance that he will be paying. So because basically insurance he will not pay. So insurance, so he will be paying to the container, like shipping company. That shipping company will be doing the transportation. First the shipping company will pay to the insurance company, and thereafter it will be recovered from the importer, and the freight will be paid to them. So due to that reason, the shipping company should raise invoice to me as to how much insurance I need to pay and how much freight I need to pay. So if I know, I am the importer, I know at the time of import how much I need to pay, then it is ascertainable, we will take actuals. Suppose if the insurance is not ascertainable, we will take 1.125% of FOB. Same way freight. If freight is ascertainable, we will take actuals. Okay, but if it is air freight, we will compare between actuals or 20% of FOB, whichever is lower. If it is not ascertainable, always it will be 20% of FOB. Is it clear here? So freight ascertainable means actuals, not ascertainable means 20% of FOB. But in case of air freight, we will compare with what? Actual or 20% of FOB, whichever is lower will be taken. Why we need to do whichever is lower? Because if high cost air freight is included in the value, then we end up paying more customs duty na. So to reduce that only they have brought in whichever is lower will be taken. Got it? Now in this process, so this freight shall include landing charges but not at the place of import. So in importation, unloading charges will be there. If you see here this image, there will be some unloading charges. Whether this unloading charges is pre-import or post-import? Post-import. What I told you, post-import expenses are not part of value. So therefore unloading charges should not be taken. That is this point. So shall include actual landing charges, then ship demurrage charges. Ship demurrage charges means when you anchor the ship at the outer port, you need to pay, that is the shipping company, the person in charge of the ship will be paying some charges to the customs department or port, that is called as ship demurrage charges, because he will stop the ship there itself, anchor. Then the customs officer, everyone should go to that ship in order to do the supervision, for which they will be levying a penalty kind of, that is called as ship demurrage charges. Okay. Then lighterage and barge charges. Lighterage charges means the charges which are incurred for the purpose of bringing the ship from the ship to shore. Ship will be anchored there, then the goods should come to the shore. How the goods will come to the shore? Through boats, small boats, the goods will come, and for that purpose we need to pay some charges, that is known as lighterage and barge charges, that is charges incurred for transportation of goods from ship to shore. That is this. And look into the next page, you can see some illustrations based on this. You understood now up to this? What is it we need to do? In case of import, we need to take CIF price. What is CIF price? FOB plus cost is FOB. FOB plus insurance plus freight. Easy pass. CIF. C is cost. What is cost? FOB. I for insurance. F for freight. The total we should take. Insurance ascertainable, actuals. Not ascertainable, 1.125% of FOB. Same way freight. Ascertainable, actuals. Not ascertainable, 20% of FOB. If it is air freight, actual or 20% of FOB, whichever is lower. Say this. FOB value of goods imported is $7,500. Exchange rate on 110, that is date of presentation of bill of entry, 60 rupees per dollar. Exchange rate on 1012, date of grant of entry inwards is 70 rupees per dollar. Landing charges not ascertainable. Now you tell me what should be taken as the relevant exchange rate? 60 or 70 or? Why 60? Always exchange rate prevailing on the date of presentation of bill of entry should be taken. What is the bill of entry? Date, rate, 60 rupees. What is the assessable value? Value. 7,500 is the FOB, correct? Now take FOB 7,500, multiply with 60, so you will get FOB price 4,50,000. And to that FOB, what and all you need to add to get assessable value? Concentrate, freight and insurance. First we will add insurance. Ascertainable or not ascertainable? Not given in the question means not ascertainable. Got it? Not given in the question. Is anywhere it is given? No. So which means we need to take 1.125% of FOB. What is FOB? 4,50,000. 4,50,000 into 1.125%, 5,063. Is that clear? Then freight, ascertainable or not ascertainable? Not given. Not given means not ascertainable. So how much we need to take? 20% of FOB. What is a FOB? 4,50,000. 4,50,000 into 20%, 90,000. Now you do the total of this. 4,50,000 plus 5,063 plus 90,000. That will be 5,45,063. To that we need to add, nothing. We don't have to add. That itself is the CIF. So that will be taken as assessable value. 5,45,063. This notional landing charges, no, we don't have to add anything. Just this much only. Understood here? Easy. You will not get this type of question and all for 7 marks. but this is for MCQ purpose. For MCQs you will be getting this, and for descriptive you will get big questions that we will solve, but this is just to understand the concept. Okay, then case study 2. CAF value of goods imported is $40,000, freight $2,000. The above CAF price includes only freight. Actual landing charges incurred is 20,000. Compute assessable value if the relevant exchange rate is 63 rupees per dollar. Now concentrate. So CAF price is how much pa? CAF price is 40. That 40,000 includes what? Freight. Then can we get FOB price? FOB price is how much? $40,000 minus, so how much? $2,000. Why we need to do this? Because insurance should be taken. Are you getting? They have not added insurance, so we need to add insurance. So 40,000 minus $2,000, FOB price is $38,000. Understood up to this? Then first we will take FOB price in Indian rupees. FOB price $30,000 into what is the exchange rate? 63 rupees per dollar. Okay, so 63 rupees per dollar, that will be 30,000 into 63. 38,000, sorry. 38,000 into 63, that will be 23,94,000 rupees. Okay, to the extent possible when you are doing questions on customs, you put rupees, dollars, etc., because otherwise they will not understand what is that you have done. Okay, then for FOB price we need to add what? Insurance. Ascertainable or not ascertainable? Not ascertainable. So what we need to do? 1.125% of FOB. So 23,94,000 into 1.125%. Okay, 1.125%, 26,932.50. Wait, last number alone you convert to nearest 1 rupee. Do everything, finally you convert. Okay, then next, freight. How much is the freight? $2,000, but whether this landing charges will be included or not. Where is this landing charges? In India is it given? Whether this landing charges in India like that, is it given in the question? No. What I told you, only landing charges in India should not be included, but midway somewhere they will unload and load and all whether that will be included? Yes. They have not given, so this landing charges is also part of freight. Okay, so see how much? 2,000 into what is the exchange rate? 63 rupees per dollar plus what is the landing charges? 20,000. So you will get 2,000 into 63 plus 20,000, 1,46,000. Okay, now if you do the total, there is nothing up to this only. So assessable value or CIF price. What is the assessable value or CIF price? 23,94,000 plus 26,932.5 plus 1,46,000, that will come to 25,66,933. 932.5. I told you 0.5 and above we should round off to nearest 1 rupee. So 25,66,933 will be taken. Understood here this case study? Now next one. So each and every case study there is uniqueness. First one is normal. Second one, what if CIF is given and only freight is included? Next question you see. CIF value of goods imported is 75,000 euros. Insurance is 5,400 euros. Air freight is 17,500 euros. Actual landing charges not available. Compute assessable value if the relevant exchange rate notified by CBIC is rupees 80 per euro and RBI is rupees 75 per euro and the prevailing market rate on the date is rupees 78 per euro. Usually which rate should be taken? Prevailing market rate, RBI rate, CBIC rate? CBIC rate. So rupees 80 per euro should be taken. Very good. Now, so directly CIF price is given. So can we take 75,000 and multiply with 80 and determine the assessable value? Listen, don't sleep. Don't sleep. You sleep, no. So exams is there. Okay. So I will curse you. Be careful. My curse and all also will definitely happen. Don't sleep. Concentrate. Already we have left a lot of time. At least this month, April month, May month, you focus, you will clear inter. You want to clear only, no? So clear. You should come into final. You should become successful in life. Or because of someone's pressure, you are joining the CMA. No. Correct? You should never sleep. The fear should be there here. When you have fear, you will not get sleep. Say this. So, CIF price 75,000 is given. Why can't we take 75,000 and multiply with 80? Insurance, okay. Insurance is also there. Very good. Air freight. Air freight should be compared with 20% of FOB because actual or 20% of FOB, whichever is lower will be taken for that reason. So say this. First, we need to get the FOB price. So to determine the FOB price, how to construct the FOB price here? So they have given CIF PA. So CIF price minus insurance minus freight, okay, air freight or freight, that will be FOB price. So can you tell me what is the CIF price given in the question? 75,000 euros, okay, 75,000 euros minus insurance how much? 5,400 euros minus air freight how much? 17,500 euros will be FOB price. 75,000 minus 5,400 minus 17,500, that is 52,100 euros will be taken as the FOB price. Is it clear? Now, so this FOB price we will try to convert into Indian rupees. What is the exchange rate? Come on. 80 rupees per euro. Okay. So 5200 into 80, that will come to rupees 41,68,000. This is FOB price. To this FOB price, we need to add what? Insurance. Insurance, ascertainable or not ascertainable? Ascertainable. How much? 5,400 into rupees 80 per euro. Okay. So 5,400 into 80, that is 4,32,000 will be insurance. Then we need to add freight. How much is the freight? Actual or 20%. Ascertainable na? Even though ascertainable, what we need to do with respect to air freight? With respect to air freight, we need to take actuals. How much is actuals pa? 17,500 into rupees 80 per euro, that will be 14 lakhs, rupees 14 lakhs. Then 20% of FOB you take, 20% of FOB. What is the FOB we got? 41,68,000 into 20%, that will be 8,33,600. Whichever is lower. Which is lower? 8,33,600 will be taken as the air freight. Actuals or 20% of FOB, whichever is lower. And anything else? Nothing. We have got. Now if you add this, you will get assessable value. So what is the assessable value or CIF price? 41,68,000, 4,32,000, 8,33,600, 54,33,600 rupees will be taken as the assessable value. Understood? Next, look into case study 4. CIF value of goods imported is $3,000. the breakup of which is as follows: freight calculated at 30% of CAF, insurance calculated at 4% of CAF. On examination, assessing officer increased the FOB value of consignment by 25%. Yes, as soon as you file the bill of entry, the bill of entry will be verified by the customs officer, and if the customs officer is having doubt about the valuation that you have declared, so the product may be 100 rupees, you might declare it as 60 rupees, means he will have doubt about the declared value, means you have done undervaluation. Why you will do undervaluation? To save the tax, correct? But whenever you do the undervaluation, the customs officer will identify that comparable imports, whatever you are importing, that product others also will import na, and based on that comparable imports they will say no, this is not the correct value, I am rejecting the value, and they will determine the value by increasing, got it? So they increased it by 25% like this. Now compute the assessable value if the relevant exchange rate is 75 rupees. Okay, now first tell me what is the old FOB value based on the data. Tell me what is the old FOB value. Come on. What is the CIF price given? CIF price given how much? $3,000. CIF price given is $3,000 minus insurance minus freight. How much is insurance? $3,000 into 4%. 4%, that will be $120. Then how much will be freight? $3,000 into, what is the percentage? So that is 30%, that will be $900. Now if you reduce it, you will get old FOB price. What is that old FOB price? 3000 minus 900 minus 120, $1,980 is the old FOB. Now what is the revised FOB price? What is the revised FOB price? Revised FOB price is old FOB 1980 plus they have revised it by 25%. Okay, 1980 plus 25%, that will be $2,475 will be revised FOB. Now we will start doing the computation. So now this into what is the exchange rate that is given? 75 per dollar. So how much it comes to? 1,85,625. Now to this revised FOB we need to add insurance. How much is insurance? Ascertainable or not ascertainable? Ascertainable. How much? 120. Carefully listen. Only FOB they increase by 25%, but insurance and freight they have not increased, means insurance and freight will be same, no change in that. Okay, so $120 into rupees 75 per dollar, how much that comes to? 120 into 75, that is 9,000 rupees. Then freight, how much is the freight? Is it air freight? No, so normal freight. So how much is that? 900. So 900 into rupees 75 per dollar, how much it comes to? 67,500. You do the total of this. 1,85,625 plus 9,000 plus 67,500, that will be 2,62,125. This will be taken as assessable value or CIF price. Is it clear? 2,62,125. Done here. Now suppose if it is air freight, then what we need to do? If it is air freight, actual or 20% of FOB. So whichever is lower, 20% of which FOB? Revised FOB, old FOB, revised FOB. 20% of revised FOB. So what is the revised FOB? See there, 1,85,625. That is 1,980 into 75. So sorry, revise 2,475. 2,475 into 75. that is 1,85,625. Just now we did na revised FOB. On that we need to multiply 20%. Is it clear? Then sometimes they will not give the FOB price alone. They will give FOB plus insurance $200. Freight not ascertainable. Then what we will do? Simple. Freight will be, let X be the FOB price. So insurance will be 1.125% of X. Mathematics and all don't do. You understood? That much scene we don't have. Simple, normal 20% of such sum. That's it. You understood? So don't complicate. Let X be the FOB price. 1.125% of X is this much. So then already this X, Y, Z means we will have a small heart stroke, correct or not? No, don't need. Simple. Sum is there. On that sum, 20%. You understood? Freight is usually what part? 20% of FOB. But we don't have FOB alone separately. So how much is the sum? 200. 200 into 20%, 40. So CIF will be 240. Sir, is it okay we will do like this? This is how the provision is given. This is how the law has been given. Law is telling don't do mathematics in indirect tax. So you do it normally. Got it? So 20% of FOB plus insurance. So the assessable value will be 240. Got it? Next one. What if FOB plus freight is given and we don't have a breakup of FOB and freight? We don't have a breakup and insurance is not ascertainable. Then what we will do? 1.125% of such sum. 280. 280 into 1.125%, 3.15. So 280, 3.15 will be taken as CIF price or assessable value. Understood? Then there is a concept called as transit and transshipment. Transit and transshipment. Carefully listen. Transit means the same vessel or aircraft which is bringing the goods to India in one port is taking the goods to the another port. That is known as goods in transit. For example, you can see here, there is ship A which is bringing 1000 containers and they unloaded 600 containers in Gujarat port. Thereafter, the same ship is taking 400 containers, remaining 400 containers to Chennai port and unloading those 400 containers there. Now this is known as goods in transit because same ship, okay. Whereas next example you see, first a ship A has come to Gujarat port, it is bringing 1000 containers, 600 containers are unloaded, remaining 400 containers they are taking it to Chennai port. Now same ship, another ship, from ship A to ship B, this is known as transshipment. Now, so in case of transit, that freight should be included. In case of transshipment, this transshipment freight is there na, that will not be included. Is it clear? For example, say this. So FOB price is 10,000 rupees per container. Ship A, freight and insurance 40 lakhs. What is this 40 lakhs? To bring from outside India to India, some freight cost will be there na. That freight cost is 40 lakhs for 1000 containers. Then 600 containers are unloaded. What is the assessable value of the 600 containers? Come on. What is the assessable value of the 600 containers? First FOB price is how much? 600 into 10,000. That is 60 lakhs. Then freight and insurance. How much freight and insurance you will take? Full 40 lakhs you will add? No, you will not add full 40 lakhs. Why you will not add full 40 lakhs? Because this full 40 lakhs is for 1000 containers. How many containers are unloaded? So what you will do? 40 lakhs divided by 1000 into 600. That will be 24 lakhs. So you will do 24 lakhs and 24 lakhs. So plus 60 lakhs. That will be coming to 84 lakhs. Is it clear? Now, the same ship is going to Chennai port. What is the freight insurance? 5 lakhs. What is this 5 lakhs? From Gujarat port to Chennai port, to transport these goods, some freight cost will be involved. So that is this freight insurance 5 lakhs. And what is the value in this case? So assessable value in case of this 400 containers. First, what will be taken as the FOB price? What will be taken as the FOB price? 400 into 10,000 will be 40 lakhs plus freight and insurance. What is freight? 40 lakhs divided by first freight up to Gujarat port. 40 lakhs divided by 1000 into 400. So 40 lakhs divided by 1000 into 400, that is 16 lakhs. Now another freight. What is that another freight? From Gujarat to Chennai. How much? 5 lakhs. Should this also be included? Yes. Remember, transit freight should be included in the value, but transshipment freight should not be included in the value. Is it clear or not? So whether this 5 lakhs will be included in the value? Yes. So FOB value will be 40 lakhs. Freight up to Gujarat port will be 16. Freight up to Chennai port will be 5 lakhs. So assessable value will be 61 lakhs. Got the clarity? Now, suppose if it is like this, then what is the assessable value for 600 containers? Same pa, no change, no change. What is that? So first is 60 lakhs plus 24 lakhs, 84 lakhs will be taken as the assessable value on import. Got it? Say no change, no change. Here also 84 lakhs, here also 84 lakhs, no change. But here for this 400 containers, 400 into 10,000, 40 lakhs, and plus 40 lakhs divided by 1000 into 400, 16 lakhs, that freight will come. Whether this 5 lakhs will be included? No. See the answer. 5 lakhs will not be included. Remaining and all is same. Can you do the comparison between this illustration and the above illustration? You will find the difference clearly. So transshipment freight will not be included. So only 56 lakhs. Is it clear? So transit freight will be included in the value, but transshipment freight will not be included in the value. Got the clarity? So this is about assessable value computation. Now concentrate. Look into this page number 58. Come back. What is that I told you? In case of import, we need to take CAF price. And this CAF price directly we will not get. We need to make some adjustments. There are two adjustments here. Primary adjustments and secondary adjustments. First we need to take FOB price and do the primary adjustments. Thereafter we need to do the secondary adjustments. What is the secondary adjustment? Just now we discussed insurance freight, that is secondary adjustments. Some primary adjustments are there that we have not yet discussed. This is given in rule 10. Rule 10 sub rule 1 is primary adjustments. Rule 10 sub rule 2 is secondary adjustments. Okay. Now concentrate. See this. If the following conditions are satisfied, the value of imported goods and exported goods shall be transaction value. So for exported goods, the price actually paid or payable for the goods when sold for export from India for delivery at the time and place of exportation. Highlight these two conditions. So already you know what is the meaning of FOB price prevailing at the time and place of exportation. But what is the important condition you need to remember? Buyer and seller should not be related and price must be the sole consideration. These two conditions should be satisfied. For import also these two conditions are there. Buyer and seller are not related and price is the sole consideration. If these two conditions are satisfied, then we will take transaction value, that is CAF price and FOB price. What if they both are related? Who both? Importer and exporter. Or price is not sole consideration. What is the meaning of price is not sole consideration? Some other consideration is getting from the recipient to supplier. You understood? For example, I am not getting only the price. I am getting some other consideration. So maybe you are giving me gold or you are giving me some other goods. For example, you give me raw material on which I do the manufacturing and I am giving. So means price is not the sole consideration. Is it clear? So in that case the value will be determined as per rules. Then next one, conversion dates already we discussed. What is the relevant date for determination of exchange rates? Bill of entry for home consumption or bill of entry for warehousing. For export it will be shipping bill. Now sometimes we do the fresh bill of entry. The old bill of entry will be cancelled and a new bill of entry will be presented. Is it relevant for exchange rate? Yes. In case of, this case, it was held that relevant date in respect of rate of duty payable is the date of presentation of bill of entry and not the representation after correction. For example, we do the amendment now. When we do the amendment, are we filing a new bill of entry or old bill of entry is only there? Old bill of entry. Amendment is not called as new bill of entry. So, at the time when we file the bill of entry, whatever exchange rate is there, that only should be taken. Please concentrate pa. 15th March I filed a bill of entry, then 25th March I am amending the bill of entry. Now, which date exchange rate should be taken? 15th March or 25th March? 15th March. Then, currency conversion rate. Whose currency conversion rate should be taken? CBIC or RBI or market rate? CBIC rate. Those are these points. So, we completed the secondary adjustments. Whatever we discussed now is secondary adjustments. You write there Rule 10 sub Rule 2. Rule 10 sub Rule 2 of Customs Valuation Rules 2007. Rule 10 sub Rule 2 of Customs Valuation Rules 2007. This will be taken as assessable value in case of imports, that is CAF price. Okay. Now we are looking into primary adjustments. What are the costs and services to be included in transaction value? Rule 10 sub Rule 1 of Customs Valuation Rules 2007. In determining the transaction value, there shall be added to the price actually paid or payable for the imported goods the following. Okay. So now, just read it once. But these are primary adjustments. Primary adjustments are given in Rule 10 sub Rule 1. Now, read it. The following, everyone, I want everyone to read. The following, to the extent they are incurred by the buyer but are not included in the price actually paid or payable for the imported goods. Wait, who is incurring this? Who is incurring this? Buyer. Underline, incurred by buyer. Who is incurring this? Incurred by buyer. So actually who should incur this? Seller. But who is incurring it? Buyer. Means it's an indirect consideration to the seller. Agreed? Example, you have paid me fees. Apart from that, my lunch expenditure also you are only bearing. You are bringing me daily lunch for me. Is it an indirect consideration to me or not? Who should buy lunch? I should buy. Correct? But I am asking you to buy and bring. Then whatever money that you have spent is a indirect consideration to me. My liability you are incurring, my expenditure you are incurring, which means it's a indirect consideration to me. Correct? Same logic. Who is incurring these expenses? Who should have incurred these expenses? Seller. So it's a indirect consideration, so therefore we need to add. What are they? See there. Commission and brokerage except buying commission. So what is the difference between buying commission and other commission? What is the opposite of buying commission? Selling commission. Let's try to understand what is buying commission and what is selling commission. Please concentrate. So Germany, India. Where exporter is located? Exporter is located in Germany. Exporter is located in Germany. Importer is located in India. And importer will have an agent. Importer will have an agent. Where that importer's agent will be in Germany, representing the importer. Is it clear, pa? Importer's agent will be in Germany, representing the importer. Same way, where the exporter's agent will be? In India. Exporter's agent will be in India. Now, whatever commission that is paid by the importer to his agent, what is the name of this commission? So, importer agent will buy or will sell? Importer agent will buy or will sell? will buy. He is not selling. Exporter agent is selling, but importer agent is buying. So what is the name of the commission? Very good. Buying commission. Buying commission. Then, so whatever commission that is paid by exporter to his agent, for what? To buy or to sell? To sell. So what is the name of this commission? Selling commission. Correct pa? Now, actually selling commission who should pay? Exporter. But who is paying? Who is paying? Importer. Correct ah? Buyer has incurred what commission? Selling commission. Now tell me, is it an indirect consideration to exporter? Yes, it's an indirect consideration to exporter, therefore it should be included in the value. Is it clear? So the selling commission will be included in the value and buying commission will not be included because it is his expenditure. If importer buys a necklace to his third wife, will it be included in value? It is his expenditure pa, why you need to include it? If importer buys something to exporter's wife, some relationship is there. So definitely we need to include it in the value, correct or not? When he is spending for his person, why it should be included in the value, agreed or not? So therefore this selling commission will be included in value. When it will be included in the value? If it is incurred by the importer, okay? So say this. So commission is divided into two, buying commission and selling commission. What is buying commission? Commission to importer's agent. What is selling commission? Commission to exporter's agent. Who is paying buying commission? Importer. Will it be included in the value or not included in the value? Not included in the value. Whereas selling commission, commission to exporter's agent. Who paid? Paid by exporter. Will it be included in the value or not? No. It will not be included in the value, to be excluded from value. But if it is paid by importer, it is an indirect consideration to the exporter. So therefore it should be included in the value. What is the other name for selling commission? Local agent's commission. Because which agent is local? Exporter agent is local na. So what is the other name for selling commission? Local agent's commission. Sometimes in exam when they give local agent's commission, don't get confused. Local agent's commission means selling commission. It should be included. Is it clear? Then what are the three expenses? Selling commission, then cost of container, cost of packing. So these three expenses, who incurred these three expenses? Importer. So therefore it should be included in the value. Understood the first inclusion? Respond. Second inclusion. Second inclusion, the value apportioned as appropriate of the following goods and services were supplied directly or indirectly by buyer, free of charge or at reduced cost for use in connection with production and sale for export of imported goods. To the extent such value has not been included in the price actually paid or payable, you will not understand anything. I will tell you. That is, importer is sending some material. Importer is sending some material to the exporter. Using that material, exporter is making the finished goods and that finished goods is being imported. Now, in this import value, definitely exporter will not charge for the material. I am exporter pa, you are my importer. You give me the raw material. Using that raw material, I made the finished goods and I am sending. When I am raising you bill, will I include in the bill raw material cost? No. Why will not include raw material cost? Because I got the raw material free of cost from you, correct? So means only the conversion cost I will collect from you, but whether this raw material cost to be included in the value or not? Yes, because the value of imported goods should include raw material cost, but in FOB there won't be raw material cost, so we need to add. Okay, you understood this example. With this background you read, the value apportioned as appropriate of the following goods or services. Who supplied those goods or services? Who supplied those goods or services? Importer. Supplied directly or indirectly by the buyer, free of cost or at reduced cost for use in connection with the production and sale for export of imported goods. Got it? What are they? Material, tools and dies, materials consumed, engineering work, development or artwork, design work, etc. For every point I gave one example below, you see. There is an exporter who is located outside India, an importer is located in India, and importer is sending the raw material worth rupees 15 per unit to the exporter, and using this exporter made the finished goods and sending the finished goods to the importer in India, and the FOB price is 100 rupees per unit. Definitely this 100 do not include 15 because the exporter will charge only for the conversion. But what we need to do, what is the revised FOB price? This 100 plus this 15, 115 rupees per unit should be taken. Understood this point? Second point. So importer is sending molds and dies worth rupees 1 lakh to the exporter. Using that, exporter made the finished goods and sending the finished goods to the importer. For example, let's take a situation. Lot of kids in India are not eating food properly in the school, and lunch boxes, if it is unique, no, they will be opening that lunch boxes and they will eat. So that's why I wanted to come out with lunch boxes which is made up of cartoon characters, so that parents one day one lunch box will be given, and no, like surprise it should be. So today which character they don't know, so they need to take and see which character it is. So they will open and see, show it to others. So they will open the lunch box and they will eat it. Done. For that I need the lunch boxes, and it should be affordable, 200 rupees or 150 rupees, like that the lunch box should be. So which country I should approach? China. I will approach China and I will ask them, I need lunch boxes at this rate. Now what the manufacturer will tell, okay, we will make, but all those characters and all will be their cartoon characters only, which our kids don't know. Agreed? They will give lot of cartoon characters and that we don't know, ching shong shong, like that, okay. And in India, our kids will watch some cartoon characters. What are they? Because I became boomer, so I don't know, so I am asking you. So what are those cartoon characters? Because my kids also will be watching, this Shinchan, then Rudra, like that one character is there, then Doraemon, then even this, what is that, Motu Patlu, okay, Ben 10, okay, then you are also boomer only. There are like lot of other characters also coming up, but fine. So now these characters I need. And classic, all-time classic will be Marvel series, Spider-Man, etc. and all also we need. And I need to send a mold to where? Outside India, to China. Mold means shape and design. In this shape and design, they will make the lunch box and they will be sending. Understood example? So what is that I am sending? Mold and die. Using that mold and die, they make the lunch boxes and they will be sending it to India. Now what should be taken as the value of these lunch boxes? Whatever is the FOB price plus molds and dies should be included into this value. But how to include molds and dies? Because this molds and dies is like capital goods and I need to amortize this based on the production quantity or contracted quantity, etc. They have given 3 methods. Method number 1, you include entire cost of molds and dies at the time of import of first shipment. Second method is based on the production quantity to the shipment quantity you apportion. Method number 3, based on the contracted quantity with the shipment quantity you apportion. For example, so how much is the contracted quantity? 10,000 units and FOB price is 2,500 per unit. How this 10,000 units we are importing? First shipment 2,000 units, second shipment 5,000 units, third shipment 3,000 units. At the time of first shipment, what is the produced quantity? How much they already produced? 4,000 units. Now see this, what we need to do. What is the FOB value of first shipment? We have 3 methods. Method number 1, what is the FOB price? First shipment 2,000 units. What is the FOB price? 2,500. 2,000 into 2,500, that will be 50 lakhs. Plus molds we need to include. How much is the value of molds? Full 1 lakh you include in the first shipment. So full 1 lakh if you include, 51 lakhs will be taken as the revised FOB. Understood? Second method Second method is based on production quantity to the shipment quantity. What is the production quantity? 4,000. What is the shipment quantity? 2,000. So therefore, first 2,000 into 2,500, 50 lakhs. Then 1 lakh divided by 4,000 into 2,000. Are you understanding this? 4,000 units they made part. Out of the 2,000 they imported. So 1 lakh divided by 4,000 into 2,000. So 50,000. So 50 lakh, 50,000. Third method. What is the third method? You apportion based on the contracted quantity. What is the contracted quantity? 1 lakh divided by 10,000 into how much we are importing now? 2,000. So into 2,000, 20,000. So 50 lakh, 20,000. Now which method should I follow in exam? Depending upon the information given in the question. Whatever is the information given in the question, you follow based on that. Suppose if they give contracted quantity, you go by that. If they have not given anything, you follow first method. Fully you include. But depending upon the question, you need to do that. What if everything is given in the question? Any method you follow based on the assumption, but that will not happen. Clearly they will specify. So any of these methods can be followed in exam depending on the information given. Then look into third point. You understood the first point and second point. First point is raw material part. Second point will be molds and dyes. Third point is related to this consumables. Consumables means what? Fuel or some other things which are consumed in the process. So we will not be having that. Example, what is the difference between direct material and indirect material? Costing, direct material versus indirect material. What is the difference? Direct material means which is direct is direct material, indirect is indirect material. Show me, no? I will just pray to it. Sir, direct material means which is present or visible in the finished product, that is direct material. Indirect material means which is not present or visible in the finished product but used for this product is known as indirect material. You take this calculator. In this calculator, the plastic used is direct material. The screw is direct material. The buttons are direct material. The screen is direct material. Understood? The chip inside is direct material. But to make this, they need a indirect material like consumables. So for example, they will buy the solder and to join the wires. You understood? Soldering equipment. So that will be indirect material. You got it? And then the chip needs to be cut. So they need to cut and paste it. So that cutting will be coming under indirect material. Scissor is an indirect material. You understood? And to do the screw to this, they will buy a screwdriver. That is indirect material. You cannot see it in this, but it is present in this. Is it clear or not? So that is called as. And if you see furniture, sandpaper they will buy. Sandpaper to do the polishing of the furniture. That is indirect material. You got it? But mica, wood and all will be coming under direct material. Clear pa? So therefore not only direct material, indirect material also I may be sending. Material sent by the importer are not directly identifiable in the finished product, that is consumables, then the actual cost of such material should be included. Not only direct material, not only molds and dyes, but also indirect material, that is consumables, and intangibles. Intangibles means what? Drawings, designs, patents, trademarks, all these are intangibles. Okay. Now carefully listen. I wanted a pen like this to be made and imported into India. I asked a manufacturer in China, I want a pen like this kind of pen. It should work on iPad. This pen is 11,500 rupees. What is there in this? Just a normal pen. In this 11,500 rupees, Apple is looting money from me. You understood? So I want exactly a pen like this. Using that, I will be taking class, etc. and all. And I need for 1,000 rupees or 2,000 rupees like that. Now, to do the design of this patent will be with some person. I need to procure that patent. Is it clear? I need to procure the patent, or I need to procure the design and I need to give it to the manufacturer. You understood? Every design will have a patent and every product requires a design. Without design we cannot make the product. You understood? Like how for construction blueprint is there, like that for every product there is a design which is very, very important. So I procure the design and I will be giving it to the manufacturer and manufacturer will make the product accordingly. Is it clear? Now I am only sending the design to the manufacturer. Whether this design cost should be included in the value? Yes. But if I procure the design in India, then it will not be included in the value. Why sir like that? So government is encouraging me to spend money in India rather than procuring it from outside India, because procuring from outside India means cash outflow. When I procure in India, there is no cash outflow for that reason. Got it? Means foreign exchange outflow. So foreign exchange outflow should be discouraged or encouraged? Foreign exchange outflow should be encouraged or discouraged? Discouraged. Why? If there is too much of foreign exchange outflow, the rupee will depreciate. So today, the rupee is depreciating now. $1 which was 75, it is going to 85, 87, 90, like that it is going now. So that should not happen for that reason. Read this. There is an exporter outside India, importer in India. Importer is sending the intangible which is procured outside India. Using that intangible, exporter made the finished goods and sending it to the importer. And this intangible is procured where? Outside India. Whether this intangible should be included in the value? Yes. Such intangible cost either actuals or apportioned to be included in the value of finished goods imported. Understood here this one? Next. Next one you see, royalties and license fee related to the imported goods that the buyer is required to pay directly or indirectly as a condition of sale of the goods being valued, to the extent such royalties and fees are not included in the price actually paid or payable. Now concentrate. So just remember this chart. Royalty or technical fees paid by whom to whom? Importer to exporter. Upon reproduction or resale in India, it will not be included in the value. Okay, I'll give you an example. Have you heard of Louis Vuitton bags? You don't know? Louis Vuitton bags. Kannadiya? No, bag. Handbag. LV bags. Correct. Louis Vuitton bags. So this Louis Vuitton is very premium brand. Okay, I'll just show you this. So maybe if you guys planning to buy some handbag and all to gift it to your loved ones, it will be useful. So this Louis Vuitton, this is the Louis Vuitton bags. You might be seeing this kind of bags, okay, like this. This is called as Louis Vuitton bags. And how much you know? 3,05,000 rupees only. So this is the price of the bag. Okay, it starts actually with 1.5 lakh to 2 lakhs starting range. Starting price is 1.5 lakh to 2 lakhs and it goes up to 10 lakhs to 15 lakhs. Handbag. Okay, and sir, I wanted to import it and sell it because there is a huge demand for it. You don't know, there is a huge demand. Okay, see, boys likes bikes, cars, etc. But girls also has some desire na, like they will not spend money on bikes, etc. So they spend on handbags and watches and dress, etc. and all. So that's why premium products will always be there. You understood? So I wanted to do this import and sell. But 3 lakhs worth bag if I import, on that customs duty itself, I need to pay somewhere like 80,000, 90,000. So I will speak to Louis Vuitton manufacturer and say, you give me one bag. The same bag I will make here. Because if I am importing the bag, see these bags and all, not for the quality, same quality, if you go to Paris corner also, same bag will be available. But you know why people spend money on that brand, brand. For the sake of the brand only people will be spending money, not for the sake of handbag. What is there? Every handbag, the same thing will be there, correct? And one YouTuber will be there, na? Every celebrity handbag he will open and see what is there inside your handbag and all. A nice concept that is, okay? Probing into others' personal life means views will be more and more, got it? And every handbag, same information only, there won't be anything else and all, correct or not? Maybe little thing, extra toys and all also they might be keeping. But coming back to this, so this particular handbag, for the brand we pay. Now I speak to the Louis Vuitton manufacturer, you send me the model. The same model I will make and I will sell. For which they will tell, okay fine, you do that. For every bag that you are selling, 60% you need to pay to us as royalty. Got it? Now I imported one bag, the same kind of bag I made and I sold, and how much ever sale price I am getting out of that, I will be paying 60% to the manufacturer, the brand name owner. Whether this 60% what I pay should be included in the value or not included in the value, not included in the value, that is this. Royalty or technical fee payable by importer to exporter upon reproduction or resale in India will be included in value or not included in the value? Not included in the value. You write down there example handbag, so that whenever you are reading it you will recollect it. Handbag. Okay, next. Suppose if it is as a condition of sale of exported goods to India. What is this condition of sale of exported goods to India? I will give you one more example. Hero Honda, you know, na? Hero Honda. Previously, Hero Motorcar was a cycle manufacturer and Honda was bike manufacturers outside India, Japan. And Hero Motorcar thought the cycles will become outdated over a span of time. Like, always the evolution will happen. And they could sense that cycles will become outdated, because at that time cycle was the only vehicle which everyone used to buy. And it will become outdated, so there is no point in having cycles. So we should definitely make motor bikes. For that reason, they don't have engine. Engine they don't have. Remaining and all they have. And what happened, they were importing, like they made a joint venture with Honda and they created Hero Honda, and they have released many models, Splendor, Passion, etc. and all they released. It became a super hit in the market. Thereafter, Honda understood the market of India. They said, okay, we will only do that manufacture, and Honda got separated. Now if you see, Honda is making all the bikes separately. So Activa, Unicorn, etc., Discover. So Discover is, I think, Bajaj, sorry. So Unicorn, like that, they are making the bikes and they are selling. But Hero don't have still the engine. For that reason, Hero made a deal with Honda. See, you left me and you are starting manufacturing, but I should also survive in the market because I have been in this many years. So you give me your engine, using that the old model Splendor, etc., I will continue in the market. For which Honda said, sir, fine, I will give you, but for every engine you have to give me 15,000 rupees plus, as I am giving you engine, which means that I am losing the sale of my bike in India, so you need to give me an opportunity cost of 10,000 rupees as royalty. So 15,000 rupees what we pay for the engine plus 10,000 rupees what we pay for the opportunity cost, 25,000 rupees will be taken as the value of imported goods. Is it clear? So the royalty that we pay as a condition of sale of exported goods, write down example Honda engine. Honda engine. Example Honda engine. That should be included in the value. Sir, is the amount known or not known at the time of import? Just now I told you known. So therefore you need to add. What if the amount is not known? They are telling 20% of your sale price you need to pay like that. 20% of my sale price means I don't know now how much is my sale price at the time of import. So due to that reason, transaction value not possible, and value as per valuation rules. CVR means customs valuation rules. So D point also have included in this chart itself. Now look into E point. E point is simple part. Apart from all these things, any other expenses, who incur that expenses? Exporter is incurring the expenses and charge it to importer. When it is charged to importer, before import will always be included in the value. Example, design engineering charges. After import, now you need to divide into two. Whether it is as a condition of sale as per contract, yes, to be included in value. Example, installation charges. So first they will send a machine and they will only come and do the installation. So whether this is pre-import or post-import, post-import, but it is payable as a condition of sale of goods as per contract, so it should be included. Then as per importer's request, to be included or to be excluded from the value, to be excluded from the value. Example, customization charges. Let's take a situation, you imported a Lamborghini car, and this Lamborghini car when you have imported, so many crores, I think 4 or 5 crores it is, and you are importing that car and you took it in our Chennai road. In our Chennai road, speed breaker and all will be 1 feet, 1.5 feet speed breaker they will put. Lamborghini car will not have that much of ground clearance, it's a racing car. That we will come and take in speed breaker, it gets stuck in the speed breaker, you understood? And thereafter, somehow towing vehicle will come and it will tow. Then this person will call the engineer, Lamborghini engineer. I purchased the car for 4 crores. I need the ground clearance to be improved. So they will send their engineer and they will try to do some modification and improve the ground clearance, for which they will bill some 40 lakhs or 50 lakhs. For 4 crore car, 40 lakhs, 50 lakhs is normal, you need to pay. Whether this will be included in the value of imported car? No, because it is pre-import or post-import? Post-import. And is it payable as a condition of sale or as per importer's request? Importer request. So that will not be included in the value. You understood the example? Clear? Next. So this is the explanation why buying commission is not included and selling commission is included. Already I explained to you. So up to this we completed determination of assessable value. So I told you first we need to take FOB price, do the primary adjustments and then do the secondary adjustments, then we will get the CAF price. Can we do some questions based on this as per your study material? So look into this. So in valuation, what we started is that valuation on the basis of transaction value. 14.1 we discussed, 14.2 relevant date for determination. So look into this example which is in page number 259. Actually I thought of taking the class from your study material. One of the stupidest book on earth is your study material. Okay, seriously here. No, so it's like in the Pura எல்லாமே உடம்புல ஏர்னா எப்படி I really cannot explain here what kind of some person who get diarrhea vomiting at a time, if they have prepared the book, how it will be like that they have made. Okay, so very very pathetic book it is. Okay, so but what to do, the same book is available and based on that only you need to prepare and write your exam. So they have money but they are not spending good quality people, and they should make them. And right, I am not telling they should recruit me and all. Why will they recruit me? They should not recruit me. If they recruit me and all, my revenue gets affected. You correct or not? So they should create a team and they should do that. Determine the rate of exchange for the purpose of computation of customs duty in the following cases. Case 1, import, date of bill of entry or shipping bill 2010, date of entry inward 1510. Exchange rate notified by CBIC, exchange rate notified by RBI. You tell me which will be taken, date of presentation of bill of entry or entry inwards, whichever is later. Correct? No. For exchange rate it is not whichever is later, always bill of entry date. So 2010, what is the exchange rate? 82. So that will be taken. In case of export, it will be shipping bill. So shipping bill, what is the rate? 81. That only will be taken. This and all is one question, Appa. You understood? So they have not given. That's what I have told. And RBI rate is relevant or irrelevant? Irrelevant. Then this is what I was referring to. Say this. So this chart you should keep in your mind. First we will take ex factory price. Ex factory price. For that ex factory price we will add freight and loading up to exporter's port. That will be FOB. Correct? We discussed there. To that FOB we need to make primary adjustments. Then we need to make secondary adjustments. Then we will get CIF or assessable value. What is the primary adjustments? Commission and brokerage except buying commission. Packing cost except cost of durable and returnable packing. So let's remember packing cost. Engineering development plan and sketches, but where it should be undertaken? Outside India. Royalty and license fees. Then value of subsequent resale if payable to foreign supplier. Value of material supplied by buyer free of cost. But this in detail we discussed. Okay. After making that, you will get FOB value as per customs. To that FOB value as per customs, we need to add cost of freight. And if not specified, then it will be 20% of FOB. Which FOB? FOB price given a FOB value as per customs. FOB value as per customs means after making primary adjustments. After making primary adjustments. Then we need to take ship demurrage charges, then actual insurance charges if not specified 1.125% of FOB. This will be taken as the assessable value. Understood? Now, look into this illustration to compute the value of imported goods for the purpose of customs purpose with the following information. Price actually payable to seller 10,000. Cost of packing materials 1,000. Labor charges for packing 2,000. Price of material 1,000. Cost of transport 1,000. Insurance is not ascertained. Local transport in India, will it be included? Local transport in India? No. Local transport in India will not be included. Mode of transport C. First we will take 10,000 as transaction value. Packing materials, labor charges, price of material supplied by seller free of cost, cost of transport. But how much should be taken as insurance? 1.15% of FOB. Tell me what is FOB? 10,000 plus 1,000 plus 200 plus 1,000. Don't add cost of transport. If you add cost of transport, that is not FOB. So FOB, if you add cost of transport and insurance, that is secondary adjustments. You understood? So except cost of transport, how much you got? 12,200 into 1.125% into 1.125%. That will be 137.25. So 137 should be taken. Is it clear? Be careful, pa. If you add freight and then calculate 1.15, you will not get 137 as the answer. Okay. So please be careful. Freight and insurance will come in the last. So we need to make all other adjustments. And finally only we need to do freight and insurance. Is it clear? Then next case you take price actually payable to the seller 20,000. Cost of packing material etc. nil. Price of material 500. Now what will be the FOB? Customs FOB 20,000 plus 500, 20,500. Cost of transport not ascertainable. So how much we will take? 20%. Correct. That is 4,100. And then insurance. Insurance will be 20,500 into 1.125%. That is 230.625. So 231. Now you do the total. 20,000 plus 500 plus 4,100 plus 231. 24,831. Is it clear? Next, case 3. Price actually paid to seller 30,000. Cost of packing, labor we will take. Price of material also will take. Just add this. You will get FOB as per customs. What is FOB as per customs? 30,000 plus 500 plus 300 plus 2,000. 32,800. Transport to insurance given. Directly you add. Add transport 12,000. But we need to compare it with 20% of FOB because it is air. So 32,800 into 20%. How much? 6,560 or 12,000, whichever is lower is. So don't take 12,000, you take 6,560. So 32,800 plus 6,560 plus insurance 500. When actuals is there, we will take that. So 39,860. Understood? Clear here how we got these answers. Next, illustration 3. From the particulars given below, find out the assessable value of imported goods under the Customs Act 1962. Cost of machine at the factory of the exporting country $20,000. Means X factory price, good. Transportation charges incurred by exporter from his factory to the port of shipment 1000. Add. Handling charges paid for loading the machine on the ship 100. Now when you add this, you will get FOB price, correct? So first X factory price. What is the X factory price? X factory price is $20,000. Now you add these two, that is $1,100. When you add, you will get FOB price, but this is FOB price, normal FOB price, that is 21,100. Now for FOB as per customs, remaining, what is the other cost? Buying commission paid by importer, included or not included? Not included. Which commission will be included? Selling commission. I told you, buying commission paid by importer is to his wife. You understood? So that will not be included. Clear? So buying commission will not be included. Selling commission paid by importer only will be included. Then freight and insurance will be thereafter. So now we got up to FOB price na. Now add insurance. How much will be the insurance? Given or not given? Not given. So 21,100 into 1.125%. How much? 237.375. And freight, is it given? Yes. Is it air freight or normal freight? Normal freight. So 2,000. Now you total everything. 20,000, that is 21,100 plus 237.375 plus 2,000, that will be 23,337.35 into exchange rate 85. 85 if you multiply, 19,83,676.875, that is 19,83,677. Now what you can do, at this stage itself you can multiply into Indian rupees. Is it clear? Not necessary that you need to go up to end, do the total and then convert. So beginning itself you can start doing it in Indian rupees. Got it? Then also you will end up with the same answer. Okay? Any doubt in this question? You understood? Then you did all these questions before itself. Before itself you did all these questions. Respond here. No. So this will be useful only enough for you by doing this. If you feel like no sir, all these things we did something different, you tell, so that we can discuss that also. Okay. Next, see the illustration 4. XYZ Industries Limited has imported certain equipment from Japan at a FOB cost of 4 lakh Japanese yen. The other expenses incurred by Messrs XYZ Industries in this connection are as follows. So what is the FOB price? 4 lakhs yen. Freight from Japan to Indian port, 40,000 yen. We will take, yes, but we will do that in the last. Then insurance paid to insure in India, we will do it in the last. Design charges paid to a consulting firm in Japan. So it is pre-import or post-import? Pre-import. So we need to add. So take your calculator. 4 lakhs plus 60,000. 4 lakh plus 60,000. Next one. Messrs XYZ Industries has expended 2 lakhs in India for certain development activities with respect to the imported equipment. Pre or post? Post. Will it be included? No. XYZ Industries has incurred road transport cost from Mumbai to their factory in MP 1,30,000. Pre or post? Post. Post import will not be included in the value. Is it clear? All these are after import here, that's why it will not be included. And the CBIC has notified exchange rate as 1 Japanese yen as 0.69, but interbank rate is 1 yen 0.7. No. And exchange rate is 1 yen 0.71. No. So we will not take that. The commission payable to the agent in India was 5% of FOB cost of the equipment. Now concentrate. First, what is the FOB price given? So see this, I am just writing the answer for you to understand. Just help me with the numbers. FOB price given. What is the FOB price given? 4 lakh yen, and this 4 lakh yen we need to convert into Indian rupees at rupees 0.69 per yen. Okay. Yes, Japan currency is less than ours. You know that, na? So at least we should be happy. So 4 lakh into 0.69, that will be rupees 2,76,000. This is FOB price given. To that FOB price, we need to add design charges. How much is the design charges? 60,000 yen into rupees 0.69 per yen. That will be 60,000 into 0.69, that is rupees 41,400. Then next, what's next? Buying commission, will it be included? Buying commission or selling commission? This is buying commission or selling commission? Selling commission. Which agent will be in India? Exporter agent will be in India. I told you the other name for selling commission. Actually, you were sleeping at that time. So the other name for selling commission is local agents commission. I told you this. So who is local agent? That is exporter agent. So this commission is selling commission. They will not directly give, they will give twist like this. Okay. So 5% of FOB. Should we add this selling commission paid by importer? Yes. Selling commission. How much is the selling commission? 5% of FOB. What is a FOB? 2,76,000 into 5%, that will be 2,76,000 into 5%, rupees 13,800. Now if you do the total, anything else? That's it. Freight and insurance thereafter, last. Freight and insurance is thereafter last. Now this is known as FOB price as per customs. FOB price as per customs, that is 2,76,000, 41,400, 13,800, 3,31,200. This is FOB price as per customs, and we need to add insurance. Is insurance ascertainable or not ascertainable? Ascertainable na? How much? 20,000. Directly it is given, so take 20,000. Then freight, air freight or normal freight? Normal freight. Ascertainable or not ascertainable? Check here. Ascertainable. How much? 40,000 yen. So 40,000 into rupees 0.69 per yen, that will be 27,600. Do the total of that. 3,31,200 plus 20,000 plus 27,600 rupees 3,78,800. So you can see the answer, 3,68,800. They have not added. One second. Insurance paid to insurer in India 20, but they took 10. This is not my mistake. Okay. So it is their mistake only. It is 20,000 because in the question it is given as 20,000. So actuals ascertainable, we need to take actuals, because of which the answer will be 3,78,800. How shall your answer differ if the information regarding freight and insurance not available? Up to this same this 3,31,200, it is same. Thereafter, insurance and freight will change. How the insurance and freight will change? So 1.125% of FOB. So insurance will be 3,31,200 into 1.125%. 3,31,200 into 1.125%, that is 3,726, and 3,31,200 into 20%, 66,240. Accordingly, the answer will change. 3,31,200 plus 3,726 plus 66,240, 4,01,166. 4,01,166. Clear? Then look into this illustration 6. BSA and Company Limited have imported a machine from UK. From the following particulars furnished by them, arrive at the assessable value for the purpose of customs duty payable. FOB cost of the machine 10,000 UK pounds. Freight, air. So actual or 20% of FOB, but be careful, don't multiply 20% on 10,000. The 10,000 is the FOB price given. We need to do lot of adjustments. Then you will get FOB price as per customs. For that FOB price as per customs only, you need to do freight and insurance. Wantedly, they will give freight in the beginning itself because they want the student to make the mistake. Okay. So this freight don't take now. Last only we need to do. So engineering and design charges paid to a firm in UK before import or after import? Before import. Definitely it should be included in the value. So we need to add. So first we will take 10,000 and this engineering work we will add. License fee relating to imported goods payable by buyer as a condition of sale, 20% of FOB cost. Yes, even though it is license fee payable as a condition of sale. I told you now one chart. What is that? Any amount that is payable as a condition of sale, is it known at the time of import? Yes, included on actual basis. So how much it is? 20% of FOB. Then next, this is which FOB? FOB given, FOB given, not customs FOB, given FOB. Material and components supplied by buyer free of cost. Will it be included? Yes, that's what I gave you. Any material which is given by importer to the exporter, which is present, that material cost should be included. Then insurance paid. Last, buying commission. No, it will not come. Buying commission will never come. Other particulars, interbank exchange rate, irrelevant. CBIC notified rate, 100.25 per pound, that will come. Importer paid 5,000 towards demurrage charges for delay in clearing the machine from the airport. No. There is a difference between ship demurrage charges and demurrage charges. Ship demurrage charges is payable by shipping company, person in charge of the ship, and that is before import. So it should be included in the value. But demurrage charges is payable by the importer for not clearing the goods after import within the prescribed time limit. So demurrage charges which is after import, so don't include it in the value. But ship demurrage charges should be included in the value. So kindly make note of this. Somewhere you have space. Okay, in this place you write down in page number 61, if you have space, there in that space you write down ship demurrage charges, versus demurrage charges. Ship demurrage charges versus demurrage charges. Who will pay? Who will pay ship demurrage charges? Shipping company or person in charge? Shipping company or person in charge. Person in charge means captain of the ship. Person in charge. Whereas demurrage charges is payable by importer. What is the reason? What is the reason for which we pay ship demurrage charges? For anchoring the ship outside the port. Outside the port. But demurrage charges for not clearing unloaded goods in port within time. Inclusion in value. What is your answer? Ship demurrage charges to be included or to be excluded? To be included. Why it is to be included? Because it is pre-import. And what about this demurrage charges? To be included or to be excluded? To be excluded. Why it is to be excluded? Because it is post export, after export, sorry, post import, post import. Okay, now coming back to this, you finish making note of this. Now see the question. Now tell me whether this demurrage charges to be included or not to be included. Not to be included, because who will pay this demurrage charges? Paid by the importer. Now can you help me with this question? We will do it together. Yes. First, where we need to start? FOB price given. What is a FOB price given? FOB price given is 10,000 pounds into what is the exchange rate per pound? 100.25 per pound. So this will be the FOB price that is given. 10,000 into 100.25, that will be 10 lakh 2,500 rupees. Then to this FOB price, what is the next cost that we need to add? Check the question. What is the next cost that we need to add? Engineering and design charges. Engineering and design. How much? 500 pounds into rupees 100.25 per pound. Okay. 500 into 100.25, that will be 50,125. What's next? License fee. License fee is how much? 20% of FOB, that is already we know 10 lakh 2,500 into 20%. 10 lakh 2,500 into 20%, that is 2 lakh 500. Next, what's next? Material supplied free of cost. Material supplied free of cost. How much? 20,000 rupees. Then next, insurance buying commission will not come now. Now you need to add this. Now once you add this, this is known as FOB price as per customs. FOB price as per customs. So 10 lakh 2,500 plus 50,125 plus 2 lakh 500 plus 20,000, that will come to 12 lakh 73,125. This is FOB price as per customs. Now to this we need to add insurance. Ascertainable or not ascertainable insurance? Ascertainable. How much? 6,000. So directly you take 6,000. Then next, after insurance, what is the next thing? Freight. How much is that freight? Freight is air freight. So we need to take actual or 20%. What is the actual? 3,000 pounds into 100 100.25 per pound. So 3000 into 100.25, that will be rupees 3,750,000. Now 12 lakh BB, that is 12 lakh 73,125 into 20%. 12 lakh 73,125 into 20%, that is 2 lakh 54,625, whichever is lower. Which is lower? 2 lakh 54,625. Anything else to be added? Everything we covered now. Now you do the total of this. So 12 lakh 73,125 plus 6,000 plus 2 lakh 54,625, that will be rupees 15 lakh 33,750. 15 lakh 33,750. Okay. Done. So we'll take a break and then we will continue with the remaining aspects. Now got the confidence about approach? Yes? Fine. We'll take a break for 15 minutes, then we will continue. And all your revision classes we have planned primarily based on your study material. All subjects. Wherever some subjects they feel like they need to give you notes, they will be giving you notes, faculty. But otherwise, predominantly, these revision classes will be based on study material, because what I have observed and what I have heard is that if you are thorough with your study materials, definitely you will complete. So, is what I have heard. Thorough with your study materials. Okay, thorough in the sense everything you read from your study material, then it will be sufficient. If you skip from the study material and go for exam, God also will not save you. Okay, you should be thorough with the study material, that is required. Okay. Okay, we'll start. So I have shared one practice manual in the Telegram group. So I have prepared one practice manual which is around 63 pages. That practice manual I have uploaded in the group, Telegram group. So chapter wise I have given the MCQs, and what I observed in your study material is that for these MCQs I have given lot of MCQs. For these MCQs there is no proper explanation. That's why for every question I have given the explanation also as to why that is the correct answer. And then I have included almost all past exam questions, study material questions. So till up to December 24. Till up to December 24 also I have included. Okay. But there are few corrections required. I mean, I have not done the proofreading because of non-availability of the time. So I have just prepared it and I have shared. Whichever question you have doubt now, you just put it in the group itself, I will clarify. Okay. And kindly don't circulate it, please. So make it useful for yourself, because otherwise now people and all just remove header, footer and some academy name they will put, and they will give it as if it is their property. You understood? Now for that reason, please. And you can make use of it, no need to take printout of it and all. Just do the solving. Okay. If really required, you feel like you need a print, you take a print of it. Otherwise, you can practice from this itself. The disadvantage with past exam suggested answers and all, the answers will be given as per provisions prevailing at that time. So DT, IDT, always you need a kind of compilation like this, so that the questions are solved as per the latest amendments. That is the reason. Okay. I already gave you, you make use of it. Okay. Then coming back to this, so one friend shared me December 24 question paper, that sir, there is one question related to this customs valuation. Just see this question. So we discussed now all these in the same lines only. Okay. This was a question, Appa. This is a question. Say this. Palak Trade Limited of Mumbai has imported a machine by air. By air means you need to remember the treatment. What is the treatment we need to do? Actual or 20% of FOB, whichever is lower. The details in this regard are as under: price of the machine UK pound 10,000, air freight, loading, unloading and handling charges associated with the delivery of imported goods to the place of importation. So this is freight. Royalty relating to imported machine payable by buyer as a condition of sale, that should be added. Design engineering charges paid to consultancy firm in UK. Just now we discussed this question. We need to add. Insurance charges paid to the place of importation not known, not ascertainable. Date of bill of entry 34 and date of arrival 21/5, which should be taken as rate of duty. Bill of entry or arrival of aircraft, whichever is later. So later means 20% should be taken. Got it? And for exchange rate, always we need to take bill of entry, that is 104 rupees per UK pound, that should be taken. Then social welfare surcharge is given, integrated tax is given, ignore GST compensation cess. I know this is the way in which question will be given. There are two parts in this question. One is related to valuation, another is related to computation of customs duty. First, in valuation, what we will do, we will take the FOB price. So what is that FOB price here? You can see price of the machine 10,000 pounds. So that 10,000 pounds needs to be converted into Indian rupees at rupees. What is the exchange rate to be taken? 104 rupees per pound. So 10,000 into 104, that will be rupees 10,40,000. This is FOB price, and then we need to take charges. Out of the other charges, royalties and design engineering charges 500 and 300. So we'll take it as 800 pounds. Okay, royalty and design charges. So 800 pounds, 800 again into 104 per pound. So 800 into 104, that will be 83,200. Anything else that we need to take for FOB price as per customs, that's it. So if you do this, you will be getting FOB price as per customs, as per customs. So what is the FOB price as per customs? 11,23,200. Now you need to take insurance. So what is that insurance we need to take? So is it ascertainable or not ascertainable? Not ascertainable. So 11,23,200 into 1.125%. Okay. So 11,23,200 into 1.125% will be 12,636. Okay. That is insurance. And then we need to take freight. So freight, it is air freight. So A, actuals. So actuals we need to take. What is actuals? That is given as 2,000 pounds. So 2,000 pounds into rupees 104 per pound, that will be 2,000 into 104, 2,08,000. So 2,08,000, and B, 20% of FOB. Which FOB? FOB as per customs, that is 11,23,200 into 20%. 11,23,200 into 20%, 2,24,640, whichever is lower, 2,08,000 should be taken. Okay. So we need to take whichever is lower. So now you will get the assessable value. So what is the assessable value? 11,23,200 plus 12,636 plus 2,08,000, that will be 13,43,836. Okay. So this is your assessable value. Let me check the suggested answer. Huh. 13,43,836. Suggested answer is correct. Then basic customs duty at the rate of, what is the basic customs duty should be taken? 20%. 20% of what? 13,43,836. 2,68,767.20. Then social welfare surcharge at the rate of 10% of 2,68,767.20 into 20% into 10%, 2,26,876.72. Then IGST. Is IGST given in the question? Yes. How much? 12%. IGST at the rate of 12% of what? Of everything. 13,43,836 plus 2,68,767.2 plus 26,876.72 into 12%, that will be 1,96,737.59. Now you do the total of this, you will get customs duty payable 2,68,767.2 plus 26,876.72, that will come to 4,92,382. 381.5 will come. So 382, that will be taken as total customs duty payable. But they are given 2,95,000. Oh, mistake in suggested answer itself. No, seriously, I'll just show you. Say this. So 13,43,836 we also got. Correct? 13,43,836. Done pa? And next we have basic customs duty 20%. That itself is 2,68,000. Social welfare surcharge 26,000. IGST 1 lakh. Total eppadi pa 2,95,000. You understood? You got the clarity? Sir, basic customs duty itself is 2,68,000. Maybe they forgot to add IGST. 2,68,767.20 plus 26,876.72. They forgot to add IGST. Correct. That's where they have given. So, like this they will evaluate. I don't think so. If they have evaluated like this, then the student would have got less marks. Okay. Rest in peace. Fine, but this is how you need to arrive at the answer. Then next one. See this illustration 7. X Limited imported goods from Switzerland, 400 units at $110 per unit. Following further information is also needs to be considered. Freight vessel $5,000. Demurrage charges paid to port authority. Will it be included or not included? Not included, because demurrage charges will be payable after import. Only when it is given as ship demurrage charges you need to include. And insurance we will take. Royalty for use of patent 1,000. Royalty as a condition of sale 20,000. So we need to take 400 into 110. 400 into 110, 44,000, correct. These two royalties we need to take. Then you will get the FOB value. Then freight 5,000 we will take. Insurance directly given 50 we will take. But demurrage will not come. So that will be taken as the assessable value. Demurrage charges payable to port authorities for delay in clearing goods are not added. But royalties and license fee relating to imported goods that the buyer is required to pay directly or indirectly as a condition of sale of goods should be added. Then illustration 8. C Limited, an importer, has imported a machine from USA at FOB cost of $10,000. Freight from port in USA to Indian port was $700. Insurance was paid 6,000 rupees. All these are later. But design and development charges 2,000 were paid to a consulting firm. The importer also spent 50,000 in India for development work. That will not be included. So far we need to take FOB price 10,000, design and development charges only 2,000. Okay. 10,000 were spent in transporting the machine from India port to factory. No, it will not come. Now when you add these two, so we will be getting FOB price as per customs, then freight. What is the freight that is given? 700. Convert into Indian rupees, add insurance. And what is the commission that is given? Foreign exporters have an agent in India. Commission is payable to the agent in Indian rupees at 5% of FOB price, which is selling commission or buying commission? Selling commission. So will it be included in the value? Yes, it will be included in the value. So find the assessable value. So actually the way in which they have arrived at the answer may be correct, but the format is wrong, because what we need to do is that first we need to take the FOB price as per FOB price given, then FOB price as per customs. Okay. So first check the question and tell me what is the FOB price given. What is the FOB price given? How much? $10,000. Convert into Indian rupees. What is the exchange rate? So rate of exchange as announced by RBI 84.7, but CBIC 85.6. Which should be taken? 85.6. So $10,000 into rupees 85.60. So 10,000 into 85.60, 8,56,000 will be taken as FOB price. To this FOB price, we need to add other charges. What is the other cost that we have? Freight and insurance will not come now, but design and development charges will come. Design and development charges. So what is that design and development charges? $2,000. Same exchange rate, 85.60. Okay. So 2,000 into 85.60, 1,71,200. Then we need to add next. What is the next cost that we have? So anything else? Buying commission also we need to, sorry, selling commission also we need to add. What is it? Selling commission. Selling commission 5% of FOB. So what is a FOB? 8,56,000 into 5%. Okay. So 8,56,000 into 5%, 42,800. Now I think that's it. Yes. So if you do this, you will be getting the FOB price as per customs. FOB price as per customs, that is 8,56,000, 1,71,200 plus 42,800, that is 10,70,000. Then we need to add insurance. You know why? See, in this question it is okay, but sometimes insurance is not ascertainable, means you need to arrive this, on that only you need to multiply 1.125. But in this question, as insurance is directly given, what is the insurance? 6,000. So no problem, directly we will take. And freight is also given. Freight, air freight or normal freight? Normal freight. If it is air freight, now again we need to do like this. So that's why stick on to the template. Okay. So freight will be how much? $700 into 85.60. So 700 into 85.6, that will be 59,920. Now you do the total, 10,70,000 plus 6,000 plus 59,920, that will come to rupees 11,35,920. 11,35,920 will be taken as the assessable value. Okay, answer correct only, but the presentation is wrong. Okay. So this is about valuation. Then we have to discuss the valuation rules related to valuation. We completed up to this, and please take your book, page number 65. When transaction value is not applicable, page 65. When transaction value is not applicable, I told you there are two conditions. If those two conditions, any one condition is not satisfied, transaction value not applicable. What is that? Buyer and seller should be related. So if buyer and seller should not be related, what if they are related? Transaction value not applicable, and price is the sole consideration. What if price is not the sole consideration? Then also transaction value not applicable. Transaction value can be rejected either for special circumstances or conditions as specified in rule 3. First, these are the special circumstances. Buyer and seller are related, price is not the sole consideration. What is the meaning of related? So related is given. So this related definition is common between GST as well as customs. Both places the related definition is same. So easily try to remember this related definition. I'll give you one mnemonic. Kindly remember that mnemonic. Family scope. Remember the mnemonic, family scope, because GST also we come across related definition, customs also we come across related definition. Okay. So you remember this mnemonic, family scope. Okay. So what we are trying to understand, meaning of related. We are trying to understand meaning of related. Somewhere you please make note of this. We are trying to understand the meaning of related. So under GST as well as under customs, we are trying to understand meaning of related under GST and under customs. So family definition is there in GST, but it is not there in customs. Okay. So in customs it is not defined, family is not defined, but family is defined in GST. What is the meaning of family? Spouse and children. Spouse and children, whether or not dependent. Whether or not dependent. Okay. So spouse and children, whether or not dependent. Then parents, grandparents, grandparents, brothers or sisters, wholly and mainly dependent. wholly and mainly dependent, wholly and mainly dependent. Okay. So both places we have family in the meaning of related, but in GST it is defined spouse and children. For example, for me, my wife and my children are always related whether they are dependent on me or they are not dependent on me, whereas my parents, my grandparents, my brothers and my sisters, if they are wholly and mainly dependent on me, then only they are treated as my family, otherwise they are not my family. Whether my in-laws are my family, no, in-laws are not given. So mother-in-law, father-in-law, brother-in-law, sister-in-law, son-in-law, daughter-in-law, no one is my family. Got it? So that is not given. And moreover, this is for the purpose of GST. In customs, no problem. Definition itself is not given for family. Then, even if you observe, there is one problem here. For me, my grandparents are my family if they are dependent on me. But for my grandparents, I am not their family because grandchildren is not given, they missed. So I don't know how. So for me, my grandfather is family, yeah? But for my grandfather, I am not his family, I am someone's family then, okay? So I don't understand. And so this is the definition which is given in GST, but in customs it is not defined. So first you need to remember family. Then next, scope, in that yes. Yes for sole selling agent, and this is common between GST and customs. This is common between GST and customs, okay. There is no difference. So both the places it is the same, sole selling agent. Who is a sole selling agent? There will be only one agent and all the supplies are made through that agent, then that person will be called a sole selling agent. Then number 3, C for control. C for control. There are total 4 types of controls, and see this, that is one person controls another. Make note pa, because even if you stand upside down also you will not be able to remember all these things, okay. So when you read, I don't know whether you can remember this and all. Write, once you write, no, it will register in your brain, write it once. One person controls another. So here investment should be greater than 50%. Investment greater than 50%. This is one point. One person controls another. Then two companies with common shareholder, okay, holding greater than or equals to 25%. This is for GST. Whereas greater than or equals to 5%. This is for customs. So there are two companies pa. These two companies is having common shareholder. How much that shareholder is holding? 25% or more in two companies. Then those two companies are treated as related. For example, X Limited, Y Limited. I am the common shareholder. I hold 25% or more in X Limited, 25% or more in Y Limited. Now I am the influential person. Any transaction that happens between X Limited and Y Limited, they need to take a special resolution. Special resolution means it should be 75%. Without my vote, they cannot take the decision, which means I am the influential person in these two companies. So any transaction that happens between these two companies, it's a related party transaction. Whereas in case of customs, the percentage is not given as 25%, the percentage given is 5%. Means two companies having a common shareholder, one company in India, one other company outside India, that is importer, exporter. So in these two companies, I am a common shareholder holding 5% or more. Then also those two companies are treated as related. This is for the purpose of customs. Then next, common control by third person. Common control by third person. What is this common control by third person? Two companies having the same parent company. X Limited, Y Limited are two companies. They both have the same holding company, A Limited. So, two children, same father, different mother. Related or not related? Related only, na? Same parent, same parent. Okay. So, related. Like the two companies having same holding company, definitely they are treated as related. Then, together they control third person. Together they control third person. Together they control third person means two shareholders together control the company. So those two shareholders are treated as related. Okay. So these are the 4 points that we have in control. Then number 4. SCO. O for officers or directors of one another business. One another's business. So what does it mean? Simple. In my business, you are appointed as officer or director. In return, in your business, I am appointed as officer or director. So we both will be treated as related. That is this O. Then SCO, P. P for partners of a firm. P for partners of a legally recognized firm. Partners of a legally recognized firm. Then E. E for employer and employee. Employer and employee are also treated as related. So this is the definition that we need to remember. Okay. So family, scope. Family, S for sole selling agent, O and C for control. 4 points in control, that is one company controlling the another investment greater than or equals to 50%, greater than 50%, and two companies with common shareholder. How much that shareholder should be holding? In case of GST it will be 25%, customs it will be 5%. Then common control by a third person. Together they control a third person. O for officers or directors of one another's business. P for partners of a legally recognized firm. E for employer and employee, because already one time they have asked a theory question. For 7 marks they have asked. Explain the meaning of related, like that. Definition itself they have asked for 7 marks. Okay. So that's the reason why you should be knowing this definition. And between GST and customs the definition is same, slight difference. What is the slight difference? Here family is not defined, and in this place, in the place of 25%, it will be 5%. Okay. So you understood now? That is the meaning of related I have given. They are officers or directors of another's business, legally recognized partners, employer and employee. Any person directly or indirectly owns, controls or holds 5% or more of the outstanding voting stock or shares of them. One of them directly or indirectly controls another. Both of them are directly or indirectly controlled by a third person. Together they are directly indirectly control a third person. They are members of the same family. Then you can see sole selling agent. Now whenever there is a transaction between related parties, definitely transaction value not applicable. We need to determine the value as per rules. So valuation rules 2007 in case of import. So these are the various rules that we have. Just remember this mnemonic: TIS DCR. TIS DCR. First T for transaction value. If transaction value not possible, we need to take identical goods. If identical goods also not available, then we need to go by similar goods. If similar goods also not available, then deductive value. If deductive value not available, then computed value. If computed value not available, then it will be residual value. Understood? So first we need to take transaction value as per section 14. So we need to go by transaction value. But this transaction value may be rejected by the officer. I told you, whenever officer is of the opinion that the value has been undervalued, it may be rejected. So then in that case, we need to go for identical goods. If identical goods also fails, then it will be similar goods, like that. Okay. So see this. These methods are to be applied in sequential order. That's why you remember this mnemonic. TIS DCR. Once again you tell me. T for transaction value. T for identical goods. T for identical goods also fails, then it will be similar goods. If identical goods also fails, then it will be similar goods, like that. Okay. So see this. These methods are to be applied in sequential order. That's why you remember this mnemonic. TIS DCR. Once again you tell me. T for transaction value. Then I for identical goods, S for similar goods, D deductive value, C computed value, R residual value. So it should be applied in sequential order. If one method cannot be applied, then method 2 will come into force, and so far. But the only exception is that computed value may be used before deductive value. So these two are interchangeable. These two are interchangeable means either we can go for computed value first and then deductive value. So either it can be TISCDR or TISDCR. This is the only change that is possible. So between computed value, deductive value, first computed then deductive, or first deductive then computed. Okay, that is this. Then rule 3 sub rule 1 says value of imported goods shall be transaction value adjusted in accordance with the provisions of rule 10. That's what we did. First what we took the transaction value, we made the primary adjustments as per rule 10 sub rule 1, then we made secondary adjustments as per rule 10 sub rule 2. This already we know. Look into the proviso. This is the proviso I was referring to. The value as declared by importer, underline, can be rejected by the assessing officer. Yes or no? When it will be rejected? If the assessing officer has doubt about the truth and accuracy of the value declared. But assessing officer has to give reasons, like opportunity of being heard. Opportunity being heard means, so he need to give explanation, like he should seek the explanation. He should give a notice and tell this value is not correct, and he should hear the other party, and then only he need to proceed for valuation rules. So that is known as personal hearing. Personal hearing means he should call the person to appear before him, and he should seek the explanation from that person. That is called as personal hearing. Then rule 4. Rule 4 talks about transaction value of identical goods. I told you, first transaction value fails, then we need to go for identical goods. See the meaning of identical goods. What is the meaning of identical goods? Identical goods are also imported goods having the same physical features and quality, same country of production, and same producer, not mandatory but preferable. Then it will be called as identical goods. For example, you are importing a washing machine, a front load washing machine you are importing, and that value whatever you have declared has been rejected by the officer. Now you need to see the identical goods. Identical goods means that should also be imported washing machine, that should also be front load. Can a top load washing machine be taken as identical? No. Front load. All the features should be same. For example, this is 7.5 kg means that should also be 7.5 kg. This is steel drum means that should also be steel drum. Everything it should be same. And moreover, suppose you are importing from Taiwan, so can that be from Japan? No, that should also be from Taiwan. Same country of production, same producer preferably, not mandatory. Means you are importing LG and that person importing Samsung. Can we take it as comparable? Yes. Same producer preferably, not mandatory. Some other producer also can be taken. Okay. Then it will be called as identical goods. Tell me what are the 4 points, Pa? Imported goods, same physical features and quality, same country of production, same producer preferably, not mandatory. Then we need to make 3 adjustments after we get the identical. Actually, who will do all these things? Customs department will do. We will not do. Customs officer will do, because he is only having the date of comparable transactions. Then 3 adjustments they will do. First adjustment, difference with respect to the quantity. For example, I am importing 1000 units. That person is importing 800 units. Had he imported 1000 units, he will get a discount, correct? So now that comparison we need to do. So first we took the identical goods, but difference in the quantity adjustment we need to make. For example, I am importing 1000. He is importing 800. Had he imported 1000, he will get 5% discount. Means whatever is his price, minus 5% should be taken as the comparable, equally comparable. Is it clear? That is known as difference with respect to quantity. Then difference with respect to freight. For example, I am importing to Chennai port, but that person is importing to Surat port. And had it been imported to Chennai port, what is the extra freight? Surat port to Chennai port, what is the extra freight we need to add? That is called as difference in adjustment with respect to freight. Then difference in commercial level. For example, I am importing from manufacturer, but he is importing from a wholesaler. Had he imported from manufacturer, the wholesaler margin will not be there in the price. So we need to deduct that wholesaler's margin. You got it? Equally comparable, pa. Your transaction should taken as equal point and the adjustment needs to be made. Got it? Say this. So rule 4 of customs valuation rules provides that if valuation on the basis of transaction value is not possible, then the assessable value will be decided on the basis of transaction value of identical goods sold for exportation to India and imported at or about the same time. So we need to take identical goods at the same commercial level and substantially same quantity. And if different commercial level or different quantities or both is available, we need to make suitable adjustments. And what if we get more than one price? We need to take the lowest of such value. Now, see the steps involved. First, we need to take the identical imported goods from the customs database. Then, it should be imported at or about the same time. At or about the same time means nearest time. And identical imported goods shall be those whose assessment has been done. Assessment means final assessment. Means that identical goods value should be transaction value. That identical goods value should not be as per rules. That identical goods value should be transaction value. In case of comparable transaction is found, but that is of different quantity level, different commercial level or involving freight difference, then what we need to do? We need to make the adjustments. So these transactions can be used but not as such. Before using this, adjustment in this shall be made to bring them at the same level at which goods being valued are there. If multiple comparable transactions are found, we need to take whichever is lowest. Now let's see one example to understand. So there is a manufacturer in Japan. Mr. A is a dealer in Ahmedabad. Now, dealer has imported to Surat port how many TVs? 30-inch LED TV, 2000 numbers at 25,000 each is imported, and this transaction value is rejected due to undervaluation. Because of undervaluation, the transaction value got rejected. When the transaction value got rejected, we are seeing the comparable transactions. Mr. B, a dealer in Chennai, imported to Chennai port, assessable value equals to transaction value 30-inch LED TV, 2000 numbers at 35,000 each. Now, is it identical goods? Is it also imported? 4 conditions. Imported goods, same physical features and quality. Yes, 30-inch LED TV, 30-inch LED TV. Same country. Yes, Japan. Same person. Yes, definitely it is identical but not directly comparable. Why not directly comparable? This is to Surat port, this is to Chennai port, so we need to make adjustment with respect to freight. Identical goods only, not directly comparable. Adjustment to transportation is required. Are you understanding this? Then, so Mr. C, a dealer in Surat, imports from a manufacturer 30-inch LED TV to Surat port, 2000 numbers at 32,000 each. Assessable value equals to transaction value. Is it identical goods? Respond. Yes, imported goods, same physical features, same country, same producer. Yes, it is identical goods. Any adjustment required? Not even one adjustment required, because this is also Surat port, this is also Surat port, and this is also 2000. So there is no adjustment that is required. So identical goods, directly comparable, adjustments not required. Then, so Mr. D, dealer in Mumbai, imported to Mumbai port, assessable value equals to 40,000, determined under rule 4, 30-inch LED TV. Can we take it as identical goods? No. Why it cannot be taken as identical goods? Identical goods should be transaction value under section 14, means assessable value equals to transaction value, but here the value is determined under rule 4, that's why it is non-identical goods. Then Mr. E, dealer in Mumbai to Surat port, assessable value, transaction value 30-inch, 3000 numbers, manufacturer Japan. Is it identical goods? Yes. Imported goods, same physical features, same country and same producer, but not directly comparable. What is the adjustment that is required? So we imported 2000, that person has imported 3000, so adjustment to quantity is required. Then Mr. D, a dealer in Surat, imports to Surat port, assessable value, transaction value 30-inch LED TV 2000, but he imported from a distributor in Japan. Is it identical goods? Yes. Imported goods, same physical features, same country, same producer is preferably. So even if it is not the same, it's okay. But what is the adjustment that is required? A is importing from manufacturer, but D is importing from distributor. Had D import from manufacturer, what will be the price that should be taken? Adjustment with respect to different commercial level is required. Now when we do all these things, multiple prices are there, which should be taken lowest of that price. Got it? Then transaction value of similar goods. When transaction value of identical goods fail, suppose I am importing front load washing machine, on that day or nearest time there is no other comparable front load washing machine imported. Now can we take top load washing machine as a comparable point? Yes. Yes. So for a front load washing machine, top load washing machine can be taken as comparable because both are washing machine only. But don't take refrigerator as comparable. Washing machine cannot be compared with refrigerator. So similar goods, imported goods, commercially interchangeable with imported goods, and same country, same producer is similar goods. What is the difference between identical goods and similar goods? Identical goods, same physical features and quality, but similar goods, commercially interchangeable with imported goods. All other points are same as identical goods, but extra one more adjustment is required. What is that? Usually what is the price difference between front load washing machine and top load washing machine? So front load washing machine will be somewhere 40,000 rupees. Top load washing machine will be somewhere like 25,000 rupees. So what is the price difference? Usually 15,000. So whenever you are importing front load, but the comparable similar goods is top load, you derive the price and add 15,000 as adjustment. Why? Because difference in the engineering work, development work, artwork is there. So that engineering work, development, artwork difference we need to adjust. Then when you are unable to determine value, remember rule 4, all these is rules of customs valuation, rule 2007. Rule 4 is identical goods, rule 5 is similar goods, and rule 6, when you cannot determine the value as per rule 3 or rule 4 or rule 5, then we need to take rule 7, deductive value, and rule 8, computed value. What does deductive value says? Deductive value says, see the price prevailing in India minus all post importation cost, you will get the price prevailing at the time of importation. Is it clear? For example, see this, say this, you need to take the price, selling price in India. How much is the selling price in India? 7,000. Then do all reverse working. I need the price at the time of importation. So commission, just take calculator, 7,000 minus 80 minus 100 minus 500, okay, minus storage charges 20 minus customs 50. Now you will get 6,250. That is price prevailing at the time of importation. So that is deductive value. You understood? It is bottom up approach. You take the sale price, go reverse working and arrive at the price. That is bottom up approach, okay. Whereas top down approach, that is computed value. In computed value, what we do? Cost sheet, raw material cost, labor cost, overhead cost, administration cost, profit, all those things we will add and we will arrive at the price at the time of importation. That is computed value method. Understood the connection between these two? So in deductive value method, what we will do? We will take unit price at which imported goods, identical or similar imported goods are sold in greatest aggregate quantity. What is the meaning of greatest aggregate quantity? Means price at which greatest number of units are sold to unrelated buyer at the first commercial level after importation. So there are different quantities. Highest quantity you take, at the highest quantity whatever is the price, that is known as price at greatest aggregate quantity. From that you will reduce all post importation expenses. What is post importation expenses? Commission, transport, customs duties, etc. Then you will get the deductive value, okay. So that is known as deductive value. So first we need to take the sale price minus post importation expenses, then we get the deductive value. Understood this here? Now computed value. So computed value, you see, what is the difference between deductive value and computed value? In computed value, what we will do? We will not see the price in India. We see the cost in outside India. So raw material cost, processing cost, usual profit and general expenses, then freight, insurance up to the port in India, that is computed value method. Got the clarity here? So 1000 plus 500 plus 500 plus 150 plus 50, that is computed value will be 2200. So we need to take cost sheet, purely cost sheet, cost of material, cost of fabrication, usual profit margin, and all costs referred to in rule 10, that is freight insurance, then you will get computed value method. But actually we can decide between either a deductive value or between computed value, correct? Now when we go by deductive value, sometimes what will happen, we are not selling the goods as it is in India, we are doing some processing and then selling in India. Then what we need to do, so this after importation some processing cost we are doing now, that processing cost we need to eliminate, okay? After import we do some process and then sell in India, so take the sale price minus this processing cost is there now, that should be reduced. See there, if neither imported goods nor identical goods nor similar imported goods are sold in India in the condition as it is imported, the value shall be based on unit price, okay, sold in greatest aggregate quantity, but deduct what? Further processing cost. So today I don't have the sale price, you take any sale price before also. How many days before? Up to 90 days before, got it? Up to 90 days after such importation you take any price and that price you do the deduction. Then residual value. Residual value means when you are unable to, when customs officer is unable to determine the value as per any of these rules, then they will determine the value as per their principles, valuation principles, that is known as best judgment value or residual value, got it? This is similar to best judgment assessment in income tax. So wherein they will determine the value based on the information available with them. Then next you look into valuation in case of exported goods. Last we completed. So valuation in case of exported goods, what should be taken? Generally FOB price should be taken. Any adjustments? No adjustments, only FOB price. Value of exported goods shall be the transaction value provided price is the sole consideration and buyer and seller are not related, if value determined by valuation rules. Transaction value is the main criteria for valuation. Usually which value should be taken? FOB value is normally considered for value. However, this can be rejected if there is overvaluation. Usually in case of import we do undervaluation, but in case of export we do overvaluation. So why do we do overvaluation? Often done to get the excess export benefits, okay? Then exchange rate. Which exchange rate should be taken? Exchange rate at the date of presentation of shipping bill or bill of export. And if the valuation is not on the base of transaction value, then we have three rules, not like import. In case of export, just three rules. First one is comparison method, second is computed value method, number three is residual method. What is comparison method? Just like identical goods, similar goods, okay? See there, comparison method, transaction value of goods of like kind and quality exported at or about the same time to other buyers in the same country. All identical goods point you reverse, that is their imported goods, here exported goods, there at or about the same time, here also at or about the same time, same country, here also same country, but here there is a relaxation. If the country is not available, another country also can be taken. While determining the value, adjustments to be made. All these adjustments, difference in dates of exportation, commercial level, quantity, freight, okay? Then suppose if comparison method is not possible, then computed value method. In computed value method, what we need to do? Same, cost sheet, cost of production plus usual profit margin, but don't add any transportation cost because we need to take the FOB price. Then residual method, where the value will be determined by the officer, okay? That's it. These are all the points which are there. You can see transaction value of identical goods we discussed, and similar goods, then deductive value, and in deductive value, see this, what is the meaning of price at greatest aggregate quantity? You see this table and tell me what is the price at greatest aggregate quantity? What is the highest quantity? What is the highest quantity? 2000. So therefore 2000, 100 rupees should be taken, correct? Slight change. Now 98, 98, 98. Three places we have, correct? Now add the quantity. 2000, 1000, 1000. How much? got it? 4000. So for 98, 4000 units. Next 100, 3 places. How much? 1000, 1500, 2000. How much? 4500. Okay, so 4500. But basically when they have imported, you see, following are the sale details of product X imported from Japan on 1/1/2025. 1/1/2025 you are required to compute the assessable value of product X. So for the purpose of payment of customs duty. Now this 10/1, 1/1, 2, 3, all these are nearest, but 7/5 is very far. 7/5 is very far, so don't take this. Don't take this. This remaining and all we will take. So now you see 100 and 100. For 100, how many units? 1000 and 1500. 3000. Sorry, 2500. What's the next price? 99. 99, how many units? 1500. Next, 101. How many units for 101? 500. Any other price? No. Now you tell me what is the highest quantity? 4000. What is the price? 98. So 98 should be taken. Is it clear here? So don't just get carried away. So first you need to see the price and you divide a table like this. For that price, what is the quantity and what is the highest quantity there? That price should be taken. Okay. So sales made on 7/5 is not considered as it is made after 90 days. I told you within 90 days means 3 months. Beyond that it should not be taken. The greatest number of units sold at a particular price is 4000 units. Therefore the price at greatest aggregate quantity is 98. From that 98, deduct post importation. Assume the expenditure incurred in India is 18 rupees per unit. So 98 minus 18, that will be 80. Okay, 80. And from that 80, duty is charged at article and 25% ad valorem. Okay. So 25% is the duty. Take out duty also. Means this 80 is inclusive of duty. So into 25 by 125, that will be 16. You understood how we got 16? Clear here? Simple pa. 80 rupees is including duty pa. How much duty? 25. 25 divided by 125, that is 16. So therefore we need to take 80 minus 16. How much? 64 rupees. How we got 64 rupees? 80 minus 16, 64 rupees per unit. And how many units they are importing? 12,000 units. So 12,000 units into 64. 12,000 into 64, that is 7,68,000 is the assessable value and the duty will be 16. So 16 means 12,000 units into 16, that will be 12,000 into 16, that is 1,92,000. Easier. So this is about deductive value. I don't think so deductive value and all they have tested in exam so far. Okay, there is a chance. So that's what I told you. When you do the study material, sometimes they will take the question from study material itself and they will be asking. And the advantage, of course, again I am repeating, thoroughly. Every question, every page of study material you should have seen, because trust me, when I wrote my CMA intermediate, so at that time it was like morning one paper, afternoon one paper and 8 papers, same intermediate. It was 2000, I don't remember exactly the year, so 2005, 2006. That was the time I wrote my intermediate, 2005, and it was morning and afternoon. I was All India first rank. So in that attempt, and what I did was, at that time there was no lectures, classes, etc. Everything was self preparation. I used to thorough with the study material. Every nook and corner of the study material I used to read, and coincidentally that helped me for scoring in MCQs. That's where I am able to get more marks. Okay, and so the advantage of reading the study material is that when they give the MCQs and all, you will be able to answer. The problem is that they give study materials and there will be reference books. We study from reference books and refer the study materials. You understood? What we need to do is that we should study the study materials and refer the reference books, but we are doing reverse. Okay, so that's why problems you do that, okay, but at least all the sums which are there in study material should be covered. Keep that as a target. Practical papers, theory, okay, you depend on any material for theory, but practical papers, to the extent possible, try to depend on study material. Okay, then computed value, residual value, then this cost and services, already we discussed all those things. Then look into some questions based on this. All these things are not required. Valuation of exported goods, there also I told you what is to be followed. And see these MCQs. When the insurance amount is not available for ascertaining the assessable value for customs duty, the percentage of FOB value will be 1.125. Goods which are same in all respects, including physical quantity, is known as identical goods. Where the transportation charges is not available for ascertaining the assessable value for customs duty, the percentage of FOB value to be taken is 20%. Buying commission shall be included in assessable value. Is this statement correct? No. Buying commission will not be included in assessable value. Transportation charges incurred by importer for transporting goods from factory of exporter to the port of exportation shall be included in the assessable value. For transporting goods from where to where? Factory of exporter to the port of exportation, definitely that will be included. Okay, so first one B, second one A, third one B, 4A, 5A, correct. Then look into the next one. On the request of importer, the order of application of valuation rules 7 and 8 can be reversed. True or false? Yes, I told you, either it can be TIS, DCR or TIS, CDR. Okay. Identical goods means imported goods which are same in all respects, including physical characteristics, quality and reputation, as the goods being valued except for minor differences. Correct? Except for minor difference in appearance that do not affect the value of goods. True or false? True. Same physical characteristics, quality and reputation. For the purpose of computing assessable value, insurance cost at 1.125 value shall always be taken. False. Only if it is not ascertainable we will take. In case of air transport, transportation should be restricted to 20% of FOB while computing assessable value. True. Rate of exchange provided by CBIC shall be considered while computing assessable value. True. Then fill in the blanks. The value of imported goods shall be dash of such goods. Transaction value. For the purpose of customs, exchange rate notified by dash should be considered CBIC. Buying commission shall dash while computing assessable value. Included or not to be included? Not to be included. Then this, I think in these questions up to some questions we did. Question number 8, question number 9 we did. Look into question number 10. Malia Internationals Limited has imported a machinery by air from Germany. Bill of entry is presented on 21/2025. However, entry inwards was granted on 25/1. Which should be taken for rate of duty? For rate of duty, we don't have any confusion. Only exchange rate we have confusion. So for exchange rate, we need to take 21. So as on 21, what is the exchange rate? So CBIC rate should be taken 86. 86. CAF value of the machine, air freight insurance. This point only I told you. They have given CAF. What should we do? Can we take directly? No. Rework and get the FOB. Why we need to rework and get the FOB? Because we need to compare air freight. So 20% or actuals, correct? So what is the FOB? 5,500 minus 1,250 minus 100. that will be 4,150, correct? And for that 4,150, what is the insurance? 100. You take actuals. And air freight, what is actuals? Actual air freight, 1,250 or 20% of FOB, 4,150 into 20%, 830, whichever is lower will be 830. Now when you add, you will get assessable value and exchange rate will be 86. So 5,080 into 86, that will be 4,36,880. Got it? And customs duty we need to compute based on that. Basic customs duty 10%. So into 10%, 43,688, and thereafter social welfare surcharge, IGST. So total customs duty payable. Easy pa. Next. Question number 12 you see. RPG Limited imported 125 units of materials from high seas for sale in India. Selling price is exclusive of duties and taxes. Freight from port to depot in India is 2,530 and insurance is 310. So we have different sale quantities and unit price which should be taken. I told you how. First 105. 105 we have in 3 places. Quantity 80, 30, 10. How much? 120 units. Next. 90. 90 is in 2 places. 60 and 70, that will be 130. So for 90 it will be 130. And next 95 and 100, 150. Now you tell me where we have high quantity, 120. For 130, what is the price that is given? 90. So 90 should be taken. You got it? So imported 125 units and 125 into 90, that will be 11,250. 125 into 90. 125 into 90, 11,250. It's a mistake, slight mistake only, it's okay. 11,250. Then, now what we need to deduct? See there. Selling price is exclusive of duties and taxes. Freight from port of depot in India is 2,530. From port to depot in India, and insurance is 310. Now what we need to do, is it after importation? Yes, after importation. From port from port to depot after importation, take out minus 2,530 minus 310. This will be assessable value. On the assessable value, we need to pay customs duty. Assume that there is no IGST. So customs duty will be basic customs duty 12%, social welfare surcharge 10%. So 8,410 into 12%, that is 1,009.2, and on the top of that 10%, so that is 1,110. You understood? Next, question number 13. From the under mentioned relating to import made on 12/10/2024 of product Munich from Newark, USA to Kochi airport by Mr. Prahalad the importer. FOB value of product $10,000. We'll take that. Transport insurance, it will not come now. Unloading charges will never be taken. Okay, unloading charges will not be taken. Basic customs duty IGST, directly we will add transport. So 1,000, 3,500 insurance. What is the CIF? 10,000 plus 3,500 plus 1,000, that will be 14,500, correct? But it is which port? Airport. So therefore we need to be careful. How much will be taken as air freight? Actual or 20%? So 3,500 we will not take, but we will take 2,000, correct? So 2,000 means 10,000 plus 2,000 plus 1,000, that is 13,000 will be taken as CIF and convert into Indian rupees. CBIC rate 84. So 13,000 into 84, that will be 10,92,000. Now thereafter basic customs duty 10%, social for such 10% and IGST 18%. Basic customs duty, social for surcharge, IGST you will get. Got it? Customs duty and all is simple here. Already we did lot of sums. That's why I am just showing you how to arrive at the answer. Then illustration 14. compute the assessable value of a machine imported from Germany by RLI Limited under Customs Act. Also determine the duty liability of RLI, FOB 30,000 and air freight. So we have some adjustments to be made. This 30,000 is the FOB price given. Design and engineering charges we need to add, and incurred in India, no, it will not be added. In India, it will not be added. Indian Agents Commission. Indian Agents Commission, whether it will be coming? Yes. Local Agents Commission, it will come. Transportation charges from port to factory in India will not come. Now, what we will do? Say this. So, we will do the answer for this. What is the FOB value? Can you please check and tell me? FOB value how much? 30,000 into 85. 30,000 into 85. $30,000 into rupees 85 per dollar. How much? 25 lakh 50,000. Now add selling commission. What is the selling commission? Local agents commission. 20,000. Anything else we need to add for this? Nothing. No, that is afterwards. Now this will be called as FOB price as per customs. Okay. So that will be 25 lakh 70,000. To this 25 lakh 70,000, we need to take insurance. Ascertainable or not ascertainable? Not ascertainable. So 25 lakh 70,000 into 1.125%. Okay. 1.125%, that will be 28,912.50. Then freight, how much will be the freight? Actuals. Actuals, what is actuals? Air freight, $7,250. So 7,250 into 85 rupees per dollar. 7,250 into 85. 6,16,250 B, 20% of FOB. What is 20% of FOB? So 25,70,000 into 20%, that is 5,14,000, whichever is lower. Whichever is lower, that is 5,14,000 you take. Now you do the value, assessable value. 25,70,000 plus 28,912.5 plus 5,14,000, 31,12,913. 912.5, 913. Okay. So what is the assessable value under customs? 31,08,688. You know what is the mistake that they have done? They have added the local agents commission after adding freight and insurance. Actually, local agents commission will come as a part of FOB. So this is wrong. This answer is wrong, because as per format, if you see, first we need to do FOB value as per customs. After doing FOB value as per customs, then only we need to do the freight and insurance. Okay. This is actually question number 14. Question number 14. So just keep that. Okay. So anyhow, I'll share this with you. So keep that and you can start working out like this. So don't follow this, because see, if you see, some questions they did normally, some questions they did like this. So this is really a mistake. Trust me, it's a mistake. I am not lying. Okay. Then question number 15. Informatics Limited imported a photography printer by air from Bestin Corporation of USA as per following details. CIF value 4,500, but air freight is given, insurance is given. So we need to do the reworking. 4,500 minus 1,250, 3,250 will be taken as FOB, and air freight actual or 20%, whichever is lower. Insurance assessable value we got, and thereafter we need to take the exchange rate 84.5. So we got the assessable value and computation of customs duty. Easy na? Next. Question number 16. R Limited has imported one machine from England. It has given the following particulars. Price of the machine is 8,000 UK pounds. Freight paid air 2,500. Design and development charges in UK. We will add this, correct? So first price of the machine 8,000 pounds. Design and development charges 500. Commission paid to local agent. We need to, but convert that into Indian rupees. So date of bill of entry 24th October. Date of arrival 20th October. Exchange rate as on bill of entry should be taken. But rate of duty whichever is later, that is 10% only will be taken. So 100 rupees. So 8,500 into 100, that will be 8,50,000. Then local agents commission will be 2%, that is 8,50,000 into 2%. Okay, one second. So 2% of what? 2% of what? Price of machine. What is the price of machine? 8,000, not 8,500. So 8,000 into 2% into 100, that will be 16,000. Okay. Now you will get FOB value as per customs. Then you need to take air freight actual or 20%, insurance, you will get the remaining details. Then question number 17. ABC Industries Limited of Mumbai imported one machine through vessel from Japan in the month of November. The following particulars are made available for computation of customs duty. Cost up to the exportation incurred by port of exportation incurred by exporter 6 lakhs yen. That 6 lakhs will be taken as the ex factory price. Okay. And next, loading charges at the port of exportation. So that is 25,000 yen. Freight charges from port of export to port of import, that we will add later. So 25,000 we need to add. This will be the FOB price. And what is the exchange rate? 0.71. So when you convert into 0.71, you will get FOB price in Indian rupees. Now we need to add some charges. What is that? This freight we will take later. Design charges necessary for the machine paid to consultancy firm in Delhi will not come because it is incurred in India. Then commission paid, not buying commission. Yes, it will be taken 1,25,000. Then actual landing charges at the place of importation should not come. Light rate charges paid, this is part of freight. Light rate charges paid is part of freight. Insurance not ascertainable, that's it. So we got FOB value as per customs 5,68,750. Add freight charges. How much is the freight charges? See there, 1 lakh yen into what is the exchange rate? 0.71, that will be 71,000. Light rate charges is also part of freight. The insurance will be 5,68,750 into 1.125%. So we got this CIF. Thereafter customs duty, social welfare surcharge and integrated tax. Done. So all the questions, around 17 questions, and previous also we have, every question I solved in customs. Okay. So this is sufficient, and thereafter you don't have to solve this. Already I gave you practice manual. In that practice manual also these questions are already there. Remaining questions you practice. Okay. So we completed everything except for exemptions under customs. Now see this, some questions we will see based on this. Take page number 241. Take page 241. The limit of exclusive economic zone in India is dash from the nearest point of the baseline. What is exclusive economic zone? Easy, 200 nautical miles. Which of the following is a taxable event for imported goods? Date on which goods cross customs barrier, date of presentation of bill of entry, date of entry into territorial waters. date on which goods cross customs barrier. A ship carries some goods KLMN from Singapore to Dubai via Chennai. N and M are moved at Chennai in another vessel. L being meant for Kochi and M to Dubai. As per customs law, the transshipped goods are, which one is called as transshipped goods? L and M are L, both. Which goods are taken from one ship to another ship? L and M. So this is called as transshipment. Is it clear? Transshipment means movement from one conveyance to another conveyance. So L and M is moved. Then next one. All goods, derelict, jetsam, flotsam and wreck brought or coming into India shall be dealt with as if they were into India imported. As if it is imported into India. As per section 2 clause 31, person in charge means for vessel master, for train conductor or guard, for vehicle driver, all of the above. Okay. So A, C, B, D, correct. Then true or false, entry number 83 of list 1 to schedule 7 of the constitution empowers the union government to legislate and collect duties on imports and exports. Correct pa. So usually 7th schedule to the constitution has 3 lists: union list, state list and concurrent list. Union list gives the power to levy taxes to central government, state list to state government and concurrent list to both central and state government, wherein customs is covered under union list. Okay. So entry 83 correct. The Customs Act extends to whole of India except to the state of Jammu and Kashmir. False. Territorial waters extend to 12 nautical miles into the sea from the baseline on the coast of India and include any bay, gulf, harbour, creek or tidal river. True, true. Territorial waters is up to 12 nautical miles. The exclusive economic zone of India is area beyond and adjacent to territorial waters and the limit of such zone is 100 nautical miles. False. It's 200 nautical miles. Coastal goods means goods other than imported goods transported in vessel from one port in India to another. True. See, imported goods or exported goods means outside India to India, India to outside India. But coastal goods like that, some goods are there which are taken from one port in India to another port in India. That is called as coastal goods. True. The exclusive economic zone is an area beyond and adjacent to territorial waters and the limit of such zone is 200 nautical miles. Baggage includes unaccompanied baggage but does not include motor vehicles. No idiot will bring motor vehicles as a part of baggage, na? Correct? Next. Dash means goods for use in a vessel or aircraft and includes fuel, spare parts. What is it called? As I told you, stores. Goods being derelict, wreck, jetsam coming into India shall be dealt as if they were imported. Section dash of Customs Act empowers government to grant exemption. That is section 25. Section 25 that we have not yet discussed. Okay. And actually on exemptions they have not given much questions, but we will definitely discuss that in tomorrow's class. Okay. So majorly I completed today. Just a small chapter is left, that is exemptions under customs, that we will discuss tomorrow. And tomorrow what I will do is that I will be covering the other topics that we have in GST. In GST, if you see, recently December exam also they have asked some questions on valuation. So valuation, that is value of supply, is what we are going to discuss tomorrow. Okay. So what I will do is that these extra topics when I am discussing, along with this the regular portion also you should be learning. So I will tell you what are the chapters which I am going to cover tomorrow. I want you to revise it once from whatever you have studied and come, so that it will become easy for us. Okay. So tomorrow's agenda, customs exemptions we will complete. Valuation under GST. Valuation under GST we will be discussing. And then time of supply, that is value of supply we will be covering. Time of supply also we will be covering. So please read these two. Value of supply and time of supply. Okay. And even place of supply. 3. value of supply, time of supply, place of supply. Because we have some information related to that, rules etc., section 12, section 13, so that we will cover tomorrow. That's the agenda for tomorrow. Thank you. We'll meet tomorrow. And tell me whether today, morning to evening, whatever time that you have spent, is it worth? Yes, it's worth. Because when you sit on your own, you will not be able to cover all these things in one day. You understood? So that's what. In YouTube also it will not happen. Because what will be problem is that in YouTube, I'll be taking, you feel like you are listening, but you will not listen. And only in face to face, because I'll make you listen to the class. Okay, fine. So tomorrow will come, right? Done. We'll meet tomorrow. Take care.